less than a year in trading, and I'm hoping to learn from the bootcamp some precision about entries. And if I could go back in time to tell myself 10 years, I wish I had known about trading a long time ago. It's just with my roommate that I learned about trading, and he has helped me a lot to be at least get some money from the market, but I still need some precision. Thank you.
That's awesome. Thank you, brother.
And I'll jump in really quick. You can hear me?
Yes, sir.
Yes, sir. My name is Earl Simpson. I'm actually down here from Miami. Just met Griffin actually this past weekend at FX Summit, and I got to talk to him actually for about 3 hours a couple of days ago, and I signed up for the boot camp immediately. He said there was like one spot left. I was like, okay, boom, that's me. So how many years have I been trading? And shout out Tristan too, yo. I met actually Griffin and Tristan this weekend, yo, Atlanta and North Carolina. So I've actually been trading. What's up? I've been trading for about 6 months now. Actually, all this is really new to me, but it's been a beautiful journey. What I'm hoping to learn from boot camp is, for a long time, people kept saying, well, the charts are random. There's no way of analyzing or predicting. Or what I want to know is what is in the minds of these financial institutions, like what makes them move the markets the way they move them, So I'm really trying to get that insight on the mindset of it. And if I could go back and tell my 10-year-old self 3 words, it would be keep the faith. Yeah.
Love it. Don't stop believing and keep the faith. Awesome. Good. Awesome, man. Well, thanks, Earl. It was awesome meeting you this weekend, and we're definitely catching up soon, brother. So, all right, bro. All right, let's get a few more people, and we'll go ahead and get started, guys.
All right. Hello. My name is.
Yes, sir.
My name is Jabon. Y'all hear me?
Yes, sir.
All right, my name is Jabon. I'm from Connecticut. I've been trading options for about 13 years. And I think one of my biggest issues is I've learned too much. And I want something real simple. That's what I'm hoping to get. Well, not necessarily simple, because I'm sure what we're getting ready to learn is not simple, but just a different approach from what I'm used to, and taking advantage of that. And if I could go back and tell my 10-year-old self something, I think I'd tell him, marry a hustler.
Absolutely. Marry a hustler. I love that. Yeah. To each their own. Yeah. I mean, definitely. I mean, who you surround yourself with, especially your significant other, you want to be motivating one another. I mean, at least for me, I love working around people who are always going to be, contributing, who are hustlers, who want, who really are just go-getters and want, love the grind, who are going to get it, not nothing against, marrying that individual, but that's the whole purpose of the community, right? Surround yourself from like-minded individuals who are addicted to the grind and the hustle. And there was an interview by Tony Robbins, and what's the same, personality or common trait that all millionaires have, or at least the majority of them have? It's the hustle. No matter how many times you fail, keep seeing light at the end of the tunnel, keep going. Doesn't matter how many times you fail, you only need one yes to get there. So absolutely the hustle. All right, let's get 3 more people, guys.
Let's hear from one of the ladies, man.
Ladies, thank you, ladies. All right, let's put Miss Anna on the spot real quick. She has been here. I'll put Miss Anna.
Hi, I'm Anna. I'm from Washington. I'm in Seattle right now. I was in part of the March boot camp. I joined for the second half. Been training for about 2 years, but Forex actually just started back in January. I'm hoping to kind of focus on points of interest this boot camp. Get my refinements down right. If I could go back and tell my 10-year-old self 3 words, what would they be? Have more patience, probably. I feel like I'm always in a rush to do things, so I think I could value or use a little more patience.
All right, well, thank you. All right, let's get 2 more, and then we're gonna say one girl for every introduction, make it a little interesting. So thank you, Anna. Let's get 2 more people, and we'll get started.
Right. I'll go next, Griffin, if that's okay.
Yes, sir.
Hey, it's Mesh. I've been trading for a year. I think we did our call in March, if I remember, Griffin. And then at that time I was still doing Uber on the side, and finally I was able to get a job right now. So when I started trading, I think I told Griffin I lost about 50K in a year, like in 90 days, I guess. But then I just wanted to make sure that I study properly. I have a friend of mine in this bootcamp, TJ as well. So we started studying together, and we have been studying forever, I guess, together, doing back testing and all. And if I go back in time, I'll be telling myself, believe in yourself. That are the 3 words I'll be telling. And just an FYI, guys, if I'm not doing at this screen because I'm at work, that are my work screen. So just an FYI.
Understand, brother. Thank you, Mesh.
Yeah.
All right.
That's a good 3 words. Yeah. I'll go, I guess, if that's cool.
Go for it, Dan.
So my name's Daniel DePork. I'm from Orlando, Florida. Technically been trading for like 5 years, but started Forex about 9 months to a year ago. I'm really hoping to learn from the bootcamp is, I guess, just understanding, like finding good points of interest better versus, smart money traps. And then the 3 words I'll tell myself would be to trust your gut.
Mm-hmm. Awesome. Yeah. And for those who know, so I was just saying, after I lost everything, I was in the beach, North Carolina. When I moved back down to Clemson, I actually worked with Daniel for a period of time. And, this was when I was making the money again on the come up, and he saw, and, I was up 20K in a day. I was like, fuck this, I'm out of here. I'm leaving. Like, no more. Like, I finally, was able to get back to one piece. It's really cool because, I was working with him. He was able to see that live hand. And ever since then, that was the last time I ever had a traditional job, but, a job. And, Daniel is someone really who was that last person that I was able to talk with and work with. And now my goal is to help him, just like all of you guys, do the same. So thank you, bro. I really appreciate it. All right, so one more person.
Appreciate you.
Yes, sir. We'll go ahead and get started.
Yeah, I'm happy to go now. So I'm Ray from London. I've been trading about, I think I started about 2018. all sorts of stuff. And then obviously over the last 2-3 years, I came into S&C refinements and all that. And that's why exactly I'm here hoping to learn from here. Obviously getting better entries, better TPs, and understanding how the whole order flow flows and whatnot. And if I could tell 3 words to my 10-year-old self, certainly protect your energy, because everything is about energy. And if you surround with the wrong crowd, you're going to end up getting spun up into it. And next thing you know, you're screwed.
Yes, sir.
Awesome, bro. Awesome. Yeah, I mean, I believe there's so many of us in here who, are all about energy. And I mean, it's absolutely right. Everything has energy. And, I'm very surrounded. Who you surround yourself with, ultimately, it's going to rub off on you. And making conscious decisions about who's worth your energy, who's not, and, what things specifically aren't. That's definitely a crucial thing to make note of. So absolutely, brother. Thank you. All right, guys and girls, we're going to go ahead and get started for today. So before we get started, one last little intro thing, everybody, is we're going to be having our bootcamp challenge. So what is the bootcamp challenge? So this is going to be an opportunity for the May bootcamp students for you guys to complete a series of tasks and have a name entered into a raffle to win some cool prizes at the end of the bootcamp. Now, this is wholly optional, but as you guys will see, I would definitely recommend you guys doing it. So how to actually enter the challenge? Well, for each completed task, you'll be rewarded a certain amount of tickets with your name on them. And again, these are digital. We have a digital person who's going to be counting all this. And what are the tasks? Well, you can either choose to repost or rather post just a snippet from the bootcamp. You guys are allowed to do that. Obviously, yesterday we mentioned there's no recording, nothing in the bootcamp. Now, of course, taking a picture, just whatever it wants to be, or a little video, not going to hurt, right? So just let us know that you're doing that. But yeah, guys, so posting it, the content just on your Instagram story, at least one time a day is going to get you that first raffle. So it could be introducing me, teaching, someone else going over something, so whatever it is, just really helping spread the word as we are going to be really reaching new global levels. So that's going to result in 1 ticket. Now, if you want to post a picture of yourself or your screen during the bootcamp, right, and tag effects, that's going to get you're getting 2 tickets. And then the last thing is post a quick video of yourself one day for the bootcamp to mention you're excited about it, 5 tickets. So when we say video, it could be a video of yourself saying how the bootcamp was, awesome day, awesome bootcamp, whatever. That's going to result in 5 tickets. Now, it's important to note the person who does the most is not going to be rewarded the prize. It's still a raffle. It's a genuine raffle. Everyone's names are going to be entered. We have a log to keep track of everything of who posts what, and the tickets that are credited. So if you have any questions about that, you guys let me know. It can be about anything. It doesn't matter the topics. But if it is a video of yourself saying something about the bootcamp, your genuine thoughts, that will be 5 tickets right off the bat. So now, what's the prize? Well, you guys are going to be receiving an exclusive Dreams Effects trading shirt and a $50K funded trading account right after the bootcamp. So this is completely free of charge. It's just to help create awareness. And something I'm very hell bent on, again, is your success. If there's anything that I can do to help you guys become successful, I'm also going to be providing the opportunities. Now, everyone wants to get funded, but what if there's a way for you to not spend on, again, is your success. If there's anything that I can do to help you guys become successful, I'm also going to be providing the opportunities. Now, everyone wants to get funded, but what if there's a way for you to not spend any time or money to get funded and you can receive that as a reward? Well, that's what I'm here to give you guys the opportunities to do so. So actually, Tristan is, and I think a couple of us are wearing our shirts right now. I can actually also grab one, but if Tristan, I don't know if you want to show, but it's awesome. We have polos. These are for the educators and these are also for the ambassadors. Additionally, is that we have the t-shirts. So t-shirts are going to be exclusive. You can't buy them, only exclusive merchandise. We have limited amounts of them. And Tristan, I don't know if you're able to, brother, but are you able to show what the shirts look like? Oh yeah. So at the front of the shirt, it says Dreams Effects on the side, and then on the back, it just says turning dreams into reality. And it's awesome. It's a Nike dry fit shirt. Thank you, bro. Appreciate it. Awesome dry fit shirt. And we have all of them. And we have all sizes too. So you want to go through those and get to the next level, starting your journey right out of the bootcamp positive, and you can go right for it. So additionally, guys, the last shout out opportunity is we want to show off your hard work, guys, to the community, and we'd like to offer you guys to take pictures of yourself with your daily notes, you guys social media shout out. So if you want to take a picture of yourself, the notes that you take, we would love to give you an Instagram shout out, post it on Instagram, shout you guys out, and that's just something additional. Again, none of this is mandatory, all optional. But yeah, so if anyone has any questions about that, y'all let me know. But this will be introduced every single day, just a brief overview. But yeah, guys and girls. So now let's go over the overview. So this is going to be the 4-day overview of the bootcamp, and this is generalized, right? So this isn't like a specific section, but these are the blocks. So today is everything about total SMC review. So smart money concepts, understanding what is SMC, what is retail versus smart money concepts. Then we're diving right into structure 101, what is basic structure, going into advanced structure, complex structure, structure 201, and then market fractality and wave theory. So the day one, guys, is especially, it's going to be longer, especially with the student introductions, but this is going to be the most pivotal day in the bootcamp. That's going to set you guys to have a solid foundation. Every day is building upon one another, and if you don't join the day before, you're going to be really lost the day after. But regardless, again, I want to emphasize, no matter what your understanding is right now, you will be exactly where you need to be come time, especially next week. If you guys are having trouble with some stuff from day one, we provide homework. You guys will receive study guides, cheat sheets, diagrams, everything you guys need. So that's the first block for today. Then going to the second block, where we always have breaks implemented. So block 2, we're going over that complex structure that we just mentioned, liquidity 101, IFCs and POIs, understanding at the most fundamentally basic level what institutions are doing, or not doing, but what order blocks are, what the institutional quote unquote intent is. Block 3 is going into POI locations and refinements, know exactly where the main move is going to happen, or at least some form of pullback move is going to happen. Understanding institutional order flow, understanding how those institutions are accumulating their positions down on the most basic level, and then followed up by extensive case studies. And this is going to be all day one, but it is imperative to note, everybody, no matter your understanding of day one, you're going to be completely and utterly unlearning everything. Right? Maybe you've never learned day one. Yes, you need to know it, but even if everything else you've been doing, you're going to be unlearning this. And the whole bootcamp process is, in order to know how to win, what do you need to do? You need to know how to lose. The whole focus of the bootcamp specifically is understanding why all strategies fail. And one of the most important ones is SMC. So day 2 is unlearning all of this and learning essentially how to fail. So going over advanced liquidity theory, liquidity types, SMC versus true institutional ideology. I may be speaking a different language for those who don't know what any of this is, but for those who do know, you're going to be learning why SMC fails, what SMC traps are, how liquidity is king, not structure. Structure has no relevance in the market besides telling you, everybody, no matter your understanding of day one, you're going to be completely and utterly unlearning everything, right? Maybe you've never learned day one. Yes, you need to know it, but even if everything else you've been doing, you're going to be unlearning this. And the whole bootcamp process is, in order to know how to win, what do you need to do? You need to know how to lose. The whole focus of the bootcamp specifically is understanding why all strategies fail. And one of the most important ones is SMC. So day 2 is unlearning all of this and learning essentially how to fail. So going over advanced liquidity theory, liquidity types, SMC versus true institutional ideology. I may be speaking a different language for those who don't know what any of this is, but for those who do know, you're going to be learning why SMC fails, what SMC traps are, how liquidity is king, not structure. Structure has no relevance in the market besides telling you, it's going this direction. But what actually makes structure structure? You might not know that. Understand what the true IFC is, liquidity inducement intro. And then block 3, this is the most pivotal, transitioning into the second weekend, which is everything about the algorithm. So how to escape the matrix, right? Intro to inducement, the different types of inducements and purposes. And last but not least, of course, always going off of the cliffhanger, the origins of the algorithm. Because the whole purpose of this bootcamp is nothing is ever random in any financial market. You always hear, the markets are risky. Well, duh, there's always risk associated, but they're never ever random. And people say it's impossible until it's done. And that's exactly what we're showing you. When you understand that every single move anywhere, there always has to be enough of something in order for it to get there. That's what we're going to be exclusively disclosing. So day 1, day 2, and then just a quick overview of day 3 and day 4 right now. Right here, day 3 and day 4 is, of course, our favorite days. These are the most heavily intensive and important. Algo origin. So advanced liquidity 201 review, going over inducement review, what the liquidity inducement cycle is. And then block 2, this is where the magic is happening with block 3. What the central bank algorithm is, how the banks actually trade, because those who know what SMC is or smart money concepts, banks don't utilize that trading. The banks don't even look at effing price charts, when they execute their trades. Nothing like that. How to ping pong the markets. Of course, going to everything else about trap and stack, my personal proprietary approach to understanding the markets and how the institutions on the most fractal level are accumulating their positions and stopping out everyone. Followed up with extensive case studies. And then day 4 is everything about trading the algo. So we talk about everything regarding the first dimension of trading, which is price, but the second one is time. How many times have you guys heard, when the time is right, something will happen, right? Or when it's the right time in the right place, something will happen. How many times maybe have you guys seen you ended up meeting someone at the exact right time at the exact same place you needed to? What are the coincidences of that happening? For instance, me meeting you guys, some students this weekend. It's crazy just how everything happened coincidentally to happen at the right time. Trading is no different. When timing aligns, when it's the right time, the right move is going to happen. And everything is about energy, and everything in the world, there's no coincidence, right? There's no coincidence we're on a floating rock, and I get into that in the bootcamp. But that's what all day 3 is. Everything regarding time, entries, price and time delivery, understanding all the different sessions with our own refinements within those sessions. And what if I were to tell you guys, what if you'd be able to not only have a projection of what's going to happen, but have a whole week of price action of understanding the individual trends that are going to happen, individual sessions for the whole week planned out on Sunday. You can do that. You can know everything that's going to happen throughout the whole week and know every single move in between every individual session of the next 5 days without even knowing. And that's where the whole mastermind approach comes into play. You know what's going to happen exponentially before it's even there. We don't want to have 2020 hindsight. Anyone can. You need to have 2020 foresight. All right. So finally, makes it for everybody. Yes, sir. All right. So finally, we are getting into the fun stuff. So again, always intro, it's a little long, so hang on, guys and girls. So 5 bootcamp rules and reminders. These are some important notes to keep in mind prior to starting the bootcamp. And right after this, we get right into it, guys. So the first thing, the bootcamp duration is 4 days and 5 to 7 hours each day. So especially today is going to be a longer day. Of course, I'm going to get through it. And for those who know, day 1 is something I love teaching, but it's definitely my least. There's just so much information to cover. And because we almost don't utilize anything from day 1, it's still important to know because you need to be unconsciously processing all of this. So the Mastermind Bootcamp is a 2-week grind for a lifetime experience. Yes, I understand, you might have friends, boyfriends, girlfriends, time to spend with your family. I completely get it. I've had so many scenarios talking to students where they may not be able to join and whatnot. So I understand the bootcamp is long, but it's important to know it's only 4 days. And then everything after you can do on your own time. It's all recorded. But these 4 days are crucial. And hypothetically, if you can't stay for those 4 days, well, we do always record the bootcamp. Even now, I'm recording the bootcamp, and you'll be able to see everything as is. And we will have a scheduled time and date for you to participate and rewatch the recording. And it's available to those who missed the bootcamp, who had to leave, etc. So make sure to pay attention. And as we know, training bootcamps, especially in the military, they're designed to be a short, rigorous training course, right? However, by providing mental adequate breaks to ensure your attention and focus on the material being taught, we're going to make this a lot enjoyable. It's not just going to be me lecturing the whole time. We have fun games, interactions. You guys will see. So as long as it is, we try to make it as fun as possible. So that's the first important thing. The second and the most crucial, your camera must remain on the entire time. Now, I know some of you guys might not be able to, blah, blah, blah. If you have to turn your camera off, you will have one warning to do so. Now, for those who message me privately and they can prove what they're doing, I get it, and that's fine. But maybe let's say you don't have a camera on your computer, that's fine. Log in using your phone and show your face with your phone, right? There's still other ways around that. Also, if you can't have your camera on, I'm going to ask you to politely leave. We do have a DreamsFX admin or moderator who is literally his whole job is to constantly watch your cameras to see if it's on, if it's off. Additionally, is not just keeping on your camera, but no recording. And we talk about that as well. So, guys, for security purposes, as stated in our NDA, we teach our proprietary intellectual property that has enabled us to pick our specific edge in the market. So any attempt to record the bootcamp, take pictures, besides, unless authorized, which I did say, right, will result in instant removal from the bootcamp with no refund. As fun and as engaging I want to make this we understand how toxic this industry is. Everyone trying to make a quick buck, blah, 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 want to resell shit or even learn it for yourself. I promise you guys, don't think, everything's in the bootcamp. Everything is not in the bootcamp for that specific reason, right? I mean, you learn everything inside, but the mastery, everything happens after. Let alone, guys, you receive everything from the bootcamp after the bootcamp, the diagrams, protocols, everything in a student resources folder. So I'm going to heavily emphasize, please don't be dumb. Please don't. I know you guys are going to fear of missing something, blah, blah, blah. But if we do catch it, no refund, kicked out, and you guys will never be allowed back in. And that's something we're hell bent on. And lastly is if it is redistributed, or especially after joining the bootcamp, that's when it becomes much more serious, where you guys are going to be prone to legal prosecution of infringement of intellectual property in specific cases, referring to the NDA, and will be subject to $500K fine, up to 10 years in prison. Now, that's not just some words. We do have I personally have a legal team that I've had for the past year and a half now. I'm advising, please don't do this. It's not worth it. You guys literally get anything regardless. But we shouldn't have any problems like that, right? We're all good. We shouldn't have any problems. So, all right, guys, that's the second rule, most important. The next thing, write down all of your questions. Write down. Even right now, if you need to take 30 seconds, get a piece of paper, do so. You need to have one specific piece of paper for label it literally questions. And what I want you to do is I want you to create subsections when you have your questions. It needs to look like so. And this will help you with organizing. So for instance, right here, let's say this is your sheet of paper, everybody, right? This is your sheet of paper. You need to have questions at the top. And what I would do is I would then break it into 4 days. Here could be day 1, here could be 2, 3, right, and 4. So these are your questions on every single day. Just write them down, do whatever you need. And the reason I'm saying this is because I know all of the questions you guys will be asking. As an educator, I have to anticipate everything. And I've done this 5 times on the bootcamp, 5 times. We know all the questions you guys are going to ask. And the bootcamp is specifically structured so that every question will get answered the next day. So for instance, of course, you're going to have questions on day 1, but day 2, those questions should be answered, right? So that should be happening on day 2. After that's being responded to, you're going to have more questions on day 2. That'll get answered on day 3. So the bootcamp is not styled to be an active Q&A session. That is something there's a lot of people that we need to teach to and get the message across. So for that reason, please have your mics muted at all times. We know you guys are going to have the same questions, but throughout the bootcamp, you will receive 95%, if not 100% of all of your questions asked. Additionally, at the end of day 4, there is a Q&A session for all answered questions to happen. Again, when we do have our breaks, if I am here and maybe I can answer a quick question, you guys can ask that. But other than that, let's reserve the questions. You can even ask them in the main bootcamp chat, work with your community. Your community is your whole resource. You guys are all students graduating together. Utilize one another. Guys, quick question, market makers guy. Who I need to ask who the market makers guy is?
That's me, Marlon Simmons.
Oh, okay, Marlon. Are you able to turn on your camera, brother?
I thought I had it on. I'll see how I can get it fixed, but I thought I had it on.
Yeah, sure. Just message the admin, Dreams FX admin, and talk with him. Yeah. All right. So write down all of your questions, guys. So the fourth thing, of course, is taking high quality notes. Organize your notes to be as clean as possible in order to study as most effectively as possible. So you guys are getting given adequate time for notes. And most importantly is don't write down everything you see on a page like you're in elementary school looking at a presentation. Don't write down paragraphs, paraphrase, write the most important things, especially what I say will be more important than what's on the screen. Because of course, I'm not going to have everything put on a screen for you guys to read. What I'm going to be saying is much more important than what's on screen, or it'll even have more precedence or be in addition to what I'm not going to write on screen for extra security reasons. So paraphrase, draw replica examples, color coordinate them. If you have blank pieces of white printer paper, that'd be perfect, and take notes that way. Have red for, sells or bears, green, blue for bullish. And that's really just going to maximize your studying, because you always want to refer to your notes in order to study, keep leveling up. And that bootcamp experience is just going to be helping you. And additionally, there will be an opportunity to receive diagrams for the bootcamp afterwards. So stay alert from that. Anything you see in the bootcamp, we have different diagrams that with clear, specific explanations that we provide with your name watermarked on it. So you have access to that. If it's not perfect, don't worry about it, but just try and take it like it's serious. Okay. So, all right. Lastly, everybody, then we can finally get into, I know it's been a while, be respectful, have fun, and learn as much as you can. So all of you guys are a part of the same bootcamp, and just like college or high school, you'll be graduating together off into the top tier world of trading. We're all here for similar reasons, and by developing meaningful relationships with other members and building a community of high skill set individuals on a global level, right? This is what's going to separate us from everyone else. It's not just, oh, what are you looking at here? What are you looking at here? No, you can be making connections, networking. Maybe you need, freelancer, someone, and one of the other students is a total beast at it. You don't know, right? Make friends about this. After COVID, especially, everything is online, virtual. One way or another, we're going to be going virtual. So if you can have a community, a whole freaking support group online, guess what? That's what you need. And it's not like you're surrounding yourself around, maybe some of your friends who have no ambitions, or honestly, some of you guys have friends who are where you want to be. You guys need to, in order to get to the top, you guys need to surround yourself with individuals who aspire to do the same. And we're all there. And it's not about money, it's about the impact, right? So have fun, soak up all the info, and then off to where the real mastery begins, guys. The post bootcamp, an exclusive Dreams FX Discord server is where all the hype is. So before I get started, everybody, I want to ask, do we have any preliminary questions? It's the only time I'm going to ask for questions before we get into all the material.
Griffin, are we planning to take breaks every couple of hours, or how will that work?
Yeah, so they're going to be structured about every hour to hour and a half, depending on the sessions. We want to ideally after each block, but there will be about 4 to 5 breaks, especially on day 1, and they'll range anywhere from 5 minutes to 8 minutes, 5 to 10 minutes. All right, anybody else before we get started? All right, good stuff. All right, everybody. Well, without further ado, let's go ahead and get started. Everyone, please make sure to let's have everyone mute their mics. Make sure everyone's just muting their mics, and we'll go ahead and get started right now. All right, everybody, are you finally ready? All this bogus that's done with, right? Are you ready? Well, let's go ahead and dive in, everybody. This is gonna be an awesome day, very, very long, very long, exciting, interactive. And if you know this already, then great, you're supposed to this. If you don't, well, let's have patience for those who want to learn and know more, because this is what you need to go and know before going forward. So at the most basic level, everyone, we first understand what smart money is. So what actually is smart money, right? So we have heard of retail traders, and for those who've never heard of smart money before, we need to understand there are 2 types of money or positions traders in the market. So smart money refers to the collective force of big money that moves, controls, and manipulates all financial markets. So we have heard before, everyone, that the markets are manipulated. And if I were to ask you, how many people believe the market is manipulated? Everyone, right? We all know the whole goal of market operations is they don't want you to win. They don't want you to win. And that's why people say, oh, the markets are risky, I want to lose. Why do they say that? Well, they are right when they say it's risky, because the whole goal of all markets is to make sure that you lose. Like that's what you need to establish right out of the bat. So smart money is that collective force that actually controls the markets. Let's say you have maybe $100 account, $1,000 account. Do you think you entering a position is going to do anything? Absolutely not, because the markets is trillions of dollars, right? It's trillions of dollars of money. Your little $100, even $1 million, doesn't mean anything to the market. It's just a little tablespoon of water, a little drink, and you're like a whale the size of Earth. It doesn't matter. So this is inclusive, everybody, of all the central banks, institutions, hedge fund, market mavens, and all other financial entities. So we've heard of hedge funds, the central banks, all these different types of participants in the marketplace. They're the ones that are contributing all the money, the central banks, the governments. Even if Wells Fargo, Bank of America, as this is going to be particularly or specifically relating to Forex, there's a Forex sector for the banks. I mean, how do the banks make money? Well, trading, international, foreign exchange. Foreign exchange is all about currencies, right? It's all about currency exchanges. How do you assess how strong something is? How do we know how do we know the value of a dollar? How do we know that $1 is $1? Well, we have to compare it against something else to give it its value. So we need to compare it against other currencies to determine the value of that currency. And again, this isn't an intro course by any means, but we need to understand that there are banks that are trading Forex, constantly exchanging money. When your money is in your bank account, it's not actually in your bank account. The bank is lending it and loaning it to those who are, they're using it as loans, trading, investments, bonds, anything that they can utilize their money. That's what's happening with yours. So trading performed by these entities are executed by complex algorithms developed by engineers and developers, and trades automatically without any human interaction, everyone. So this is where we are. We are all the retail traders sitting behind our laptop and we're wanting to trade. If I were to ask you guys, when you guys think about Wall Street or an institution, a hedge fund, maybe some of you guys might think, there's a trader sitting behind a desk entering positions. No, that is not happening. What is happening is trading is virtually all automated nowadays. Wall Street, everything is automated. There's complex algorithms that are taking their positions based off of specific strategies that are manipulating, controlling their movements and the markets. So we need to understand our cute little positions, buying, selling. That's not what the big money who is controlling the markets are doing. They're doing autonomously, automatically, mechanically, and we are completely different than them. So we have two types of traders: retail traders, AKA us, and then we have the institutional or the smart money traders, right? The true smart money, those who are the hedge funds, banks, everything else. So this is going to be the first introduction to just the basic, what is smart money? Give you guys about another 30 seconds or so. Right. So now though, what is retail trading versus true institutional ideology? So we have two main groups of entities in the financial markets, and they are called retail and institutional. Retail and institutional. Institutions control the market, and their sole purpose is to trade against retail traders. That's their whole purpose. In order for, you always hear someone's winning, someone's losing, or in a casino, right? The house always wins. We've all heard that before. AKA the house is the institutions. They're the ones who are always going to win. They have the money. They can take millions of dollars of losses, billions of dollars of losses. Some of us will crap ourselves if we see $10 losing. We do not move the market. So we need to first understand, no matter what trading style you've traded before, if you have ever lost, you need to understand why you've lost. And you are losing because the institutions are causing you to lose, whether it be analytically or psychologically. In both realms, they're causing you to lose, using your money and your emotions against you. Hence, the markets are risky. We've all heard the markets are risky, but why are they risky? It's not because they're random. It's because they're literally trying to make you lose to put money back into their pockets, or to cause the whole market exchange and all your money's going back into the marketplace to then take price wherever. That's the specific reason that you've lost in the past and you will lose in the future. It's because they want you to see something that's actually not going to happen. And that's the main difference. So now let's dive into it a little bit more, right? We want to understand more specifically retail and institution. So we need to first understand that it's a problem solution scenario. What we have for the problem is retail trading. Retail trading is dumb money. We are dumb money, right? This is the problem. This is what we need to fix, right? How do we become successful in the markets, right? Well, we first, at the very fundamental level, we need to understand we are not the ones that control the markets, right? Me, Cecilia, Anyone else, we are not going to be moving the markets. Doesn't matter. Now we are participating in the exchange, but we will never have the capital to move it. So with that being said, we are the spectators. We are just trying to get a little piece of the pie, or as for those who are in the summit, in the Forex Summit, this convention, we're just trying to take some water out of the ocean. And no matter how much water you take out, it's really, unless it's the whole ocean, even if you take it out of a lake, it's not going to be enough. So we are the spectators. So what we need to do is we first need to understand we are just trying to make some money, right? We do not control the markets. Additionally, is that we are the populous majority. So what do I mean by this? Well, we are in numbers. There are over 10, 15, 20 million Forex traders alone in the markets. There are a ton of traders, but there aren't 20 million hedge funds, right? Like there are not 20 million hedge funds in the world. So when it comes to numbers, there are a lot more of us compared to institutions and hedge funds. However, we are the fiscal minority. So even though there's more numbers of us, all the money that the 15, 20 million plus of us can combine, again, it can be a lot more than that, but at the base level, all the money that we have either lost together or we want to invest, that's not going to compare to the thousands of institutions that have hundreds of millions and billions of dollars. One institution, for instance, can make up for 5 to 10 million, or, not 5, but maybe a few 100,000 or a million traders, right? Because they have the capital. So even though in numbers we're large, with money, we don't have a lot. So with that being said, we are a market participant. We are actively participating in the market by trading on a daily basis. But we virtually have no influence on price movement, because the money that we're actually participating, or the money that we're contributing to the marketplace, is very, very, very little. And it actually accounts for less than 15% of the total daily volume. So if we had to think about it in terms of a pie chart, or just, let's say, a graph, if we have our little chart right here, we need to understand that where's our little subsection? How much are we actually taking from this whole pie? Well, this little sliver is about all that we're taking right here. This is all of us, right? This is all right here. We are all the dumb money. This is how much we are participating in the whole market, a very small amount. Now, on the contrary, well, questions, what's left with the remaining pie? Who has the remaining money in the market? Who's actually controlling it? Well, the ones who are controlling it are the solution, right? It's going to be the solution, the smart money. So this is the problem. And if we want to know, first of all, how to win, at the most basic level, we need to understand that we should not be looking at what other retail traders are doing, AKA support, resistance, indicators, trend lines. Every retail trader, dumb money trader who's doing that, some might be successful, some might not be successful, and 95+% are not successful. And why is that? Well, you're literally trading strategies that have no direct correlation on market operations. People have made up support resistance. Oh, I see, maybe I see, some form of rejection. Oh, well, what does a human think? It makes sense to sell here. But what you guys are gonna be learning about is your human logic and institutional logic, totally different. This is what makes sense to us, but that is not how the market works at all. So that is what's dumb money. This is their ideology. This is their trading strategies that don't move the market. On the contrary, smart money, like we talked about, all those banks, institutions, hedge funds, those with hundreds of millions and billions of dollars. If you have a hedge fund, maybe you say have $100 million, you're considered a small hedge fund. Large hedge funds need to have billions of dollars, 1, 2 billion, over $10 billion of assets, liquidity, and capital. Those are the ones who are moving the markets. So smart money, these are the market makers, right? We've all heard of, the market makers or the manipulation. Yeah, these are the guys that do that. So they're the market makers. And why is that? Well, they're controlling all market operations. They literally have the upper hand in every scenario, right? It's, if we had to think about ratios, it's like 7 to 1, 6 to 1, 7 to 1 of 8 guys over here versus 1 guy here. Which one do you think is going to win majority of the time? The 8 guys, 1 guy in the fight. Ferdy, if you can mute your mic, bro, thanks. It's like 8 guys versus 1 guy in a fight. So of course these guys are going to win all the time. You're going to get trampled. So with that being said, they're the populist minority. In numbers, there are less institutions or hedge funds compared to the millions of traders out there. However, they're the fiscal majority, right? So they account for all the transactions on a daily basis for the volume. So now the question is, guys, what do we do? If this is where we want to be, right? If this is where we want to be, well, how do we get here? What do we have to do? In order for us to trade like them, or in order for us to make the money that they're making, or at least be right and not wrong, what do we have to do? Well, we have to learn what they're doing, because clearly this isn't working. So why are we focusing, or why have we focused on the past, all these different retail strategies, when all of them just fail, when all of them fail? How many times have you looked up, oh, well, I need to find the next big thing, or maybe you've spent hours of back testing. Oh, this looks perfect. Oh, this indicator looks great. And oh, this looks perfect. I found the holy grail. But then in the moment you see the same scenario and you're like, WTF, it's not working. The indicators are lagging. I haven't had that crossover yet. Doesn't matter. Everything manipulates, even indicators at all. So in order for us to get here, what do we have to do? We have to remain objective and holistic. And we need to understand that the big guys trade against the weak guys, AKA us. We are never, ever going to win unless we know how to fight like the big guys. So in order for us to fight like the big guys, or AKA make money like the big guys, we have to imitate their trading style and what they're doing. So that's what we need to be doing. All right. So how do we do this? That's the question. So what do we do? Well, we need to be trading smart money. We need, at the very basic level, again, you guys will be unlearning all this like they do, but we need to trade smart money in order for us to get to where we want to be or do what everyone is doing right. We have to first understand what everybody is doing wrong. We have to, at the very, all the discovery calls I have with you guys, we need to understand first why everyone else is losing so we know how to win. And I have posed this question to all of you guys at some point, right? Let's say I give all of you guys a random test with 100 answers on it, right? Or 100 questions. What are the chances, right? And let's say I give it to all of you guys. There is literally, you guys, of course, are going to get some answers right sometimes, but do you think the overall success rate of that test you're going to be taking is going to be 100%? No, of course, you're not going to get 100%. You might only maybe get 10%, 15% because you're just filling in questions randomly, a random bubble sheet without even knowing the answers. Guess what? Everyone else is going to be doing the same thing. They're going to be getting some answers wrong that you might get wrong, or the same ones oftentimes. So now we need to understand from a very objective point of view is, well, how do we know what all the right answers are? Well, first of all, in order to know all the right answers, we must know why everyone is getting the wrong answers. Directly correlating to trading. In order for us to know how to win, we need to know where everybody is losing. And that's where we're going to start switching that mechanical mindset to institutional trading and understanding how it's working on every single day on a daily basis. So trading smart money, this is the short-term solution, right? So why do we trade smart money? 95% plus of our trades will always have a 1 to 4 pip stop loss max. Now, depending on your tolerance, for me, students know, I personally won't take a trade if it's more than 3 pip stop loss. Now there's different scenarios depending on different protocols we use, but your risk reward should always be very high, right? So almost immediately, how many times you guys entered a position and you enter and you're like, oh, well, shoot, it's about to hit my stop loss. I want to move it just a little higher. And you just play a game of moving higher, 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 moving lower, moving it higher. Do not do that. When you understand how we trade, our margin of error is so freaking small, you'll almost immediately know if you are right or wrong. And that's the whole purpose of the markets. How many times have you guys seen a huge wick? Maybe you guys have gotten stopped out and you see a huge wick, you get taken out, and then it goes in the direction you wanted. How many of you guys have done that? Probably all of us at some point, right? So what we need to understand is, well, why is that happening? Why do I always get stopped out before the main move happens? Well, it's because they manipulate price and stop out retail traders before the real move happens. And this is what we need to understand at the very basic level of what's going to be happening. They manipulate price and stop out retail traders. Additionally, is when we're trading smart money, what the next most important thing, high risk reward. So risk reward ratios, right? That is something very, very important in trading. The two most important things are going to be your win rate and your risk reward ratio. What we specifically have is we have both high win rate and high risk reward. But specifically, when you ask a retail trader what's your ROI or what's your risk reward per trade, typically you'll think of, maybe a 1 to 2, a 1 to 3, maybe if I'm a genius, a 1 to 4, meaning if you have a 1 to 4, right? Risk reward ratio, that means for every 1% that you're risking, you should be ideally making 4 times, or if you risk 1%, you should be gaining, right, 4%. If you risk 1%, you should be gaining 4%. A lot of retail traders think that's phenomenal. I'm here to tell you, at a minimum, at least the trades I take, risk reward are going to be 1 to 9, 1 to 10 at a minimum. People are like, oh, that's crazy. How do you do that? You'll see a lot of our students have 20s, 1 to 30s, 40s, 50s, 100s. On a multiple daily, weekly basis. These trading opportunities are everywhere. So now let's say I asked you, maybe you had $10,000, right? Maybe you had even $1,000, maybe even $100. If you had $1,000, right? And maybe you wanted to risk 1%, right? Maybe you risk 1%. Well, that's $10, right? Well, if you risk $10 and we have a minimum of a 1 to 10 risk reward ratio, well, that means that you're going to be making how much? You're going to be making $100, right? You're going to be making 10% at the minimum. Now, if you hear someone about long-term investing in your trading or even hedge funds their goal is to be getting 10%, 15% in a year. And that's pushing it, right? We do that in a trade. And that's what separates us from dumb money or retail and what we're doing now getting to institutional level. Per trade, we are literally making we're making at a minimum percentage-wise what hedge funds are doing in a year. And when we combine plans and numbers, high risk reward and having a high win rate is what's going to take us astronomical. So now, for instance, maybe let's say you want it to be dumb. I mean, just a little side note. Let's say you got $1,000 again, and maybe I want to risk 5% in this trade, and I want to get lucky, whatever. Maybe risk $50. Okay, whatever, fine. When this is a different option scenario, but let's say now maybe you get a 1 to 20, which these happen on a daily basis. You have now done what? You've doubled your account, risking 5%. The whole goal is minimize your risk and amplify your reward. And that's what's going to happen on a daily basis. And that's what we showed the students, a few weeks ago, turning $100 into $12,700 in 4 days live with the students. I did that live, showing it doesn't matter what you start with. When you have a plan to get to where you want to be and the approach to get there, it's limitless. So that's the second most important thing. Now, the third most, of course, is what? Trading like the banks. Why we trade smart money? So we can trade like the banks. Now, of course, a little preemptive side note is you will be learning this. This is not how the banks trade, but from a basic smart money approach is that we need to understand is the banks are the one who are controlling the markets, right? They're controlling majority of the liquidity in the markets, and being able to identify how they trade will enable us to learn why all retail traders lose. Again, no one wants to lose. We know that, right? You're going to do everything you can to prevent a loss. But what if you know how to exploit your weakness? You then know how to make it a strength. If you can know what you do bad and you can work on it, you can then turn that weakness into a strength. And trading is no different. Trading teaches you so much about yourself, your mindset, your psychological makeup, and anything you struggle with trading, you're going to have a direct correlation or direct problem with that in life. So the last and most important thing I'm going to say about why trade smart money is the logic. 100% the logic. Nothing is random in the markets. Absolutely nothing. Let me rephrase that. Nothing is random in the markets. Everything, everywhere, has a purpose, has a reason, has an intention. Let's say, maybe news is coming out or someone's getting impeached or someone's getting, a CEO is fired or whatever. Nothing is random. There's always a catalyst for anything in the market. Well, it doesn't have to be an economic catalyst. It can be a technical one where we just see on the charts and we know what will happen. For instance, US 30, GU, we literally, and students know this since January, we've been anticipating GU reaching all-time lows. Perfect analysis. We had that plan out months ago, still in shorts. I mean, it's just been absolutely tanking. And guess what? We know the reason behind it. So we know what's going to happen before it even gets there. You will soon be able to learn all the reasons, purposes, and logic behind every move in all financial markets. And that's what's going to take you to the next level. When you understand everything, you can then have anything. All right. All right. So give you guys another second. All right, let's continue. All right, everybody. So now we're going finally into some good stuff. So intro to structure 101, escaping the matrix and becoming limitless. Structure is king. Of course, most of us have probably heard this term at some point. Structure is king. Well, today it is. Today it's king, but tomorrow the king is going to die. And guess what? The queen is going to take over. So that is very important to know. Everything you learned today, it's not like, oh, I'm just going to forget everything. No, you need to know everything today because it's going to directly go into everything else to come. So structure is king. As for now, let's see what the king has to say. All right. So structure 101, understanding, guys and girls, the two types of structure in the market is pivotal. We need to understand the two types of basic structure are we have continuations and reversals. Continuation and reversal structure. And structure is the key is the foundation that all trades rely on. Structure is the first thing you always need to understand prior to even looking at the charts from this SMC approach per se, right? So day one is all SMC. Continuations, reversals. We need to understand that the markets are either going higher or lower. We know they're going to be either going up or they're going to be going down. And even before going to the strategy portion of it, we need you to understand that if no matter what trading style you're using, no matter if you're using, doesn't matter, even what we're teaching. If you are on the wrong side of the market, everything else analytically is bound to fail, right? So if I were to, for example, if I were to say, oh, sweet, maybe let's say it looks like this, right? But let's say for whatever confirmation you were looking to sell here. Doesn't matter what strategy you're utilizing. If you are going to be selling here, right, and the market just goes up through the roof, there's no way you're going to win that. I mean, it doesn't matter if you have the best strategy in the world or the worst. You're not winning. So understanding the structure is going to be imperative for anything that happens after will happen after you know the structure. Any refinements, any other protocols, you have to first master the structure. So In a bullish market, right? What's bullish and bearish structure, or in options, calls and puts? Well, in a bullish market, a bullish market is an uptrend. It's consisting of higher lows and higher highs, and we always use what are these acronyms? I don't even know. Abbreviations. No, acronyms. We always use abbreviations to illustrate these. So higher highs and higher lows, HL, HH. This is an uptrend. So when we see a trend, and let's say it's doing something like this, right? Well, guess what? We are be having consecutive higher lows and higher highs, and we'll be illustrating this in the next slide with more specificity. So higher lows, higher highs, right? Same thing is bearish. If we are in a bearish trend, right? A bearish trend is going to be consisting of lower highs, LH, and lower lows. So it's going to be generally trending down, and that's how we need to understand it, just at a basic level, right? So higher highs, higher lows, lower highs, lower lows. Bullish is higher, bearish is lower. Now let's refer back to those two types of structure. We have continuation and we have reversal structure. I want you guys to first understand these bullish and bearish do not correlate with continuations and reversals. So don't think, oh, reversal is sell, reversal is sell. Do not think that. Just don't. Bullish and bearish are just the individual trends. Now, the actual structure are the continuations. So 80% of our trades should be continuation trades. What are these? You'll learn in the next slide, just a little overview. Continuation trades, 80% are the trades that we should be taking. Or rule of thumb, generally majority of the trades we want to take should be continuations, okay? So meaning if we're in a buy market, if we're in a bullish market, we don't want to be looking for sells, right? We want to be looking for buys, because trading is all about probabilities. If the probabilities are on your side, all you have to do is risk appropriately to make the money, because the odds are in your favor, right? Well, same thing as with structure. In order for us to be on the right side of the trend or right side of the trade, we need to stay on that right side of the trade, right? If we're buying, take buys. If we're in a bearish market, take sells. So this is classified by a new high or a new low, right? So again, I would definitely mark these points down. Next slide will be referencing them. And in this example, you've heard of the trend is your friend. The trend is your trade with the trend. The trend is your friend. If you're selling, look for sells. If you're buying, look for buys. Don't trade against it. That's what continuation trading is, because the probabilities are in our favor. Now, AKA, this is when you've heard people say, oh, buy the dip, especially in the stock market, right? Well, why is that? Well, what are we generally doing here? Well, we know that we have a high, a higher low, we have a higher high, right? So people say buy the dip. Why do people actually say buy the dip? And that's the only knowledge they have. Well, because we know price has to dip down. We're going to have some dip down, right? But what's the end all be all? What's the end goal? Well, we buy the dip in order for us to go higher, because we believe the market's going to go higher. As far as how far we're going to actual dip down before we reverse, very few people are able to understand that. They just buy low and sell high. Low could be here, low could be here, low could be anywhere in their mind. But that's what they say when buy the dip. So now 80% of our trades should be continuations. And then the remaining 20% needs to be reversals. Now, reversal trades, right? These are the minority of our trades taken. Meaning, let's say we're looking to buy, right? Let's say we're in a long-term buy market. If you take sells, right? This is ideally what you would think. Oh, I want to take some sells, right? I want to take some sells now. But reversal trading becomes very risky, because you're either going to be trying to sell the moon, or trying to catch a falling knife, right? We've all heard of that before. Meaning, if we're going down, let's say we're selling off really rapidly. Continuation traders would be looking to what? They'd be looking right to sell. They're looking to keep selling lower. But reversal traders, what are they going to be doing? They're going to be looking to buy when we're selling. And what's going to happen is the market's going to keep going them down. They're going to keep getting lost all the way. So for that reason, reversal trades should be taken less than continuations. Now, in this case, the trend is your friend until it ends. Now, all trends at one point or another, they're going to come to an end. And reversal traders focus on not the trend continuing, but reversing, right? So if we're in a previous bullish market, well, reversal traders, they don't want to look for buys to go higher. They are literally anticipating that it's just going to randomly sell here and then go all the way lower. That's what they believe is going to happen. So reversal traders, if we're talking from a psychological makeup, they're typically more pessimistic. Reversal traders are more pessimistic. They don't believe in opportunity. They don't believe in what's going to happen. Continuation traders obviously are going to be more optimistic. They're hoping that the trends are going to continue, and they're going to be looking for them. Of course, we have realists as well mixed in there as well. But this is the primary difference between continuation and reversals. You're either going to hope the market keeps continuing in that direction, right? Or you're going to thinking that it's just going to reverse. So we have basic continuation and reversal structure. But now let's dive into the specifics. So continuation structure, AKA the trend is your friend, right? So This is what we refer to as a bullish continuation. So we know that continuation structure trends are consistently going, higher, right? Especially when it comes to bullish or lower. But in a bullish continuation example, as we just mentioned in the previous slide, this is it's consisting of higher lows and higher highs, which forms an uptrend, aka some form of trend line, right? It's going to be forming some form of trend line. So when we're looking at this, we see that down here we have a low, right? We have this little L right here. We have a low, and then we have a high. What we look for, everybody, is when we see a low and we have a high, what's going to be forming structure is higher lows and higher highs. So what we need to do is whenever we see a high, just grab a line and wait for it to be broken, right? So when price is going down, that's fine. But as soon as it breaks this high, what we have to identify is where is the highest low that actually made a new high, right? Because now notice this high is higher than the previous high, correct? So now what do? Well, you have to mark a line and identify the absolute lowest point that created this structure. So now we have a higher low that makes a higher high. So now where becomes the new focus point, right? Where becomes the new range per se? Well, we need to understand a higher low must make a higher high to be valid. And we'll talk about this in an additional second. But higher lows and higher highs are essentially building a current trading range, right? From the previous higher low to the current higher high. So let's say this is where we are right here. This is the previous higher low. This is where we are right here. In order for us to go higher than this point, aka in order for us to go higher than this point in the future, what do we need? Well, we know price is going to come down a little bit, but it has to make a new low, right? This is a low, but it's higher than the previous low. So we have a higher low and a higher high. Is this high broken? Yes, it's broken, right? And where's the high that went above this high? Well, it's right here. And then we need to ask ourselves, what is the low that was responsible for making this high? Well, we see this is the low that caused this high to be broken, and it went higher. So we now have a solidified higher high. And what this is telling us is this is providing our trading range, meaning we know we're going higher here. So in theory, if we're going to be looking to buy, where are we going to be looking to buy from a range point of view? Well, if we have a higher low and we have a higher high, we look for buy continuations from the previous higher low and the current higher high. If this is where we are right now, mark a line from the previous higher low and the current higher high, and we are going to be expecting price to make some form of gradual retracement, right? In order to then do what? To go higher. So that's essentially what it is. I know this is very basic in review for some people. Others might be brand new, but we're going to go effectively as possible. So this is a pro tip, and definitely mark this down, because a lot of individuals have some issues when it comes to identifying structure. But this is definitely something to refer to when you're illustrating it. So the first thing that you need to understand is if you don't know how to mark the chart, first just draw a trend line, any which direction, it doesn't matter. So what you need to do is draw a trend line and connect the higher lows to verify an uptrend. Let's say you see this, right? What do? Just draw a trend line. It doesn't have to be perfect. It's not related to trend lines or anything, but we know that we're generally trending higher, right? It doesn't matter. So now what we want to do is, after we identify the trend line, we need to make our structure follow the bullish pattern. And what is the bullish pattern? Well, it's this, right? It needs, after we identify where we're trending, we need to make it look like this. We have to, because this is essentially telling us the narrative. We're going higher. But what's more important than that is this is a higher low that makes a higher high. So if everyone can tell me, if this is where we are right now, where are we going to be expecting to buy from? Before we go higher than this point, what are we going to be expecting from structure? And anyone can talk. Chat.
Russell.
Let's see. Yes, right. So we need to have some form of pullback. We need to have some form of pullback within that trading range in order for us to go higher. Yes, sir, Richard, you got it, right? So we need to have some form of pullback, right, in order to go higher. So we are only going to be focusing on buys within that current trading range from the higher low to the higher high, right? So at the most basic level, this is even if you think you know structure, I would definitely reference this, because there's some tricks that you might struggle with. So let's see here. All right. So bullish continuation structure. Of our bullish continuation, what does this look like? And as pertains, remember that pro tip I just said? Well, let's reference this. Bullish continuation structure. Let's look at this, right? So where are we generally trending? Well, if we grab a trend line, well, we can generally see that we're trending higher, right? We know that we're going higher. Now that after we see we're going higher, we want to make the structure look like what? We want to make it look like this, correct? We have to make it look like this. This is telling us our narrative. So when we're identifying the structural points, what we need to do is we need to see some form of expansion, aka some form of expansive move. Then, of course, we need to find some form of pullback before a new expansive move is made. So let's start from the left to the right. We see that we have some form of low, right? Well, we then, after we see some form of low, we see that we had some form of expansive move, and what would make sense is now guess what? We have a new high. So now after we have a low and we have a new high, we always need to do what? We need to then drag a line. So then we know where to mark the next structure. Once price, we know that price will then, of course, have some form of gradual retracement within our range in order to, right, go higher. So we know this, that our high was broken, and now we have a higher high. We have a higher high. Well, now what was the low that was responsible for making this high? Well, we see this is the low that had some form of pullback into the range to make a new high. So this becomes our new structure. Now, where's the next range, right? Where's the next range? Well, the next range is going to be, now we mark a new high. Where is it broken? Well, the new high is broken right here. So initially, you would be marking something like this. Oh, I had a new low. Great. And that was broken here. I have a new high structurally. Awesome. And then you would see this. Okay, well, where's my new range? From here to here, right? Makes sense. We're all following so far. And then you'd be like, all right, well, where's this high broken? Oh, it's broken over here. Now I have a new higher low. I have a new higher high. Awesome, awesome. But then what do we see? Do you guys see now how the pattern has been disrupted? This higher low, right? When we're looking to buy, we need to make it look like this, right? Does this right here, does this look like this? Higher low. No, this does not follow what we need to do. So what do? Well, we must make it look like this. So how can we fix this and to make it look like that? Well, clearly we know that this is going to be the wrong structural point to identify, which you guys will be learning about come on day 2 or in day 3. But specifically when we're looking at this, right, this is not the right structure. How can we make this whole scenario look like this? Well, let's delete this. Let's backtrack it a little bit. If we know that this low is broken, we don't want to view this as a structural low, correct? So what we rather need to do is we need to focus on the next previous low. So this low over here, yes, it made a high, but notice if we now make this low responsible for making that overall high, doesn't now this kind of fix the pattern that we're looking at? Now we have a higher low, a higher high. Now we have a higher low. Might be a little confusing at first. Don't worry, we're going to go through this. But now guess what? This follows the structure. We have a higher low. We have a higher high because this high right here is higher than this high, right? So now what do we expect? Well, now we need to wait for this high to be broken here. Well, it's broken right over here. And where's the structural point that stopped it? Well, it's right here. So now we have a higher low and a higher high. So now guess what? Our new bullish range is going to be from this low to this high. And what are we expecting? We're expecting price to do the same thing, to come down into our range and then inevitably do what? To go higher. That's what we believe. So by getting the right structure, we can be on the right side of the market. And this is our bullish continuation structure. 1 second, everyone. Take just 20 seconds. I'm just trying to do this real quick. Trying to clear this off for y'all real quick. All right. Sweet. All right, guys and girls. So now that we understand what a bullish continuation is, now we need to understand what a bearish continuation is, right? So now when we're looking at our bearish continuation, it's the same thing as our buys. So a bearish continuation is consistent of lower highs and lower lows forming a downtrend. Basic stuff, we know this, but let's, again, look at it quickly. What's going to tell us that we're selling? If we can draw generally a trend line, we know that it's going down, right? That's the first thing. Now what we want to do is we want to make our sell-off or a downtrend, our bearish sells look like a continuation pattern. And these are the continuation patterns, right? This is the trending phase. So you should ideally only be looking for sells in this scenario. So a lower high must make a lower low to be considered valid. So what do we mean by this? Well, a lower high must make a new low, right? That is lower than the previous low to be considered valid. So we have a lower high and a lower low. So beautiful. Where's the new range? It's from this high to where? To now this low. Now, where's this lower low broken? It's broken over here. Where's the lower high that's responsible for making it? It's right here. So now guess what? We have that pullback into our sell range and price goes lower. Where's our new range? From a lower high to a lower low. This is a solidified lower high because it did make a new lower low. So now we would look for what? Lower high, lower low, price to ideally come back into our range and then to be going lower. Again, we're not talking about liquidity or anything yet. Of course, this is all going to change, but this is what a bearish market is, right? So only look for sell continuations in the trading range from the previous lower high to the current lower low. Now, something I want to ask you guys is if we have this right here, is this a lower high? I want everyone to say yes, no, unmute your mics.
Not yet.
Not yet, because it hasn't made a lower low yet.
Yep, not yet. It has to make a
Okay.
lower low.
Sweet, right? Good. Awesome. I want to know that. Good, right? So this is not a lower high. Why is that not a lower high? Because as you guys have all said, it has not made a lower low. And this is something that a lot of people, a lot of traders will do. If they see this, they're going to be like, oh, or what if I ask you guys this? Is this a lower high? Is it a lower?
It's a failed lower high.
Okay, good, right? I want to make sure. A lot of people, what they're going to say is, oh, well, this is a lower high because it is lower than this high. Well, yes, of course, it is lower, but it's not solidified because it has not made a lower low, right? So what can oftentimes happen is if we're focusing on range perspectives, we can see this. We have a lower high and a lower low. Price can do something like this. It can come down here. It can then go higher. Guess what? Our sell range is still intact, and it can still be selling lower, right? Lower high, lower low. Our range was never broken. So we're still focusing on this. Any of this you'll be learning about. But guess what? Lower high, lower low, lower high, because where was the low broken? It was broken right here. And this was the most extreme point, right? That caused price to go lower. So that's obviously it's never going to be this clean ever, but it's all about logic. If you can make the logic make sense, everything else to follow is going to be seamless. So again, always make sure to have these pro tips down. Very crucial. All right. So our bearish continuation structure. Let's look at this again. Bearish continuation. We have our high, right? Always start from the left to the right. You cannot just pick a random place. You have to make it make sense. We are the detectives, right? In order for us to solve the mystery, we have to make sense of all the evidence that we have. The charts are no different. The charts are all the evidence in front of us. We have to solve the future. We have to prevent the future crime from happening by solving a previous mystery. In order for us to know what's going to happen or what the next murder is going to be, right? The next conglomerate of people, the institutions are going to blow their accounts. We need to figure out where they're going to do it before they do it. Trading is no different. We have our high, right? And we have a low right off the bat. So where is that current range that we have? It's going to be from this high to where? To this low, right? So now what happens? Well, this low is broken, right? And this low is broken over here. And where is that low that price stopped at? Well, it stopped here, correct? So now we ask ourselves, what is the extreme lower high, aka the absolute lower high that made a new low? Well, it's right here. This is that absolute point here that caused this low to break. So now we have a lower high because this high is lower than this high, but it's solidified because it made a new low. Then we have a lower low. Where does the new range become? From the lower high to the lower low. So now what do we expect? Of course, we expect price to have some form of pullback into the range. And the overall goal is for us to do what? Making a new low. Guess what? We made a new low. So where is the lower high that made this low? Well, it's right here, right? Because this is our new range. The range was then broken. This is that extreme lower high that made it. So now we have this. Where's our new range? From this lower high, right, to now this lower low. Price has some form of pullback. Just, again, respecting our range. And then what are we anticipating from here? Of course, a pullback to then do what? Make a lower low. So now we have our lower high because it made a lower low. So then we have our lower low over here, right? Where's the new range? Lower high, lower low. So then what are we expecting? Price to have a pullback into our range. Again, pulls back into our sell range in order to do what? To make a new low. Where's the lower high? Well, this is the lower low over here at this point in time. Where's the absolute point? Has to come back here before going lower. So if you understand this basic structure at a minimum, you'll be on the right side of the market. And this is our bearish continuation structure. Again, make a trend line. Once you understand where it's trending, make it look like this. You must make it look like this. If it looks something like this, and let's say you're marking all these individual structures, is this telling you anything? No. You need to make this look like this. And how do you make this that makes no sense, make it into look like this? Draw a trend line. After you draw your trend line, what do? Identify what we know. A low is broken here, a low is broken here. This is the high that caused a new low to be broken. This is our new low. And this is the high that caused a new low to be broken, right? So now what does it look like? It looks exactly like our pattern. Our goal is to make sense of essentially nothing and make it make something. So low, lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low. Same thing. So this is our bearish continuation structure. All right, now enough with our basic stuff, right? Now I'm going to ask you guys. You guys try. So I want everyone on your screen to take out your little annotation. Conka, if you can mute yourself, please. I want you guys to now try it. So understanding the two things that we said, right? Don't draw a trend line. I don't want you guys to draw a trend line, but everyone go ahead and take your cursors, and I want you guys to illustrate with lines or circles the lower highs, lower lows. Everyone go ahead and do it. You guys have 15 seconds. Go for it. And don't follow the leader. Please do not follow the leader. Do what you think makes sense. Make it make sense to you.
Hey, maybe I'm new to this. How did you get the annotations to draw up on the whiteboard? What do you click?
Can one of y'all? I have a different setup.
It says view options at the top of the screen. When you hit that, it should say annotate. You see it?
Yep. Thank you so much.
Yeah, no worries, bro.
I'll give y'all a few more seconds to go through it. And I'm actually going to go ahead and clear just so we can have our last few people make sense of it. Have you guys? All right, everybody. So yeah, let's go through this. You know, we do have some we do have a lot of understanding so far, right? So good stuff. Now stop annotating, and I'm going to go through this real quick. So stop annotating. So we're all good. All right, guys. So when we're looking at this, the first thing we always have to do, right, is start from left to right. We can't mark a high without identifying a low that's broken. We can't identify a low without identifying a new low or new high that's broken. So starting from left to right, we clearly see that we have we have some form of high to the left. We have a high over here, right? We have this high. Now, in order for us to mark a low, what do we need to do? Well, we can't just choose any random low. We have to refer to the left, right? So referring to the left, I see that we have some low over here. So what I'm going to do is I'm just going to drag this line right here. So again, let's say we don't know the structure at this point. We have a high. Now, first of all, I saw some people annotating, oh, well, we have a high, we have a low, right? Well, let's think about this. If you annotated this way, you have a low, a lower high. It's broken here. Great. It follows the structure. Lower high. Awesome. Right. It makes a new low. Then you have a lower high, lower low. Awesome. But what happens here? Doesn't that break the pattern? That breaks the pattern, right? So what we need to do is we need to make the pattern look like this at all times. And what I'm trying to say is all this has already happened. And we need to make this make sense for us. If you need to draw a trend line, fine, go for it. Just to see what the trend is. After you identify what it looks like, we always need to make it look like this. And it won't always make sense. But if you can make it look like this with lower lows and lower highs, that's what you need. So now let's go ahead and let's take a couple steps back. So now notice how that was broken, right? What low are we going to choose? Well, it was broken here. So what we need to do is take it back a step. We now have what? We have a lower high. And if we're not going to be choosing all of this in between here, we are going to be focusing on the most relevant one, which is this low, right? Because notice what happens. Now we have a lower high, we have a high, we have a low. Now what do we do in the future? Well, we can't just mark a lower high, right? You don't just want to mark this or mark this. We need to make it most efficient just to draw a line. Is the lower low broken? Yes. Where's the absolute high that caused the low to be broken? Well, we know that we had some retracement back into the range and pull back right here. So where's that absolute low, lower high? It's right here, right? This is the highest point of retracement before going lower. So now we have our lower high, and where's our lower low? Well, it's the low after it was broken, right? So it's right here. So now our new trading range becomes from this lower high to this lower low, right? Because notice a lot of people, what they're going to do in their first starting structure is they'll do something that looks like this. This is not telling us anything. If the structure isn't telling you anything, you're marking it wrong. That's instantly. If you don't know if you're buying or selling, you've marked the structure wrong. So rather than thinking this, it has to have sense, be logical. That doesn't tell us anything. But what does this tell us? Well, now we have a new range that we're going to sell from, right? So now we have what? A new lower high over here and a new lower low. And what are we going to be looking to do? We look to sell after that retracement to go lower, right? So now let's approach it like this. Yes, we had this low broken here, but guess what? If you did something that looks like this, what ends up happening? Does this follow that pattern anymore, everybody? Does this pattern right here follow this? Yes or no? No, right? So that's not going to be right. So how can we make the pattern look correct? Well, by doing exactly what we did. If we know that this isn't the right pattern or the right view, how can we make it look and make sense? Well, we know that if we have our correct structural points from a lower high and a lower low over here, how can we make this make sense? Well, we have a lower high, a lower low. So now guess what? What are we looking for? We're looking for some form of pullback in order for us to do what? To go lower. Now, guess what? The wrong pattern is actually right. You know, instead of marking this lower high, this lower low, just fix it. This is the main lower high that made the main lower low. So what are we expecting? Still sells. We know we're going to have some form of pullback, right? But what's the end goal is for us to be looking for sells down to where? To make new lows. Where's the absolute high within this pullback that caused a new low? It's right here. So now what do we have? We have our lower high. And where's our lower low? It's right here, right? So of course we have our new low, lower high, lower low. And what ends up happening, price does what? It pulls back into a little bit of the range and then just absolutely sells off. And then where's that new structure? We now have a new lower high and then lower low down here. So understanding structure alone, that's how you're going to be winning all of, or being on the right side of the market all the time. You're not going to be focusing all on this individual BS, because if you're just marking all the individual highs and lows, it's not telling you a narrative. You have to be able to understand the narrative. So marking the right structure is pivotal for understanding the narrative of what's going on. So, all right, that should all make sense to everybody. It will take practice when you're first doing structure, but you will get the hang of it like it's nothing, be able to see it before you can even mark it out. All right, so now I want to ask y'all this. Identify the structure of this trend. Everyone, you guys have 30 seconds. So go ahead and do those two things that I mentioned, right? Identify the trend and then identify the structure. Because I mean, it's not always gonna be easy. You gotta make it tricky. You guys see how some of y'all, I'll say in a minute, but you guys will be like, wait a minute. All right, this is becoming a cluster. I'm gonna give you guys 20 more seconds and that's it. You don't start over, but whoever hasn't gone, do it. Whoever maybe got it wrong or want to try again. And if you were right, don't do it. If you think you're right, don't do it. Oh God, I close my eyes for 1 second, it goes right back. All right, so yes, let's look at this, everyone. Good job. All right, so now let's look at this. So, okay, Antoine, there you go, bro. So some of you guys at first were a little tricked, right? And this has been the best approach that I can, this is how I was able, I think it's the easiest way for me to teach it. What are we doing? Well, trend line, again, we don't care about trend lines. We're just trying to see the trend. We're generally going higher. So what do we want to make this look like? We want to make it look like our continuation pattern. And what's that continuation pattern? It's higher highs and higher lows, right? So notice right now, an average or normal Joe, they may not know what's going on here. Yes, we're going buyer, but we need to become more sophisticated than that. And even though this is still basic, this will, let alone, it'll start to change everything pretty drastically. So before going to the right, picking random points, we need to start from the left. Look at the left. Yes, we have something going on over here. So what I'm going to do is I'm just going to see it for what it is. We have some form of low here, right? Why am I not choosing this? Because this is just not relevant right now. We have some form of low, and immediately the first high I see is right here. This is immediately that first thing that sticks out like a sore thumb is right here. And I know we're going higher. So how do we make it look like this exactly? Well, at first you might think, well, let me just mark these individual trends. High, low, lower high, lower low. Okay, well, am I going down or am I going up? Then you're like, oh, well, what's next? Okay, well, now I have a high here, high, low. Oh, well, am I looking for sells or buys? Oh, shoot, I'm looking for buys again, right? I'm looking for buys. But then you might do this. Like this isn't telling you anything. This is literally, you're drawing what it's already showing you. This doesn't make any sense, right? Because you're not going to be understanding. So don't do that. Focus on the main picture. Where are we going? We're going higher. We need to make it look like this. How can we make it look like this? Choose the lows that make, right, higher highs. So let's take a couple steps back. All right, this is where we are. We have a high here. This is the high here. What do we want to see? We want to have some form of low that'll make a new high. Where's the low? We have some form of low here. And are we going to be marking this high?
Yeah.
No, right? Because this high is not higher than here. For us to choose a higher low, it needs to make a higher high. So we have this. We have a high, we have a low. Where's the new higher high? It's right here, right? Again, had you done something like this, had you chosen this? Oh, here's a low, high, low, high, low, high, low. Does this follow this pattern? No. So don't mark it, right? How do we make this look like that? Whoop. That's all you do. And what do we expect? Some form of pullback into our range. So we know prices will have to have some form of pullback in order to do what? To go higher. So now all we need to identify is where's the next high made? It's made over here. Where is the low that made the new high? It's right here. So this becomes our new higher low because this low is higher than this low that made a new high. So now our new range becomes from this low to this high. And this is what we're looking at now. What do we expect? We expect price to have a gradual retracement back into our range, right? Before then going higher. It goes higher here. Where's the new structure? From this low here to the new high. So where are we in the future? If we're looking for buys, are we gonna look to buy anywhere down here? Yes or no? No, right? Why? Because it's not within our valid trading range. It's not, if it goes down here, it doesn't follow our narrative. So we're not gonna be looking for buys there. Think we're all clear, all good on this?
Yes, sir.
All right, good stuff, everybody. I believe a couple. All right, so yeah, so what we're gonna do is we're gonna take a quick 5-minute break. We had the intro stuff. Now we need to pick it up. Now we need to pick up the pace. So it's already 12:30 my time. So yeah, brother, yeah, guys. So go ahead, take a 5-minute break, and we'll get right back to it. And then the break it's gonna end at 12:30 EST. So 5.5 minutes from now.
That sounds good.
All right, you guys go take a break now. Leave your monitors, leave your screens, do whatever. I'll be back in 5 minutes sharp.
Getting your camera set up, just let me know.
Yep, I definitely need help.
Okay, so when you're looking at your screen and you see down in the lower left corner under Start Video, there's a little overflow menu. It's a little arrow up. Why don't you go ahead and click that?
Yep.
What are the options that it's giving you?
OBS virtual camera. That's that logo that you see, and then it says FaceTime HD camera.
Okay, go ahead and select that FaceTime HD camera.
Okay.
Beautiful.
What do you see?
I see you.
Oh, I can't see me. Okay, so problem solved, right?
Problem solved.
All right. I knew it was something simple. I just didn't. Well, I didn't get that arrow either. But so yeah. Okay.
No worries.
Appreciate
Enjoy your
it.
break.
All right, everybody, please go ahead and return back to your seats. We're gonna go ahead and pick right back up. So if you hear this, go ahead and turn on your cameras, silence your mics, see all of your beautiful faces, and let's pick back up. All right, everybody. Let's go ahead and get started. All right, Admin, are we ready to go? Is everyone back? Everyone good? Ready to go? All right. All right, guys. Well, yeah, please return to your screens. Make sure that you turn on your cameras, please. We're gonna go ahead and resume now. So the admin team will be watching all of you guys. So please, if you're hearing this, come back to the screen, turn on your cameras. Time to pick up the pace. We're holding on over some intro structure. So let's wake up, get the juices flowing, because now we're going to start becoming structural masters per se. Because structure is always the first thing that we need to master prior to denoting anything else about the strategy. All right. So quick break. Now we can resume right back into it. So we just ended off with our continuation structure. Now I'm going to start diving into our reversal structure, right? So we already talked about the two types of structure. We have continuations and we have reversals. But now there's so many types we have to go over. Continuation and reversals are the main types. Then we have subsets, and you need to understand both of them prior to getting into it. So in this scenario, this is where we refer to the trend is your friend until it ends. So we always want to be looking for those structural continuations. However, when let's say we've been going up for so long and we know that the trend is going to reverse, this is the scenario that we would start to approach purely when it comes from a structural point of view. Now, those who use change of character, break a structure, Yes, I know ICT is chalk, whatever. Honestly, what you'll know, we don't mark break of structure anymore. We don't do any of that, as you'll be learning why tomorrow. You know, how many times for those who are in structure have asked myself, oh, is this a true break of structure? You look at it and then you get screwed because it's not. That's why structure is almost irrelevant in the future, and the algo trades against us. So prior to going to knowing that though, let's go into it. What's reversal structure? So we have our bullish continuation. Now I'm going to be showing you guys the bullish reversal. So there's several parts of this that make it that come into play when we're analyzing structure. So we're essentially going to be illustrating this in 3 separate segments right now. So the first thing we have is to have a bullish reversal. This is essentially telling us at first, we're going to be having a preceding downtrend. There's going to be something to the left. We're going to have some form of sell-off happening to the left. So that's the first thing that must happen, that we must be seeing. We need to be seeing that quote unquote, that bearish continuation pattern, right? It's going to be a bearish continuation pattern with lower highs and lower lows. But the turning point is going to be right here. So this is the first thing that we are going to be seeing. And the first thing is having preceding downtrend. The second of which, right, if this is first, the second thing is going to be right here. This is our second point, and this is what we call our break of structure. Now, change of character, for those who know it, who don't, I've always used BOS, even when I was with ICT. Change of character, I don't know. Be a break of structure is better for me. And a break of structure is the second thing that is illustrated. And what is a break of structure? Well, a break of structure happens after or when a continuation pattern is broken, right? So a break of structure, when a continuation pattern is broken. So our continuation patterns are higher highs, higher lows, lower highs, lower lows. So in this scenario, what continuation pattern do we have to the left? And you guys can mark continuation pattern here and for diagram purposes. So we'll have your continuation pattern, and this will either be bearish or bullish. Okay. So the first thing is your continuation pattern. Once you understand what type of continuation pattern you have, there's going to be an abrupt change to it. So our continuation pattern is lower highs, lower lows. At this point in time, based off of probabilities, based off of trending, this is our last trading range, right? We have our lower low, a lower high that makes a lower low. So ideally, we're going to be looking for new bearish structure at this point, right? We would expect what to happen? Price to come up into here and go lower. Everyone following so far? Right? We would expect to have a lower high that's going to make a new lower low. But a bullish reversal, this is characterized by a break of structure. So our break of structure happens at the last lower high, when this last lower high makes a lower low, but then this lower high is broken. Notice now that the continuation pattern, right? It's broken. So for this reason, this point is called our break of structure. A break of structure is pretty much a sign of weakness. It's a sign of intent for the market to reverse because it's now not respecting our bearish or our sell structure. So this break of structure now tells us we're going to be looking for not necessarily sells anymore, but we're going to ideally be looking for buys. Now, important to note, a BOS does not guarantee a pullback or reversal, which you guys will be coming to learn tomorrow. But for this instance, this is what we're looking at. So we have our phase 2, we have our phase 1, and what happens now on phase 3 is we have this. On phase 3, we then have a new continuation pattern, right? So this is called our bullish reversal setup because we have a previous bearish pattern. We now have a break of market structure with now a new high, right? That takes out our lower high. This is our new high that takes out a previous lower high. So now based off of this, where does our new trading range become? Well, if we're not looking for sells anymore, and we see a lower high was now taken out by a buy, we're now going to be switching our bias from sells to buys. So where's the new trading range, or where's the new structure per se? Well, it's going to come from now this low to this high because this structure for sells, right? Notice we never made a new lower low, but the lower high was broken. So now what's happened is rather than identifying this as sell structure because it's validated, we're now utilizing this low right here and it made new structure for a high. So what do we expect? We expect price to now have some form of pullback, right? Have some form of pullback to do what? To make a higher high. So now we expect that pullback to happen. Price makes a higher high. Where's the higher low that makes this higher high? Well, it's right here. So now we see the higher high is made. We can now solidify this as our higher low. Now this is our higher high. The same thing. What do we expect? We expect price to have a gradual pullback into our buy range to then go higher. So essentially, this is for those who know order blocks or points of interest, everything we have yet to cover. This is essentially what you're going to see when price comes into one. When price is starting to round off on our lower time frames, this is what the pattern is going to look like. We are going to go from a previous direction to then a new direction. And by being able to accurately understand the structure, we're going to be able to trade. I mean, your consistency of being on the right side of the market is exponentially higher because if your structure is invalidated, it's the wrong bias. All right, I'm gonna give you guys another 30 seconds or so on this. And a side note, this is for a later reference. A BOS or a break of structure is only confirmed if it reacts from a meaningful IFC. And what do I mean by this? We'll talk about it in a little bit, but let's say you just see a break of structure randomly in the market. You cannot guarantee that this is true, meaning this can work, but it will not always work by any means. And there's a specific reason why this will not always work, which we talk about tomorrow. IFC, yes, we're talking about that today, bro. This is stuff that you have not learned yet, but it's definitely useful to all write this for later reference. BOS is only confirmed if it reacts from an IFC. If you see a BOS from an order block that has no relevance, it's not a BOS. Follow each higher time frame trend. We have not talked about any of this yet. I'm just saying for later reference, make sure to write that down. You guys, about 10 more seconds. All right, so this is our bullish, yes, you're right. So this is our bullish reversal scenario. So now let's take a little bit deeper of a look. All right, so the first thing we always do when we're looking at this, and again, there's point to take notes and also to pay attention. So don't by any means draw all of these. Do not right. I want to, as I know, especially when it's note taking, you want to focus more on the notes, but you try to pay attention. So you try to do both, and it's not maximizing efficiency. So for now, if you're trying to take notes, you can mark these 3 steps, that what we just went over, but don't mark or draw any of the charts. Just let's focus. Let's go over this together. All right. So the first thing we always do, right, is we identify in our bullish example, we must identify a previous downtrend with lower highs, lower lows. If we're starting from the left, again, just picking a random point, why did I choose this low? Well, we have something like this, right? We have a low, a high, a higher low, higher high. So what's everyone going to be expecting here? Buys. But what ends up happening, we have a what? A break of structure. A break of structure tells us that the market is going to be changing over, right? So now we have a high that makes a new low. So the new low is right here. Now, I know immediately you guys are like, well, why did he choose this low and not this low? Again, we want to focus on the most relevant move for here. Like if you start doing this, right, this is not going to tell us anything. This is not going to tell us anything. Focus on the actual move of what's happening. So noticeably, this lower high makes this low now, correct? So now we see a new low. Now we see a lower high. Where's the new trading range? From this lower high, correct, to this lower low. So we expect price to do what? Make a new low. Where's the new range from this lower high to this lower low? We wait for price to break this low. And again, in order for us to mark the right structure, we need to see a pullback. So for instance, again, why am I not identifying this point right here? Well, this is too thick. This high is higher than this high. So I'm choosing this as my lower high. Additionally, maybe some of you guys are like, oh, why didn't he mark this lower high, this lower low? In order for us to consider a lower high, we need to have a pullback. Is there any pullback here? No, it's a couple candles. We need to see some serious pullback, right? So for that reason, we now have what? Where's the lower low? Not here. It's not here. There's no pullback. But why would this low be a low? Don't we see we have a pullback after it? So this will become the new low. We have now a lower high, and what? We have our lower low with a meaningful pullback. Where's the new structure? From this lower high here to this lower low. Wait for the low to be broken, and then what do? We then wait for price to break it. Now this is the new lower high. Awesome, right? So now with the diagrams that you guys have, you can kind of start to see how this is making sense. Now, again, this low is broken. We have a lower high. This is the maximum high. And now what do we have? We have a lower low. So at this point in time, we are thinking what? We have our higher high, we have our lower high and our lower low. Before this even happens, we are expecting price to do what? For it to come somewhere up in here and to go lower. Are we not? So this is what we're expecting. However, what do we have? We get, yes, of course, some rejection, but what happens is what? This lower high is broken. So now where do the new structure points become? Again, why are we not marking any of this individual stuff? Well, this isn't telling us anything. This is the last lower high that made a lower low. And we need to understand two things is going to happen. One, price will come into it to go lower. And if that doesn't happen, the only other thing that can happen is the opposite. It'll break it and then go higher. So where's the new structure? Well, it's this high. And why is it this high? Because this is that first point that broke the previous lower high and had some form of pullback. So this now becomes our new high. This is not a lower high anymore. This is not a higher high. This is just a plain high because it's resetting and transitioning into a new trend. So this is, if we think about it, this is our phase one over here. The previous downtrend. This is our phase one right here. Where's phase two? Phase two, the lower high broken for a break of structure. Where's the lower high broken? It's right here. And this is our BOS. This is now phase two right here. Okay. Now phase three, look for the trend shift for buys. Well, now we have a low and I have a high, correct? So now we have a low and a high. What are we going to anticipate? Price to come in between this range right over here, correct? And it's going to have some form of pullback. It pulls back a little bit and does what? Goes higher. So now where's the absolute? This becomes our new structural point. Again, why? Because we have a pretty rapid pullback. Are there any pullbacks in between here? No. 2, 3 candles is not a pullback. Just don't mark it. If it's 1, 2, 3, 4, 5 candles, don't do it. It has to be drastic. So this is the first area we have a pullback. So our new structure comes from this low, right, to now this high. Anything, price can do anything. It can screw around with you all at once in here. It can do anything, but you don't want to get caught up in this. We have to have every move make sense. So when we're looking at this again, how are we going to approach this? Well, only mark the lows, the higher lows that make higher highs. Higher low, yes, it made a higher high. So what are we doing? We are not going to mark anything. We're going to mark anything in here until what happens? We break a new high. And what happens again? Price breaks a high. And then where's the highest high made? It's right here, right? So we now have our new high. Where's the higher low that made this high? Well, it's right here. So now our new trading range, higher low, higher high over here. Now we have a higher low. And where's the higher high? Over there. So now we're going to be looking for buys between this low and now this high. Now, don't think I'm just saying, oh, you're going to be looking for buys anywhere in here. Of course not. You're always going to have specific areas. But now when looking at this, guess what? As long as it can do anything it wants, it can come all in between here, blah, blah, it can mess around. As long as this low does not break, This is a higher low, and we long-term are going to be looking for what? It to make a new high. So same thing, price then makes what? A low, drag is broken here. We have a new high broken. Where's the lowest point after this high was made that it went? This low, new high, drag it. Where's the new high? Over here. Where's the low? Right here. So when we're viewing this from a range perspective, ranges will always be respected. And if you can identify the right range, which is crucial, if you identify the wrong range, you're always going to be losing out. I mean, that's how it is. Like for instance, had you seen a low, a lower high, a lower low, oh, this is a break of structure, guess what? You would have been looking for buys and you're losing. So structure is very important, and it takes practice to know how to properly mark things. But don't worry, we're here for that. It's not going anywhere, and structure is just the beginning of everything. So this is that 3-step scenario that you should be looking for when you're identifying reversal trades. You almost want to think of it as an inverted or regular bell curve, right? You're going to look for this, right? And then for it to go higher. Well, in order for us, if we're going down, right, we need to have some form of round off in order to go higher. And what's happening here? Well, it's just the same thing. We're going to have some form of structure, some form of change of structure. It's to break a structure, not change. And then guess what? It's going to be going higher. This is the same thing. And the market is the exact same way as it looks like that. So in order for us to go higher, it's going to happen on our lower time frames first. All right. So all good on this? Good.
Yes, sir.
Awesome. All right. So now let's review this together again. The first thing, and you guys, I'm going to go through this, and then you guys are having an example. The first thing that we do is what? First thing is identifying our previous downtrend. All right. So let's start from the left. We can't just pick random lows and random highs, right? We need to make them make sense. So what's the first low that we see over here that would make sense? Put a 1 if you would say this low, put a 2 if you would say this low. 1, 2. Where would you start? All right, so we got some mixed conflict, right? Well, here, let's take a look at this. What pattern does this look like here? Does this look like a pattern? We have this low that makes a high, right? Isn't this the pattern? All this in between here, there's nothing in here, right? So 1 would make the most sense. We are going to be looking at 1 because when we're looking at 2 isn't doing anything. Did this make a higher high? No, right? Do we have a previous bearish trend? No. From what we can tell, we had a huge expansion to the upside. So what is this telling us? Well, this is going to be where we're starting because this low made this absolute high. So hopefully that should make sense for y'all. But yeah, so at this moment in time, from the limited knowledge we have, we are going to be looking for just minimal buys. And what's happening is what? Well, we start at 1 and then price, of course, does what? Let's say we have this. What is this first point called here? If this is that structure that we had for buys, what do we call this?
Low high.
Well, this is a high, right? But what happened over here?
BOS.
BOS, right? This was a break of structure, telling us now that we're going to be changing the trend. So now let's see, right? We now have a new low, and this is that high that remains intact, correct? Now we have a new low. So what do? We wait for the low to break, and then we choose the absolute high. Now notice what happened over here. We had a low, we had a few candle pullback. Okay, now remember how I said this isn't a solidified? In this case, I mean, it's pretty clear. We're marking this in the past. So this is what we would choose as now what? Our lower high. Now we have a lower high, right? Why? Because it made a new low. So now we have a lower high. Now we have a lower low, right? So now, same thing. We're going to draw a line to the right. We have now a lower high. Why? Because it did what? Right? It made a lower low. Now in this example, right? Are we going to be doing all this? No, 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 right? So now what we can say, our range, our valid range that we're going to be looking at is going to be this small pullback. And again, none of these are valid pullbacks. Absolutely not. So the low we're going to be choosing is what? It's going to be this lower high, lower low, lower high, just the absolute one, right? So now where's our last trading range? It's from this lower high right here, right? Our lower high here and our lower low here, correct? What happens? The lower low was broken. I want everyone to identify the lower high that made into lower low. Beautiful, right? So now we have our lower high because it made our lower low. Now, structurally, we now have our new structural range, right? From this lower high to now this lower low, correct? So what happened here? Remember that phase one, identify the previous downtrend. We now have our lower high, lower low. Great. But what happened? What, of course, notoriously happens here? We have our break of structure, the phase two. Thank you, Antoine. You saved me from drawing that, right? Now we have phase two. This is what we call the structural shift or that break of structures. Now we see the structural break. Oops, structural break right here. Our break of structure. Now we have a new low, and now everyone, where's the new high that we make? Right, so now we have a new low and a new high. Good stuff. So now we're looking at new bullish structure, and this is that phase two. Remember that break of structure. Now I want everyone to complete the remaining. Let's see what you guys choose now. Go ahead and take 20 seconds and do the rest. Good stuff, everybody. Good stuff. So now notice we went from having something that made very little sense, and now we made it make sense. So based off exactly what you guys are doing, they're all Picassos over here, we should be expecting, right, buys, right? We should be expecting ideally buys from this low over here, right? Because this made a new high, and buys to do what? To go higher. So this is how we need to be approaching it. Awesome stuff. So those are those three phases. You have the downtrend, the trend shift, the new trend. And that's how it's always going to be. So good stuff. I love it. I love it. I love it. All right. Good stuff, everybody. So I'm getting some basic intro to mastery structure in there. Now let's talk about the bearish reversal. So let's go back to some note taking. I wish there was a way for me to figure out. It always says web page taking up memory. It always says that. I wish I could just remove that. I have no idea. But anyways, bearish reversal. Same thing, just inverted. At first, in this scenario, we have a preceding uptrend. So we have preceding higher highs, higher lows, higher highs, higher lows, all the good stuff. So this is what we call our phase one right here. This is our phase one, and that's going to be uptrend, the continuation of the uptrend. So now we have the uptrend here, right? So this is our one, identifying the uptrend. The second thing is what? Well, just like last time, we had sells, right? We had sells coming into, then break a structure, and then to go higher. It's the opposite. We now have buys coming in, but then sells to take over. So higher low, higher high, higher low, higher high. At this point, what would we expect? Price to ideally come back into the range and go higher, but that didn't happen. So it was the new structure that was made. Well, we have this high that now made what? A new low. So now this, again, a break of structure does not guarantee a reversal. It only signifies it. Yes, oftentimes it will happen, but in order for it to be a proper break of structure, this has to react, this high must react from something meaningful, which we have not talked about yet. That's why I keep saying for later reference, how to know if it's a true break of structure versus a false one. So after we have that phase one, the uptrend, two, we have that break of structure. Three is then the new trend, right? We now have a high and then a new low. The low is broken. right here. So of course, what do we expect? Price to then have a lower high here. So low is broken, high makes a new low. It's broken over here. We now have a new lower high, a new lower low. And then of course, wait for this low to be broken. And what are we anticipating? Price to have a retracement into our range to then resume lower. Give you all about a minute or so. Keep saying that. And remember, BOS never, ever, ever guarantees a pullback or a retracement. It does not guarantee it. It signifies it, but never guarantees it. I'm going to give you all another few seconds, clear all my drawings. Mercedes, I don't want you to unmute your mic right now, girl, but you don't got to be on this. You driving, girl. What you crazy? I'm not going to have that on my conscience. You can always join back. You're good.
I have you connected to my car. So
all right. I just want to make sure. All right, guys. So we're going to go ahead and continue. We're going to keep moving forward. So this is now that's why we refer to it as our now, and since bearish reversal come from buys to now sells. All right, so let's go ahead and continue. So now what we're going to be illustrating is exactly what we did before. The first thing, what do? We identify the previous uptrend. So even prior to looking at anything to the left, we need to focus on what's going on to the right, to the left, right? So now when we're looking at this over here, we have, again, what do we start with? Well, the first thing that we see to the left, we clearly see that we have some form of high. So then what do, right? We need to now wait. And again, guys, this is not, yes, this is a higher high, but this is not significant. It doesn't have a pullback. So don't mark it. We now have a high, we have a low. We can tell we're going higher based because the high was broken. Now we have a higher low that makes a higher high. All right, so now we have high, higher low. We now have a higher high because it has a pullback of several candles, right? Now we wait for this high to be broken. After it's broken, great. Where's the higher low? It's going to be right here because this was that lowest point within our small pullback that then makes a higher high. So we have a higher low. We then have a higher high, right? Now guess what? We're still in our trading range. What are we expecting? Great, yay. Pull back to then do what? Go higher. Now, again, this is not a pullback. This is literally 2 candles. That is not a pullback, right? We need to see several candles, 5, 6, 7+ candles. So where do we see as the next noticeable pullback? Well, all right here. So now what do we see? Again, why am I not marking this? Because again, we know it's going up at this point. So does this follow that continuation pattern? No, it does not follow it. So what are we going to do? Make it look like the right one. So rather than getting tricked here, beautiful, back in line, focus on that. Now what's their last structure? We have now this higher low, and now we have this higher high. Again, make it make sense. Don't mark, just make it look like a continuation pattern and you'll get the hang of it so fast. So that's not right, but this is right here. So now ideally, we would be expecting what? Price to come here and go higher. We should all be agreeing with that based off at this moment in time. However, again, what ends up happening is not that. So what do we see? We have an instant break of structure. So we know that that is not right or valid. So now we have a break of structure. What do we do at this point in time? Well, our now phase has now ended. Now we are in the second phase, which is the change in delivery, right? The change of the break of structure. 2, right? So now what are we expecting? Ideally, from diagrams, we're going to be expecting this, right? We have now a new low. We're not looking to buy anymore. So we expect now some form of lower high, lower low, lower high, lower low. This is kind of what we're going to be expecting. So now we just have to wait for prices to show us that and then make it make sense. So for instance, again, we're not just going to choose this random low. We need to have some form of pullback. So I'm deleting this for now, if I can. You don't just want to mark the first structure as soon as it breaks. Don't do that. Just wait so you have confirmation. It makes sense. So let's look, right? We have a low or a high, and then it makes a new low. Now, again, I know instantly what you guys are thinking. Oh, we have this. This is not telling us anything. This is literally not. You're going to see this all over the time. It's not. So what do we down do? Focus on the new reversal structure, okay? So what do we see? Let's have it make sense. Low is broken. We see this is the absolute point, and we need to make it look like that continuation pattern, correct? Well, let's do it. If you did this, again, doesn't follow that sell continuation. So you're going to be wrong. Make it look like the sell continuation. High. Now we have a new low. Draw out the structure. Now we have a lower high because it made what? A new low. And then guess what? Oh, we have a lower high and then a new low. Why did I choose this high? Because it is higher than this high right here, okay? So that's how we should be approaching structure. This makes sense. It'll take practice for those who are new with it, but it is everywhere. Yes, B-Law, you're a beast. I know you've been just destroying it this week. That's a prime setup, as you can see right there. So even here, even everywhere, buy, sells. Anyway, so this is that example of how we're going to be going through it together. Right before I send you guys off to do this yourself. All right, we should all, it should be making sense. I know, again, guys, I'm going to say this again, this should be like a basic review. Now, I know this bootcamp, especially, I have a handful of new types of traders. They've never heard of SMC. So like, again, thank you guys for being patient for those who are more experienced. But regardless, day one, whether it takes a little longer, so be it, because day two should be brand new to everyone. And that's what I'm most excited for. The structure used to be my favorite. Now it's definitely not my favorite thing to teach. So trying to make it as much as possible. Again, always have your questions right next to you so you can write down questions, maybe, how to choose the right structure, this one versus that one. Whatever you have, make sure you write it, and then you can always refer to them and ask. Be organized with your questions, because you're going to, for those especially who are new, you're going to have questions. That's totally, that's anticipated. And I'm going to be giving all of you guys the answers. So we should be good on with this. What I want to do now is let's continue. All right, guys, let's review. Gotta have a foundation right before anything else. You got it, dude. You freaking got it. All right, let's review this together. Do you guys want to, I'm gonna give you guys a chance. Let's see if you guys are possibly ready to do this. So I'm gonna go ahead and give you guys some time to do this. Only don't drag the lines. Don't make it look like the structure. Use lines or circles to identify the highs and the lows. So go ahead and everyone at first, only do the first thing. Only identify the uptrend. Do that for me, please. Only the uptrend, ladies and gentlemen. All right, good stuff, good stuff, good stuff. All right, so this one should be pretty clear. Now, based off of this, I feel like some of you guys are just drawing extra, just to make it look a little bit more creative. Based off of this, we're looking right here. We have, right, yes, of course, here we have a low, we have a high, right? This is not a pullback, it's 3 candles. We have now a new low, and then guess what? We now have a new high. Now this, based off of this time frame, we have a few candle pullback. There's 2 ways to view this. We can view it as, right, this kind of structure right here. Now we have, right, of course, a new high, higher low, higher high. That's one way to view it. And if you view it this way, the only other way you could view it would be what? Would be, oh, maybe this isn't a pullback, right? It's only a couple candles. I'm going to choose this high. Both ways are correct, newsflash. And there's opportunities for you to capitalize on both. So let's say that You identified it the first way. The first way would make it a little bit more confusing for you. But what I want to do is let's just do it this way right here, right? Let's say we have a higher, let's say we have a high, a low, right? And then we have what? A higher high. Let's just say we're looking at it like this. So what happens? Identify the previous uptrend. Great. Now what I want you guys to do is do the second part of it based off of this scenario. So if this is what it looked like, now do the phase 2 and 3. Do the break of structure and the new trend. I remember the rules we have because it could get a little tricky. Little trick. Remember what we were saying? If you see something that looks like this, all right, I'm gonna clear everyone's drawings. Hold on, clear viewers' drawings. All right, so you guys were all great, right? Now there was some that's a little tricky, and do not worry, you're not going to get this instantly. It requires practice. So what we have here is we have our break of structure, right? Oh, great, this is a break of structure. Now I would like to believe all of you weren't following the leader because if the leader fails, everyone else will. But let's look at this. We have now a high and we have a new low, right? Great. You'd be like, oh, well, wait, now we have a gradual retracement. Now we have a lower high. Now we have a lower low. Great. But what happened right here? Notice how it wasn't respected anymore. This is where you now need to switch and make it make sense. We need to not make this look like buys anymore because we know if this break of structure, it's going to be selling off. So we need to make it look like sells. So rather than looking at it like this, we need to retreat and retract our steps a little bit. We need to view it as what? We now have a high that makes not this low, right? Because then you mark it like this. We have a high that makes this low, right? Right here. Because if we follow it like from this perspective, then it becomes like this: high, low, higher high. Now, yes, of course, that's valid, but look, lower low. Still, this is a break of structure, right? Still a break of structure, but we're choosing to focus on a different point. Now, our new range becomes from this lower high to what? This lower low. We expect price to come back, and you'll know exactly why this happened. The reason I'm kind of going over this is because you'll know why this happened, why we don't trade structure. So you'll learn about this, but now we have what? Where's the low broken? It's broken over here. We have, this is the high that made that low, correct? So now we look for what? A new low. Awesome. Now what happens after this? Well, rinse and repeat, right? The same thing. Gas, right? Daryl, that's funny. That is funny. All right, so now we have a lower high. We have a lower low. What do we expect now? Price to do what? Come back into the range and then do what? Make a new low. Great. Now we have a new low, right? So now where's a new trading range? From this high to this low. Price will, of course, come back up into it and then go much lower. So this is how that whole transition plays, and we need to make sense of it. We have to understand what the reason and purpose for any move. So notice how I went from making really not much sense to looking like this. This is the first scenario I wanted to cover with you. Now, if I retrace my steps just a second, just to kind of show you the other scenario, because I said that's the first thing. The second thing, if you're viewing it like this, high or low, high, low, higher high, because remember what we were saying, a couple candles isn't a pullback. You could also view it like this, and this would have made your analysis the same, but a little different. And let me show you how. Where's the break of structure in this scenario? Can all of you guys identify it? Right? It would be, oh, I got my box drawn up here. Let me move this. But yeah, it would be right here, right? And notice how this would make it a little different. Now what I want you guys to do is now analyze that new structure. So if this is the break of structure here, where's now the new continuation? Awesome, right? So now we can see I'm just going to clear all of y'all's drawings. Draw. Clear viewers drawings. So now you guys can see, had you marked it like this, it would have made sense, but you have to understand that this is actually that high that did what? That made this low. This is the actual structure. And I know it's a little confusing to think of it at first, but this is the high that makes what? This low, right? This is the high that makes this low. So it can come all the way back up, 99.99%. It can come all the way back up to here, then it can sell down. But based off of this, of course, what happens, we identified the other structure too. So it's really what we're going to talk about next is fractality, structure within structure. Because notice if this was maybe our 5-minute structure here, well, maybe 1 minute structure, it could have been exactly as we identified. But if you notice, they all end up coming back to the same point. We know from let's say the blue is the 5-minute time frame and the orange is the 1 minute. Well, we know on the 5-minute, we had that break of structure, and we are going to be looking to take sells from our sell range. However, also on the 1 minute, we have 1 minute structure inside of our structure, which we're going to dive into here in just a second. But now notice what happens. By utilizing our 1 minute structural range, we can actually understand where the 5-minute will come back to. This is our 1 minute structure. This is our 5-minute. They both come back into alignment with where we want to be going, which is lower. So what do we expect? Price to then just continue lower from here. And this is where we're going to explore fractality here in the next few minutes. But yeah, regardless of how you mark that structure, you should still be getting the same move. It's just a matter of getting in sooner with less confirmation or getting in later with a little bit more confirmation, but still catching the overall move. So good stuff. Continue on, get through the, shoot, hold on. I'm gonna pause this for a second. Cleared this off. Let me see. 1 second, y'all. I'm just gonna add a new page real quick because the transition messed up right here. Control copy. All right, so now I want to ask you guys for this next page. This is where it's going to get a little tricky, and I want you guys to identify pretty much exactly what we just did, but on your own. So ready for it? Ready to see what we can do? I think you guys are. All right. So let's view here. Now it's your turn. Now what I want you guys to do is do exactly what we just did. So first of all, I want you guys to identify the previous uptrend. Everyone do it together. And stop at phase 2 or just after the second phase. All right, so let's stop at phase 2. Youngie Lou. All right, so we got phase 1. We got phase 1 master. I love it. All right, now phase 1. I'm just gonna just do this for y'all real quick. Great. So we identified this, and then this, right? This point right here was our break of structure, which tells us we're no longer looking for buys. Correct? You guys are absolutely right. Now, go ahead and finish it off. Finish off the last remaining phase. All right, good stuff, everybody. Good. You know, if we can even see the structure anymore, I can't even see this. I would have chosen this at this point because I don't see nothing over here. But awesome. All right, everybody. So let's see how you did. Right? So beautiful, right? So this is how we need to approach it. Now, I saw some conflicting. Everyone was generally right, but remember, we focus on where the logical, the moves that make sense are. So we have a high, we have a low. The high is broken, so this becomes the low. That makes a new high. We got that. Now what happens is, in order for us to mark a higher low, we have to wait for a higher high to be broken. Pretty straightforward, and we're familiar with this by now. We're professionals, right? Higher high is broken. Awesome. So now what's the actual low? The lowest point that caused this high to be made? What's this low? So structurally, we're going to be looking at this. So at this point, remember, from this low over here until this high right here, we're looking for buys. So my question to everyone is there, yes, where you have structure within structure, which we talk about in the next slide. However, based off of this, we're not going to be looking at any of this. This has no relevance to what we're looking at right here, right? At this moment in time, it doesn't, at least. So for that reason, where's the break of structure? Well, at this low. So again, this is the BOS. Where does the structure shift? This is that phase one right here. Our phase two, AKA our golden phase, is going to be right here. All right, this is that golden phase, or phase two, which then we're going to be expecting the whole transition period to be happening. So then we have our break of structure. We now have a high with what? A new low. So this becomes our new low. And what do we expect? Price to have some form of pullback before making a new low. This low is broken. So what do we expect or identify? The absolute highest point. Now, this is the highest point that made a retracement into the range, correct? But now again, we're not, I don't know if some of you guys may have illustrated this or this. Always identify the highest point. Always, always, always. So this is the highest point. What happens? New lows made. Beautiful. So this becomes our new range. What do we expect? Price to come back into our range and then continue lower. Beautiful. And then of course we have a new range, right? We have a low made a new low, lower high made a new low, becomes our new range. And what do we expect again? Price to come back into it. It can do whatever it wants, right? Now, again, this is not a lower high until what? It makes a new low. So right here, we have this becomes that lower high that's going to be making, our lower low. So our new range in the future is going to be from this lower high to a new lower low. And then we're looking to sell. So ranges will help you so much, but so many retail traders especially don't understand structure, or at least at the very basic, they understand this. But this is still very basic. We need to level it up a notch because this is just looking at one time frame. What if I told you we know that trends are different on all time frames because we know that all of these individual trends are happening on much smaller time frames, correct? So what you're going to be doing is, it's great that you can identify the main moves, but what if I told you you'll be able to take all the positions all in between because you know what the main moves are doing. That's what we're going to be getting you guys to understand, is understanding what fractality means in the entire sense of, we'll go into that now. We'll go into that right now. But that's what you guys are going to be learning now. So in 1 minute, you guys will be learning that. So now that we've covered the basic structure introduction with continuation and reversal structure, we're going to briefly introduce trading range, premium, and discount. So AKA selling high, buying low. What's the reason behind it? Why do we do it? What's the purpose? And that's what we're going to be exploring now. We're only spending one slide on it because it doesn't really have too much relevance to especially how we trade now, but it's important to know why it's a good confluence or reason to be taking any sort of position or finding your analysis. So generally all of us should be, we should be diction. What's the word I'm looking for? We should be familiar with trading range, premium, discount. So trading range, as we've discussed, is just our structure, right? That's the area that we're going to be looking to take our trades. So when we're looking at this over here, and yes, there's a lot of words, don't worry about the words. We have a lower high, a lower low. This is our trading range, right? We look to take sells in between here for us to go lower, right? Because why? Well, if this high is broken, ideally we'd be looking for buys. Again, this will change tomorrow. But that's what a trading range is. So the trading range is the range between the last structural points in any trend. It shows us the valid range where we should expect price to return to prior to continuing the trend. So within our trading range, anything that happens in between, if this is our trading range, right, from this high to this low, this is essentially saying we're going to be expecting new lows based off of probabilities. So anything that happens in the range until this low happens is just going to be a pullback. So with that in mind, we need to understand in an uptrend, our trading range is from the previous higher low to the current higher high. In an uptrend, the previous higher low to the current higher high. Let's say this is where we are right now. Where's the previous higher low? It's right here. Where's our current higher high? It's right here. This is our trading range, okay? Now, within every range, we have something called premium and discount and equilibrium. Trading range here is the same thing for the sells. I don't think I have to mark this out, but just for reference, trading range. We're looking to sell and we're looking to buy. Now, within a valid trading range, we have premium, discount, and equilibrium pricing. Now, what are these, right? What are these? Well, we know based off of market conditions now, especially Earl. I talked to him, a few days ago about the real estate market right now in Renton, Miami. It's crazy. This is not a buyer's market. This is a seller's market. Everything is cream of the crop. It's so dang expensive, and you don't want to be buying right now. And the same thing happens with trading. You don't want to buy for more than what you're ideally looking to get in at the fair market value. You want to be buying as much as you can for as less as possible. You want to be buying when it's at a discount. Let's say right now you're at a grocery store or you're going to go shopping. Do you really want to spend $70, $80, $90, $100 for a marked up t-shirt that you could get the same quality, same value for maybe $20, $30? Maybe for about brand or merchandise, okay, that's fine. But ideally, we want to be getting a discount on whatever we're going to buy. So discount pricing refers to the area below our equilibrium, AKA equilibrium is just the fair market value. If it doesn't increase in price, great. If it doesn't decrease in price, great. Essentially, it's just the same price and it's worth the value of it. You're okay with spending that. It's fine. That's essentially what equilibrium is. And equilibrium is the 50% of the trading range. Equilibrium is the 50% area between the trading range. So now we do have some fib traders in here, those who look at fibs, or maybe you haven't before. For me, I did fib trading explicitly for a couple of years, like at every number, right? You have the gold up to 38.2, 32.8, 61.8, everything, even the magic numbers with order blocks and BS. Okay, none of them are real. I'm telling you, the only one that actually matters or has any relevance is the 50. And you guys will be learning why, especially when it comes to the algo, understanding that numbers don't mean anything. Yes, everything is 369, but how many times, if you're looking at a fib, have you wondered, is it going to come to the 23.6, 32.8, 61.8, 77.6, 79, whatever, it doesn't matter, 88.6, right? You're never going to know which one it's going to come to because it's always going to be different. However, by understanding equilibrium, price should at least make a 50% retracement of the overall range prior to continuing that trend. So where's equilibrium? If this is our high and this is our low, if you want, take a Fibonacci retracement tool. And all you need to do is you need to identify just where the 50% is. And if you're looking to sell, you look to sell at a premium, right? Like we talked about, it's a seller's market right now. If we're looking to sell again, are you going to want to be, and let's say the equilibrium is where you bought it at, right? Let's say you bought your property here. Do you want to sell it down here? No, you don't want to sell low. You're not making any profit. You want to sell it at a premium. So you want to be selling it for more than what you got on it. So then you can get a positive return, right? So we want to be selling in premium, AKA selling above equilibrium or 50% of the trading range. Indicates that we're selling high, we're making money, right? So if you have a small pullback here and it goes lower, don't sell here because it will need to come up higher before going lower. That's premium price. Discount pricing is the same. If you want to buy something, you don't want to buy it right? If this is our overall range, you don't want to be buying it. I mean, gas, unfortunately, you have to, but you want to be buying it at $6, $7, $8 a gallon. No, you would ideally like to buy it when it was $1.69, $1.70, $2, $3, right? That's where you want to buy it. And that's going to be in our discount. So you want to be buying low, which is below 50%. So our premium price is above the 50% of a sell trading range, and our discount is below 50% of our buy trading range. And all that we really care about that must always happen is before considering taking a position, price should ideally return to equilibrium before resuming a trend. This is what should generally happen. Now, this will not always happen. It could reach 40%. So what I would say, if you guys want to add this into your notes just for the time being, is we need to see at least a 40% retracement, meaning there will be times where it will just come up to here, right? And then go. It won't even reach premium, or it won't even reach discount. Well, shoot, Griffin, how do I know which one to choose? Is it tranquilo? You're chill, and it's good. You're gonna know. So 50% is equilibrium, but if you really want to push the limits, 40% is the absolute minimum or maximum that I would look to buy or sell below. All right. So additionally, 50% retracement indicates a healthy pullback. This is what's going to help us understand. This is going to help us understand what's healthy. So for instance, if let's say we have this right here, maybe we're selling, right? Let's say we have this. And let's say we have this now. Is this structure, I'll just asking you guys, is this a lower high? If we're thinking about from healthy pullback, we have a low, high, a lower low. Yes, this is a lower low, but if we're thinking about what a healthy pullback or a healthy retracement is this going to be a healthy pullback?
No.
No, right? So what do you think we can expect instead? Let's say this is where price currently is. What do we think price is going to do?
Pull back, a decent pullback.
Yeah, right. It'll probably have to come back into this range. So for this reason, don't mark these irrelevant little structure, right? We want to be focusing on the real moves that have significant or meaningful pullbacks. Don't mark this, right? Just say, all right, this is a low because it's not, and proportionally, this is a fraction of the size of the last retracement. It shouldn't work out, right? So ideally, this is what will work out. But if you identify the wrong structure, you're going to be screwing yourself. Again, practice, a lot of scenarios, you'll become a master at it. All right, a little bit longer.
I'm assuming we'll have homework after this, huh?
Oh, yes. And for those who are beginning, don't worry, it is a lot to soak in at first. But once you go through the whole learning process, you realize there's only like ever 4 things that we look at, ever only. But the initial learning curve, yeah, it's going to be a little drastic to 4 days. It might be on a little bit of roller coaster of emotions, like, oh, I can't do this, oh, it's so hard, or oh, I feel great. And then one way or another, you're going to be rudely awakened. Like, oh, wow, this is a lot easier than I was making out to be. Or you're like, oh, wow, this is rocket science. But regardless, the total epiphany you're going to be gaining at the end of the 4 days is, okay, this is actually very easy. Like it becomes easy because you know all the hard stuff, and then you can focus on what matters. All right, so we're good on this slide. We're good. We're Gucci. We're ready to continue. So now, as we've illustrated, I'm going to be going over just a little intro to reversals and waves, which is finally after structure, which is the most excruciating section. We get into the fun stuff. Some of the things that we utilize every single day, all the time. What I'm trying to illustrate here is I'm showing you how reversals and waves work within one another. So reversals and waves, right? A reversal is mainly characterized by a break of market structure, AKA a BOS, of our last major swing point. Fancy words, don't worry about that. But again, all we're trying to show you is the whole transition between buys and sells here. So of course, like remember, think about that bell curve that we have, right? We have a curve, curve. Well, what's happening in between all of these curves? Price has to give some form of structural shift on our lower time frame. So of course, again, illustrating this, we have a low, lower high, identify the lower highs that break the lows, identify the high breaks the lows. Great. What happens? This high is not respected and it doesn't make a lower low. That's break structure, right? So what are we assuming at this point in time? Price to transition and shift. So what's it doing? It's going to be making new structure. Then we have what? Our phase 1, 2, and 3. Here's 1, here's 2, right here, 2, and then here's 3, the markup, right? And then guess what? This is just going to repeat at one point. So now we're looking for buys. Great, great, great. Now what happens is we're then going to be switching back to sells. Now I know this is a little distracting, or maybe it's just me, my OCD. Where's this right here? Delete. All right, so even right here, we have the same thing over here. We have our 1, the previous uptrend. Where's the 2, the break of structure, which is right here, right? This is our 2. And where's the 3 is the new trend, lower high, right? Low, lower high, lower low, lower high, lower low, lower high. Here's a new low. So we mark this high, new low, mark this high, new low, mark this high, new low. What happens here? Break of structure. This is a new shift, right? So we can be looking for buys. But guess what? All of this is happening on smaller time frames. You can be catching all these individual moves, but then this to be based off of a higher time frame narrative. So understanding how we're always going to be transitioning. This is just showing you the flow of how positions are being accumulated and distributed, the markup, the markdown, showing you what types of traders are in control in the market. So in a bullish market, the most recent higher low needs to be broken to consider a reversal. Higher low is broken, consider reversal. In a bearish market, current lower high needs to be broken to consider reversal. Lower high is broken, consider reversal. Now, this is just a trade. Oh, you're going to trade all this, then switch trade here. This is all going to be transpiring within something else on a larger time frame. And this is where we're going to get into the market fractality section of understanding. Because if I were to ask you guys this right here, yes, we have all these individual trends, but now if you could identify the main trend, how would you guys illustrate that? Meaning we see all the individual pullbacks, but what is all this making structural wise on a higher time frame? That may be a little advanced, but if someone can answer it, let's see. Yes, sir. Yes, sir. Yes, sir. Right? Good, good, good. Now, Jorge, question, brother. Let's think about this. What did this low do? Did this make, remember what we talked about? I'll put you on the spot, but you're good. Think about it. If we have something that looks like
very low, so yeah, this is well nothing. I mean, it didn't make yes, this high didn't break the low, so we're just waiting for this to happen. Like I'm going to annotate. Yeah, I'm just waiting for this to happen. Yeah, because
Sweet.
it's yeah.
Awesome, awesome. Yeah, so that's exactly what we would do. As we know, the whole purpose of all this happening this is all the higher time frame move, and we're just seeing on a lower time frame how it's transitioning. So it might be a little advanced, but good stuff, guys. Yeah, so that's just showing you kind of how the flow and the waves are working together, because what the market is fractal. It's waves within waves, and I'm going to be explaining that definition here in just a quick second. So let's see. Let's go here. All right, so I understand that. Awesome. Now let's go back into what we're talking about. What is discount price? So we talked about it, but just a quick example. That won't spend too much time on this. Is discounted price the first thing that you guys always want to do whenever approaching a charts? Is you need to understand the structure, higher time frame structure, specifically identifying the continuation structure. So the first thing that we're illustrating or identifying here is what? It's going to be the structure. Structurally, we have a high, right? We have a high, a low. This low makes a new high, correct? So now what do we have? We now have a new low, right? Because it made a new high. So this becomes a new structure range, right? What do we expect price to do? come back into our range to do what? To go higher. So now what do we expect? Where is our new trading range? Remember, structurally, this low to this high. All we do is we grab our fib, our Fibonacci retracement, or you can eyeball it, doesn't really matter. And you just look for what? You look for where the 50% of the range is from this low to this high. And you look to buy below the 50% of the range, at least at it, if not below it. You'll know specifics, of course, in a little bit, right? So now what do we see? Price comes back into discount, comes into the 50% retracement and goes higher. And it will always be the same. Here, give a low, a high. Where's 50% of the range? Probably right here, right? Comes below 50% to go higher. Same thing. So that's what we're showing you first. First is structure. Second is premium discount. It's an immediate next thing that you want to be understanding. All right. So I think we're all good with that. Now let's look at the premium price. Premium price is the exact same thing. First thing is always structure, then follows our premium discount equilibrium. Structurally, we have, some form of high over here. We have some form of low over here. Now, again, why did I mark this? Well, notice again, that's broken. Doesn't follow the pattern, right? Right, doesn't follow it. So we need to make it look like the sell pattern. So for that reason, we're going to be choosing this low. Then what? This lower high. Oh, crazy, it works. So then we have a new low, right? So we have new structure. May mark this as the lower high. Where's the new low in the future? It's over here. We know we have to have a pullback in between this range. Pullback, new low is where? Over here. So I have to pull back to then make a new low, correct? Now, guess what? We now have, where's the new low in the future? Over here. So this is that last lower high and our current lower low. We draw our fib from this high to this low. And what do we expect? Price to have some form of retracement back into a premium price, this 50% to do what? To make a lower low. So now, of course, you guys will learn how to catch all these positions that we teach you extensively, but that's besides the point right now. But once you understand it, you know where it's going. And this is what's going to start developing your 2020 foresight vision without talking about anything that actually moves the markets, because this structure doesn't move the market. Premium price discount doesn't move the markets. That's how you can trade it with an edge, but we're more focused on what actually controls the market, right? So that's later on. So this is our premium price model, our premium price example, always giving you guys some live examples to go along with that. The reason I'm pausing my screen every individual is because I had videos and they're not rendering and it's going to crash and I had to take them off. So now let's go into fractality. I want to ask everybody right now, participate, unmute your mic, or you can type in the chat box. Does everyone know what fractality is? What a fractal is? Well, I mean, shoot, now you do, looking at this. But does anyone not know what it is? Someone who does know. Anyone want to give their own explanation of it?
I can do it.
Sure, bro.
In the higher time frame will also happen in the lower time frame.
Absolutely. Yeah. So what is a fractal? A fractal is the same image zoomed in and in and in on itself until you, I mean, it's endless, right? It's limitless. It'll never end. It's like it's an infinite figure of things that are going inside. And specifically, I don't know, someone gave me the idea. I don't know if it was last boot camp or something, but specifically it's a Russian doll scenario. And Russian dolls, essentially, it's a doll that has a smaller doll inside of it with a smaller doll inside of it, a smaller doll inside of it. And that's how we need to think about the markets. The markets are the same way. Everyone says, oh, what type of trade are you? Are you trade on this time frame? Blah, blah, blah. No relevance. And let me show you why. Let's say, for instance, and let's think about this Russian doll scenario. If I were to ask you right now, let's say we have something that looks like this. I'm going to divide this into 3 different sections, okay? Let's say we have trying to think about this. Let's say we have 1, 2, and then we have 3 below here. And let's say that and this would definitely be helpful to write as well, but I do want you guys to participate. Let's say that this is our 4-hour time frame, right? Let's say this is our 4-hour right here. And let's say the structure per se looks like this. Let's say this is our last lower high and we have our lower low here. We know that this is one leg, but what I'm trying to emphasize is that within this one leg here, right, within this one leg here, what do we think is going to be happening inside of this on, let's say, maybe the 1 hour? It doesn't matter, again, time frames don't matter, but I'm trying to illustrate what do we think within here. Okay, shoot, Oliver, I didn't even say you drew that, but yeah, exactly, right? So let's say this is the 1 hour now. Well, within this, on the 1 hour, it's going to be looking like this. It's going to be creating waves within one wave. So now let me illustrate it over here again. If this is the 4 hour trend right here, if this is that 4 hour trend per se, and this is what we're looking at, well, within this 4 hour trend, we're going to have more waves within waves. So now, again, looking at this, we have our 4 hour trend here, higher time frame, higher time frame, higher time frame, higher time frame, right? Well, in between this trend, we're going to have a smaller structure because structure is always making structure. Structure on lower time frames is building higher time frame structure. So now we're going to have this, right, all within this. So all these red individual lower highs and lower lows, they're making it look like just one stagnant lower high and lower low on one time frame. So we need to think about a whole bunch of individual structural points are making one. So the next thing I'm going to ask you guys is, now let's say within a leg, we then have more structure. So if this is the 1 hour, let's say now we're going to go down to the 5 minute. Let's say now we have the 5 minute. On the 5 minute, let's think about this. Where is the last leg? Remember, it's a fractal, right? The same thing zoomed in and then in, right? So now what we're going to be focusing in on is this. What do we think is going to be happening within here? What do we think on the 5 minute? What do we think is going to be happening?
The same wave pattern.
The same thing, right? So we need to think about it like that. So this is that higher time frame again. If we have that red right here, we have the red. I'm illustrating it from right here, just for those who want to know. Within each individual red, we are going to have what on the 5 minute, exactly as Antoine illustrated. We're going to be having all individual lower highs and lower lows on the red. So this is how we need to understand fractality. And this is kind of where breaks of structure and everything kind of start to come into play. Because within every single red, guess what we have? We're going to have all of the pink. And then guess what? What happens? Right? Think about it. Remember those circles that we were just talking about, or the bell curves about how structure is working? Structure is always happening. It's happening continuously, simultaneously, all the time, building new structure. So this is where we care about, structure, and it becomes very important for us in analyzing, what's happening on all time frames. And once you understand how all the time frames are working together, you then know what's going to happen where and how it's going to be utilizing itself in order to get there. So then it's like this. Let's say this is the 5 minute now. Well, guess what? Within this 5 minute structure, right, from this lower high to this lower low, what's there going to be? There's going to be even more structure on the 2 minute. So this is what a fractal is. And that should definitely give you guys a better idea of what's happening. But what we need to think about is this pink right here is what? This pink, all these individual pink retracements are forming the red, right? They're forming the red. And then this red right here is forming what? It's forming the black. And usually I put this together all in one picture or one scenario. But if I had to make it a little easier, this is what it's going to be looking like. I would definitely draw some of this out for examples, just to make sure. And guess what? Where's the black? The black will be this. So let me know, guys, does this make sense as to what I'm trying to illustrate right now? No matter the time frame you're trading, there's going to be different trends on different time frames. But by understanding it's the same thing over and over and over again, if you know where you are within the trend, you know that where we're going. For instance, let's say red, we had something over here, right? If this was our red right here, based off the 4 hour, we want to be going lower. So can't we just use the red to target the black? Because we know it's going to be going there regardless. This is where we start programming our mind, and again, intro to it. But let me know, guys, if that makes sense, just for an intro. And if it doesn't, just put a 1, and we'll go into it. All right, good, cool. Yeah, we're gonna have a break here in just a second. So I'll make sure that makes sense to everyone. So check when the next thing is, when the next break is. Give me a second, y'all. All right, well, question, would you guys rather have a break right now or wait 20 minutes, 15 minutes? 1 for now, 2 for 15 minutes. Everyone type in the chat. 1 for now, 2 for 15 minutes. All right, Antoine, if you want to go to the bathroom, go for it. We're gonna keep going, and then our moderator will watch you. Antoine, yeah, dig one for the team, right? We gotta get through this. Yes, go for it. That's fine. So now, market fractality and wave theory. This is exactly what we're trying to get into in a little bit. A little bit of an advanced introduction to it, but this is now how we need to be viewing the charts. The market is fractal by nature. So reiterating or referencing that Russian doll, and the first thing, we need to understand structure. Waves. The market is just waves within waves within waves. If you identify what wave you're in, maybe it's a smaller wave of a larger wave, you know where price is going to go, how it's going to get there. And you're really becoming a true smart trader by utilizing the lower time frames to get in on the, or to target the higher time frames. Because if you know where a higher time frame is going structurally, as we've talked about, let's say on the 4 hour, if we know that the 4 hour is selling down, and let's say for whatever reason we have our confirmations, and let's say it's already in premium, right? And we know if this is the 4 hour structure, maybe it's even the 20-minute structure, doesn't matter, right? The time frame is irrelevant, doesn't matter. But let's say within here, right? We know what's the goal. We want to be going lower. Well, what's happening in here is what? Well, all this is happening. Then guess what happens? What does that break of structure tell us? Break of structure tells us that we're going to be potentially reversing. Well, guess what? If we have a break of structure on a lower time frame and we're aligned with the higher time frame, being smart, we can most likely anticipate what? We're now resuming on the higher time frame to go lower. And then guess what? It's rinse and repeat. Lower time frame structure, lower time frame waves is going, when what is all these individual retracements and pullbacks forming? Well, this is going to be forming the higher time frame that's going to come, but all the red needs to happen prior to forming the black. So this is everything we need to know. It's waves within waves, trading the lower time frames to target the higher time frames. Now, it doesn't matter. When I say lower time frames, I'm not referring 1 minute, 2 minute. If you're trading the monthly time frame as your higher time frame, your lower time frame could be the 4 hour, like or the daily. You know, it doesn't matter. It's just you have a high time frame and a lower one. That's it. So let's say for a better example, let's say that when we're looking at this chart over here, right? Let's say, for example, 0 to 1 is our higher time frame structure. We have our 0 right over here, and then we have our 1. If this is our higher time, we have 0 to 1. Well, in order for it to get there on a lower time frame, as we just talked about, what does it need to do? It needs to have individual higher highs and higher lows. Now, again, what's going to happen is you'd be like, oh, this is a break of structure. This is true. But at the same time, if it just because it breaks structure doesn't mean it's going to reverse. Notice the higher time frame is still buys. So we can just do what? Wait for structure to align, right? Let's say after we have a break of structure here on the lower time frame, we know that we're going to be targeting a higher time frame, right? So guess what? Break of structure, come back to equilibrium. We can be getting in here because what's this doing? It's going to be forcing buys. We know that we're going to be going higher. So all that we're doing is by being able to identify the higher time frame structure, it's going to enable us to utilize the lower time frames to maximize the reward that we're going to be getting. So this is what we need to understand. And especially is the time frame you're trading, it doesn't matter. This is always, this will never change, always be the same. It's the markets are just candles within candles within candles within candles. If you can make sense of those candles, then you know where price is going to be going. And that's how you need to approach it. I mean, even hypothetically, we had this over here. Let's just hypothetically say, right, that this is a bearish break of structure, right? Let's say that we have a bearish break of structure right here. And let's say our, the new structure was from this high to this low. Great, we know that. We know that, guess what? We're going to be looking to sell. But how can we become even more advanced with this? Well, where's the internal structure? Where's the next lower time frame structure? Well, we see something that looks like this: low, lower high, lower low, lower high, lower low, right? So based off of these two time frames, we have two structural things. We can either at this moment, right, aren't we bearish from this lower high to this lower low on a smaller time frame? We know that we can be taking sells within here. At the same time, if that doesn't work out, we know that sells price could come up higher. As long as it doesn't break this high, we're still looking to sell. So we could be looking to take a sell from here to go lower. And then guess what? This lower time frame structure, what ends up happening? We now have a new high and a new low. So guess what? We can be looking for more sells within here to go down, more sells within here to be going down. And how do we know we can sell? Because what are we doing on a higher time frame? We're selling, and we're utilizing the lower time frames because it's stipulating the higher time frame move that's going to be happening. So price doesn't know time, and time doesn't know price. That's just something we're going to be specifically referencing on day 2. But it doesn't matter the time frame you trade, it's always going to be the same. It's waves within waves within waves. Dang. Well, that next slide. Yeah, guys, I'm gonna, let's see. I'm trying to look at this for a second. Yeah, I'm gonna give you guys a second just to look at that, and then 30 seconds, we're gonna go on to the next one. All right, we should all be about good. All be about good. All right, all right, all right. All right, so now moving on, let me move forward now. So now this is how we need to be approaching the charts, especially when it comes to having this fractal mindset, this fractal understanding of price. So now illustrating, keep moving on, moving forward. Today is a lot of definitions and examples as we mentioned. So, oops. All right, so now let's look at what we were just talking about. Right here, what do we see? What we're gonna say is this is our 4-hour time frame. This is our 4-hour right here. Our 4-hour. We then have our, actually this is 1:15.5, my bad. This is our 1 hour right here. We have our 1 hour. Okay, well, 1 hour. We then have our 15-minute, and then we have our 5-minute. Okay, so what does the 1 hour structure look like? Well, we know, and the reason again, guys, that you don't want to be identifying all these individual trends is because it's just lower time frame structure. Just mark the structure only on the time frame that you're looking at that makes the most sense, because we know all the internal stuff is just going to be structured on lower time frames. So when we're looking at this, we can tell structurally we have a high up here, a low here, right? We then have a lower high right here. Now, what I'm trying to illustrate at this point in time is, let's say hypothetically that you had no idea what price was going to do after. Let's say you had no idea about this. right? Well, what do we know happened in order to give us confidence that we're going lower? First of all, we're selling. Second of all, there was our own ideology of why it reacted here, but it also came to discount or our premium price, right? It came to premium, it came to equilibrium for us to sell. So ideally, that's what we're going to be looking for. So now I want to ask you is how can we utilize this knowledge coming from a higher time frame basis and know that this is where it needs to go? How can we utilize and understand? Well, we need to go on a lower time frame. So let's say this is where price was, all right? And we know on a higher time frame, it's going to end up making a new low. What we're going to be utilizing is scaling in or getting in on the lower time frames. So essentially, we know that this huge move has to happen for the sells. But before this whole red move happens, we need to go on the next lowest time frame and figure out how we can get in. So what do we have? We have right here our structure, right? This is that lower time frame. This is the low that made the high. Where's the next break of structure? This break of structure, for those who might be a little advanced, what does this break of structure tell us? Why is it important? You can take a few seconds to type it. You can say it. Why is this break of structure important besides the fact it's a reversal? What specifically in this case is it telling us? All right, Oliver says pullback could be over. Momentum switch, confirms high. Cool, cool. Right, so yeah, so all those are good. Now, this is specifically, yeah, it's the end of a pullback. If we know that we're selling, and what do we know? We know that we have to have some form of pullback before we continue lower. So this break of structure is important because it's signifying to us that the pullback could be over. It's now transitioning into the new trend, which is our new sells. Because remember, we have the continuation. We then have what? That phase two, which is the break of structure. Then 3, the trend shift. So continuation, break of structure to the new trend shift, AKA following the higher time frame. And then now what we can do is just utilize that lower time frame and identify the structure and then get in that way. You don't need to get in up here for those who are like, oh, I only want 1 pip of drawdown. Yeah, those trades are great, but there are endless opportunities all in between, just utilizing the lower time frames. So guess what? You have high makes a new low. Where's the new low broken? Over here. Where's the high? Well, high, right? High, we have a new low. This now becomes the absolute high after to then make a new low. Low broken, low broken, low broken. I just identify the swing points that broken. Lower high, lower low, lower high, lower low, lower high, lower low. Where's this one broken? Here, but again, so it makes sense. Here, where's this broken? Lower high, lower low, broken over here. Lower high, lower low. So notice this is all substructure that is forming. Like this is all what's going to be happening on our lower time frames, right? To do what? What's this going to be forming? This is going to be forming the red. And the red won't look as so until it happens on the orange. So essentially we can be utilizing these 15-minute individual trends to target where the red trend is going, to be targeting this. If we know it's going to be going down to here, guess what? If I had to make this look how we had, if we know that price has to go down to here, we're just going to be utilizing the lower time frames to target here because we're utilizing the higher time frame structure. And then we're getting in on the lower time frames to target that respective structure. So then we're going to be utilizing this to target that. But guess what? If you want to become more of a perfectionist, what did we talk about in that first introduction? Well, we know that within every individual leg, there are several legs. So now let's say this is where we are currently. And maybe you missed this overall move. Well, rather than just randomly press and sell, right? Because you never do that, or randomly buy. If this is where we are currently, what do we think is going to happen based off of this? Well, if this is the 5-minute and the 15-minute, we know we want to sell. Well, guess what? Within this range, what do we have? Within that range, guess what? We have within here, we have more structure. We have substructure within structure right here. Low, lower, high, lower, low, lower, high, lower, low, right? This is now telling us we can be selling. So guess what? The 5 minute, this is where the 5 minute structure is still bearish. Here, what happened? Oh, we're bullish. Oh, we're bullish. I don't want, just don't buy. We're still selling. This buy needs to happen to do what? Cause some form of pullback, then to do what? On the 15-minute, we want to continue to sell. That's the whole idea, right? 15-minute structure, we're still selling. So guess what? The 5-minute break structure, that tells us, what does that 5-minute first BOS tell us about the 15-minute? What is a 5-minute break of structure or lower time frame break of structure? What does that tell us about the next respective time frame? Someone
that the pullback for the higher time frame is coming to an end and is gonna continue it's gonna continue the continuation trade.
Right. A lower time frame break of structure equals a higher time frame pullback. Easy, very simple. A higher time frame LTF BOS equals a higher time frame pullback. So this 5-minute break of structure, this does not mean, oh, we're going to the moon. No, it doesn't mean that. It means we're going to be having a pullback within that next trading range, right? When the blue or when the purple break structure, it's telling us we're having a pullback on the orange, right? So for instance, now let's say this happens. Now what is this telling us? That the pullback is over, right? Because we had the pullback. Now guess what? We are now aligning. This is the BOS, right? We're now aligning back with the orange. So where do you think we're going to be targeting now? Everybody.
A new low.
New low, right? Because this is giving us confidence that what? This will be forming on, right? This is going to form the orange. And now what I want to ask you guys is, let's say the same thing happens, but let's say maybe rather than the purple doing it, let's say that this happened. And I get very intense with structure. I'm not going to try not to spend too much time on it, but it's imperative. If you know structure, you're already the 1%, but you have to understand how to trade it, right? Because structure biases everything. So now let's say we had something that looks like this. What does this 15-minute break of structure tell us? What does this tell us now?
1 hour pullback.
A 1 hour pullback. That's all it tells. It tells us now that we're having a pullback on the 1 hour. That's all we know. We don't know if it's going to break the 1 hour structure. We don't know any of that. But what we do know now is we have conflicting trading ranges. We now can be looking for a 1 hour pullback, AKA if we have a break of structure here, and let's say this is where equilibrium is, rather than waiting just to sell here, what can we do?
Buy up.
Yes, yeah, we can buy up, right? So guess what? Break a structure, phase 2, phase 3, new trend, right? So now what we can do is, let's say we know this is where equilibrium is. Well, guess what? We can just be looking for buys up until here. And then all in between here, what are we going to be doing? We're going to be looking at what? Guess what? And all in between, a more different structure. So we know that we can utilize lower time frames to be getting in on. I know that was a whole conglomerate all at once. Some may be following perfectly. Some of you might be a little behind. Regardless, do not worry. It's going to be okay. So by understanding what wave we are trading in and where we are in the trend, we understand where price is moving towards.
Quick question. So that buy uptrend on the 1 hour time frame that you're doing from the orange to 15 minutes, right? Are you only buying up until the 50% fib? Is that
correct? Well, now, so the only reason I said buying up to that fib is because we look for at least a 50% retracement. As far as how far it's going to go, you'll be learning all that. Like you'll know to the T where it needs to go. Like just for now, the fib is showing you that we look to sell at least at equilibrium, right? Because on the 1 hour, we're still looking to sell. But we're trying to say that right now, we're going to be buying the pullback because we can capitalize on that movement before continuing the sells. So we're going to be buying up until price is ready to sell off, which will be around here. And then as soon as it aligns again, Earl, if I were to tell you that I know there's so many drawings. Let's say now that, give me a second. I think this will make more sense. All right, so this is our 4 hour, right? We're looking to sell here. This is the higher time frame sell bias. But let's say now this is the higher time frame within here. What do we have? We know we have all this. Now, Earl specifically, what does this mean for us when we see this? And let's say this is that lower time frame. What is that telling you?
That's a break of structure, but it's a pullback.
Yes, break of structure on a lower time frame, but it's a pullback on a higher time frame. So let's say hypothetically our equilibrium is, right here. That looks about 50% to me. Ideally, we don't want to be taking any sells below 50%. For the meantime, you'll know exactly where price needs to go. But until then, let's say now you have a break of structure. We have now a bullish trend on the 15-minute. Well, now guess what? What can we be utilizing? If we know at the minimum, this is where we need to go, based off of the 15-minute structure, what are you going to be looking for right now?
Higher lows and higher highs.
Right? Higher lows, higher highs. So we're not selling yet. We're going to actually be looking for our buys right here. We're going to be looking for more buys somewhere right around here. And then, of course, as soon as price aligns, what we can then anticipate is what? Higher lows, higher highs. But then let's say this happens right here. What does this tell us?
Pullback's done.
Pullback. Well, the pullback has finished, right? Because the higher time frame we're selling. This is where the pullback started, right? To start for the buys. This is where the pullback was. Oops. This is where the pullback was, right? Because we're selling. So the pullback was here. We now pull back into our premium. And now we want to resume the overall sell. So this pullback now tells us what? Well, now we can look for our equilibrium in this range. And then we can look for sell continuations. And then this is kind of the basis of what we're going to be utilizing, is understanding that it's market structure within structure. All the breaks of structure and all the whatever, they're just showing you on the next time frame what's going to happen. Break of structure on one time frame is a pullback on a next. Or break of structure, it's going to be now aligning with that higher time frame. So this becomes part of the whole mastermind mentality. Any move anywhere, you'll be able to trade. As long as you know where we're going, you can utilize those lower time frames to get there. And then you'll be able to not only just take a sell from the main area, but you'll be able to sell here, here, here. Because where do we know that we're targeting? We know that we're targeting here at the minimum. But then guess what? There's always structure inside of structure, right? So maybe you then have more structure. Maybe it comes all the way to here. What if this is now this could all be structure inside of the weekly chart, right? It doesn't matter. But this is how you're going to be able to know how you can swing positions, how long, if this is where we are. This will be a huge swing position because we're still going lower. It's all about fractal structure. And once you can master that, you'll know where price is going to be going. All right. I know that was a lot all at once right now. Well, I was pretty much going to go through that. So let me see, y'all. One second. Just want to doing that. Break is okay. Sweet. So, yep. This is the last thing that I want to do real quick is right here. So exactly. Let's do one more example, and then what we have is we're going to have 10 more people introduce themselves, and then a break. All right. So I know we're running. Today is a long day to say the least, but let's have one more practice. And this is how I always do it, always giving you guys scenarios, because rules are really important to follow, but being able to apply those rules is more important, and apply them properly. So let's say we have something that looks like this. So give me a second to draw this out for you guys. All right. So this is, let's say we're looking at something that looks like this. Okay. I'm going to this over here. 1 second, y'all. I really actually would have thought this would have moved everything faster. But yeah, here. This will be fine. Can I just like control shift all this? Oops, not that. Not that. Okay, well, regardless, let's look right here. This is what we're looking at. So from a higher time frame perspective, the blue, let's say the blue represents the 4 hour or the 1 hour. Honestly, it doesn't matter. So let's say the blue is the 4 hour. Where is the 4 hour structure, everybody? Can everyone go ahead and mark this 4 hour structure for me? So on the 4 hour, we know that we are going to be looking for buys. And this is where maybe if you ever had some structure help, this is what's going to clear it up a lot for you. So 4 hour, the trading range is from this low here to this high, right? So this is ideally that range that we should be looking for buys. So for the 4 hour, we are going to be looking for buys. Now, let's say the next time frame we have is going to be the 1 hour. Let's say now we're looking at the 1 hour. All right. Now what I want everyone to do is mark out the 4 hour structure or the 1 hour structure. Go for it. Dang, Jorge, cocaína. He's going so fast. All right. Good stuff. Right. So on the 1 hour, clearly we're looking to be buying as well. Okay. So we know on the 4 hour, looking to buy. Also on the 1 hour, we're looking to buy. But now what I want to ask you, the last one is, let's say I'm in clear viewers drawings. Let's say now on this 5 minute, let's say maybe this 15 minute, doesn't really matter. This 15 minute, what are we doing on the 15 minute? I mean, you guys, yeah, 15 minute. Let's look at it real quick.
Selling.
We're selling, right? You don't
pull back, sell.
All right, good stuff, right? So we know that we're going to be selling on this 15-minute time frame at the moment, right? Because why? Well, we had to break a structure. So now I'm going to just take a second and I'm going to illustrate you guys the different trading range we're looking at. So right here, sell. On the 15-minute, we're looking to take a sell, right? So this is where everything is going to have different relevance when we're looking at the market. And we need to understand from a holistic point of view how everything is working together to build a bigger picture. So let's start to view this, right? Let's start to be and pay attention. This is how everything is. Theory, practice. It's always about practicing. All right. So now, well, Mesh, you're on the right track, but definitely much more than that. So now range wise, this is our buy range for the 1 hour. 4 hour, this is our buy range here. And then our 15-minute, our sell range is from where? Right here. So this 15-minute break of structure, this tells us that we are having a sell, right? Like this tells us that we're having a pullback on the 1 hour. So what do you think we can do? Let's say for shits and giggles, let's just say for whatever reason, this is where we're going to be looking to buy on the 1 hour. Let's say this is where we're looking at. Now, what I want you guys to understand is that if this is where we know we're going to buy, which you guys will know the exact levels of where to get in, where to get out, how to hedge. Let's say now we have this right here. Let's say we have this on the 15-minute. This 15-minute break of structure tells us we're going to be having a pullback on the 1 hour. So we're still looking to buy on the 1 hour at this time, right? Because we're still looking to buy, but also notice on the 4 hour, we're still looking to buy. So now what I'm going to say is, let's say on the 4 hour, this is the 1 hour to buy because we want to go higher, but also on the 4 hour, maybe you have an area down here that you want to buy from, right? So you have two possibilities. Let me show you how to approach this and actually follow structure. So structure, what do? Well, 15-minute is bearish. So ideally what we're going to be looking for is sells, right? So sells, we have a lower high, lower low. Guess what? Now we have a lower high, lower low, We have a lower high, and now we have a lower low. So now we have two things, two conflicting things at this period in time, right? What do we have? Well, we are in a 1 hour buy zone. At the same time, what's the structure on that 15-minute? Bearish, right?
Okay.
Right? So it's different. We need to view this as so. We need to view it as like this. Both at this moment in time are equally probable. You'll be learning how to know which one will work out. But notice we have a 15-minute sell structure within a 1 hour buy structure. So we need to automatically be processing this. And you guys, as students will tell you even here, I say this literally all the time. One of two things is going to happen. And what do we think one of these two scenarios is going to be? What are the different scenarios based off of structure? Right? Yep. So it's either going to reverse or it's going to continue, right? Meaning what? It's either going to do this. It'll either respect that 15-minute structure or it's going to do what? The 15-minute could break structure. And then what are we going to do here? To go higher. One or the other is going to happen. And hopefully you can see why either, I mean, this clearly would make a lot of sense, but hopefully you guys can also see why this would make sense. Like you can make anything you see, it can make sense. And you guys should possibly see that. So now how do you approach this? Well, let's say now you have a 15-minute break structure. Great, right? So what do we look to do? Well, we have now a new high. So now we expect a higher low, then we're making a higher high. And where are we targeting? Where do we think price is going to go? Well, it has to go make higher highs. Great. But let's say that doesn't happen. Let's say now that we have something that looks like this. Let's say we had this right here. What just happened?
15-minute continuation.
But what happened right here?
A BOS.
A BOS, right? So now let's set this up a notch. We had a BOS. So now what are the new hourly structural points? If you guys can mark those. Right? It'd be from this high here. Yes, sir, to this low. This is that new hour structure. But as you just marked, but also what type of structure do we also have? 15-minute bearish, right? So guess what? We now need to understand one of two things is going to happen. We can possibly be selling where? Right? Isn't this that last valid trading range? So we could be selling within the 15-minute range. Or what if this happens? What if we break structure? We could also possibly, based off of the 1 hour, are we bullish at this point in time? No, we're bearish, right? So even if we break structure on the 15-minute, we're still bearish on the hour. So if we don't sell here on the 15-minute, guess what? We can still come up into the 1 hour, right? Because that's a new structure, and then we can continue lower. So how do we know which is going to work? Well, let's assess it. Let's say now, for whatever reason, hypothetically speaking again, is that let's say you had two areas. Let's say you had a sell area here. And the sell area here. Well, how do you know which one is going to work out? Well, let's think about this a little bit. What gives us a confirmation, or what tells us that we're going to be aligning with that time frame? Well, we're going to need to see some lower time frame structure, right? Because it's always, the market is fractal with structure. So let's say we have this. Let's say we are looking at this right here, and our structure is this. Let's say if this is our 15-minute structure, let's say we have structure inside of it, right? All right, what's going on?
Had a lower time frame break a structure to the downside.
And this tells us, someone besides Anton, because you're a beast, I know you know this.
Tells us that that's going to hold.
Yeah, right. It's telling us it's going to hold. So we can go ahead and actually stack our positions and target a new low, right? But now let's say that besides Anton, because you're a beast, I know you know this.
Tells us that that's going to hold.
Yeah, right. It's telling us it's going to hold. So we can go ahead and actually stack our positions and target a new low, right? But now let's say that weren't to happen on the different scenario. What if it just did this? Oh, we had a 15-minute break of structure, blah, blah, blah. Yes, we did. But that 15-minute break of structure just tells us we're having a pullback on the hour. So what we then can do is focus maybe on this zone. And what happens? What if you have this from this zone happen? Same thing. We have a confirmation. We're going to be doing what? Targeting our new hourly low. We know this is where we're going to go if we're selling. So then we just be patient and know that it's going to work out. And then guess what? We now have new structure, right? On the hour structure, what are we looking at? Low, lower high, lower low. And all this is forming on the 1 hour. And then same thing over and over and over again. Guess what? Maybe on the 15-minute, it could be looking, I'm just changing it up a little. It could look like this. Oh, 15-minute break of structure. Oh, we're buying. 1 hour, we're still selling. So if you're going to buys, better be quick because we're going to be continuing those sells, aka one reason why trend lines fail. But this is how we need to approach it. And then of course, let's say price comes and taps into our zone perfectly. It's exactly where we want it to be. What do we do here? Break a structure, we get in, and where are we going to be targeting? The higher time frame structure. So this is how we can start to have a whole fractal level understanding of how price is constantly transitioning and utilizing itself to get to where it needs to be. And if we can understand what we're trading in, we can trade ideally any move, any direction, as long as we know where it's going to go. So that was the kind of the whole spiel. All right. So we are good with this. I know it was a lot, everybody. I know it's a lot, but we need to meet some more people. Let's have 10 more people introduce yourselves. Everyone, I don't care how bad you have to go to the bathroom, please stay. You're going to be working with these people every single day. I know. Let's everyone introduce themselves. So fast we do this, fast we go through, and then we're gonna have a 10-minute break. So let's meet some people. Let's see.
All right, let me start. If you can hear me.
Go for it, bro.
All right, my name is Simon. I'm from Bavaria, Germany. So in the south of Germany. I have been trading for like 6 months, not even more. And what do I hope to learn from the bootcamp? So, well, for me, I'm struggling with my psychology, building my mindset, and that's what I hope to get, and also get a really, really deep and detailed insight into the markets and how they move. And yeah, I mean, it's a dream of everybody, become a consistent, profitable trader. So that's what I hope to learn from it. And if I could go back in time, I would say to myself, never give up.
Never give up.
Never give up, ever.
I thought you said something at the end there. I was like, okay. A little bit of turn. All right. Thanks, bro. All right. Who else we got?
I can go next, bro.
Yes, sir.
Hi, guys. My name is TJ. I'm from Vancouver, Canada, on the coast here. I've been trading for about 1.5 years. Also got my buddy Mesh in here. We've been back testing for about 1 year or so. What I hope to get out of this boot camp is to become a consistent and profitable trader. Yeah, and if I could go back 10 years to being 10 years and tell myself 3 words, they would be trust yourself.
Awesome.
That's
bro.
about it. Yeah.
Awesome, bro. Nice meeting you, TJ. All right. See who's next.
I'll go now.
Yes, sir.
I was a little bit intimidated to speak earlier because of all of these really cool American and Canadian accents. I'm from a place called Birmingham in England, and even in our country, my accent's one of the worst. So I'm being brave speaking. Anyone from the UK is probably laughing on the screen. I can't see everybody. So my name's Richard Bell from Birmingham in England. I've been trading for about 18 months now. I'll use the term trading loosely because I've really just been educating myself and trying to be more knowledgeable. To be honest, what I'm hoping to learn from the bootcamp is just keep progressing with that knowledge. I think sometimes you think you know something, and then somebody else explains exactly the same thing, and suddenly it clicks. And I think Griffin just did a great explanation on multi-time frame structure, and it took me a long time to actually get my head around that. And he's just perfectly explained it in about an hour. So I wish this had happened about 12 months ago. And then finally, if I could go back in time, I'd say that knowledge is power. And that's the end of my introduction. Thank you.
Awesome, bro. Thank you. Yeah, I mean, I believe, we do have a few people from the UK in here. Yeah, so awesome.
Yeah, I'll go next if that's all right.
Go for it.
My name is Oliver, or Ollie for short. I'm from London. Been training for about 3 years. What I'd like to learn from the bootcamp is to trade with facts instead of hope. Instead of having that hope factor, I'd like to know that it's going to work. That makes sense. And I tell myself never to give up.
Awesome, man. Yeah, everyone relies on hope, and that is something that we cover on day 3 specifically, because as much as the charts are analytical, anyone could be a great analyst. But if you cannot have the mental discipline and psychology to trust yourself to actually know what's going to happen using logic rather than hope, this is where your emotions and your fears and all your deepest desires are going to be used against you. So that's pivotal in getting to where you need to be, is relying on facts. Understand how your emotions are being used against you. And false hope is a huge one that we talk about. So consider that done. Just show up on next weekend. Awesome, man. All right, let's get a few more people going.
All right. Okay, I can go maybe? Oh, sorry.
Okay, go for it.
Okay, thank you. So my name is John. I'm from Belgium, and I'm trading for less than 2 years now. And what I'm hoping to learn is like the general algo and liquidity and stuff like that, because I tend to be lost in the market and to be trapped. So I think it can help. And if I can go back in time, I would say believe in yourself.
Yeah.
So yeah.
Thank you, brother. Thank you.
Thanks.
All right, I'm gonna switch gears. I'll meet out here after. Miss Cecilia. Hola, señorita. Let's get her going. Everyone gets to be Cecilia. Oh, you are muted, Miss Cecilia.
Yeah, there. Oh, hello. My name is Cecilia, and I'm from Mexico. And I started learning Forex, learning how to trade a year ago, exactly this coming June. But I cannot say I had never traded. I had only tried to learn and try to find the right academy or the right people. And if I could only say that in this 3 weeks, because I joined the last bootcamp, but the exponential learning that I had from this last 3 weeks of just trading with you, Griffin, it has been like, oh my God, I guess 10 months of trying to find the right person. I just learned it in 3 weeks. And what I want to have as an experience from this bootcamp is just learn how to trade like you do, because you're like a master in this. Learn how to really read the graphs, and analyze the graphs. Like you, it will be awesome. And what I will tell myself, learn Forex and learn how to trade Forex when I was a little girl.
Yeah. Well, thank you, Cecilia. I love having you. I'm looking forward to all the growth you've had, even, to some of you've had just so little so far. Imagine that if you had this a year ago, 2 years ago, right? Just imagine a place. And, a lot of us, it's hard to plan even a year, 2 years in advance, but it's like, even me speaking with the knowledge that, I have, or even some of you guys, if you would have had what you know just a few years ago, even last year, your life can drastically change in a year. And my whole goal is to show you that when you have the knowledge and again, the plan to get there, it's just rinsing and repeating the same thing every single day. And a year goes by like that, right? But at the same time, days feel so long. If we can master a day, we're then able to master a week, master a month, then we can master a year. And that's the whole point of exponential growth, fractality. Weeks inside days, inside hours, that's all fractal. That's everything is in life. If you can master one little thing, you can achieve that on a very large scale. So thank you, Cecilia. All right, let's get a couple more people and then we'll have our good break.
All right. Hello, everyone. My name is Midad. I'm from Bulgaria. I'm Kazakhstan born, by the way, and just 10 years living in Bulgaria. Soon in plans to move to the US. And my experience in trading is from 2018. So I was trading mostly Bitcoin and Ethereum. I was on the crypto market. And I'm expecting to learn how to be more sharp with entries, to know where to take my partials and how exactly to put my stop loss in the right way. And if I could go back in time and to tell to myself, I will tell buy Bitcoin.
That's a good thing to tell yourself.
Yeah.
Jeez. Awesome, bro. Awesome. Thank you, bro. All right, let's get one more person and then we're going to go have a break.
Yeah, name's Brooke Olin, Rags for short. I'm from Sydney, Australia. I'm just here in Dubai. I'm just on a short trip. So I can make it on the boot camp because time zone doesn't work, doesn't help. It's midnight, 3:30 in the morning there in Sydney.
I appreciate the grind, bro.
Trading for 4 years, started with options and then moved over to Forex, hoping to learn from the boot camp, like the way you trade, Griffin, like with all the sniper entries, and the excess 1 to 10 risk to reward ratios. It's almost unheard of in the retail. All the other Forex traders, they make it as 1 to 3 is the normal way to trade. Yeah.
Bro.
And if I could go back to myself, say to myself, 10-year-old self, I'd just say, just learn financial literacy from the beginning.
All right. Thank you, brother. I appreciate it. I'm also glad he signed up for, I believe, a couple boot camps ago. And because of the time difference, you weren't able to make it, right? Are you in Australia right now or are you in Dubai right now?
Now in Dubai.
Yeah. So yeah, I definitely know the time zone is difficult. We do have a couple students from Australia. So those who are international, even, in the UK, I know it's dinner time right now, or those who are even further in Western, Eastern, Western Europe. I appreciate your time. I know it's a time commitment. So I really do appreciate all of you guys. But that being said, take a break, everyone. You got 10 minutes from right now. Let's be back at 3:36 p.m. or wherever you are international. So 10 minutes, we're gonna go ahead and get started. get your food, dinner, dogs, whatever. You can turn off your cameras, do whatever you need, guys.
Hey Griffin, how you doing?
Yes, sir. What's going on?
Just see you doing. Just checking on you. How you been, man? You good?
Dude, I've been living it up to say the least. I've been, Tristan just came down, and then I met up with a handful of guys, and here, Daryl, Earl, and I've just been right now, Mr. East Coast, just chilling on the tip right now. Just been doing a lot to say the least. And boot camp weeks are definitely a grind, but no, man, I mean, I've been doing good. Just busy as all get out.
So yeah, I understand that. Right. I recently hit a breakthrough, and I've been just going crazy.
Yeah. Well, awesome, dude.
Thanks,
Awesome.
Ivan.
Yeah, I'm excited too. We finally finalized some security. So I'll be sending out some updates to the real, I don't want to say the real community, but the full version of the community. I'm gonna be sending out some announcements later today. So yeah, everything's gonna be uploaded. I'm finally got excited, and it's something that no one else is using. So it's gonna be pretty cool, and it's gonna be.
How's the high rise? How's the view up there? Dude, high rise. I was like, yo, holy shit. Okay.
Bro.
You all the way up where the Eagles are.
Right. That's where I'm trying to be at the top, and no way is better than to tell others how to live at the top if I'm literally there. So like just trying to get to the top by living at the top. Just being inspired. Dude, it's great. I love it. It's awesome. So
hey man, I'm happy you're enjoying yourself.
I appreciate
you deserve it, man.
Yeah, it's been a grind to get here.
I don't get to talk to you often because I know you've been working so hard on the infrastructure in the back end.
Yeah, there's a lot that's going to be released to you guys. Adjustments, changes, renovations, and updates. As soon as the whole community joins, we're completely revamping the server again. So we're not the whole server, I don't want to say, but some areas, introducing some new things, which is going to be really cool. But yeah, man, I'll talk to you about that later, and also the community. But side note is that, but yeah, I hope you're doing well, bro. I didn't even say that. I hope you're doing really well.
Of course.
Great trades.
Hey man, look, I'm chilling like a villain, like always. Like talking people's heads off, enjoying good times, making money in these markets. I can't complain. Like I almost got enough saved up to where I can get a house again.
Okay, awesome, dude.
Okay, so cheers to you, and can't wait to see you. Can't wait to invite you over. Yeah. Let's go out for a steak on me this time.
I'll take you up on that, bro. Definitely gotta have it. But awesome, bro. I'm happy, and you've been having some phenomenal trades. It's looked like so. Yeah.
Oh yeah, I've been man. I'm like it finally. I finally was able to detach myself from my bad habits, and it was a lot harder than I thought. But once it like came together, like because I knew it, but it was a whole nother thing to put it in practice. And then once I finally was able to make the adjustments, I'm like, damn, this shit is way easier than I thought. That's what really pissed me off the most. Like, but once I was able to do it, it's like, yeah.
Yes, sir. Awesome, bro. I'm glad. Awesome stuff, dude. And this is where I want everyone to be. And in order for us to get there, you got to get through the boot camp. So, all right, everybody. Well, we're going to go ahead and start. Please return to your screens. Send your, not send, my phone's literally always blown up. Yeah, unpause your screens, mute your mics, get ready, get going. Hopefully have a drink, and not a real drink, but a drink to, or maybe I just do quench my thirst from talking. But let's go ahead and get started. So Awesome. We've covered some of the basics so far, but now it's time to really go ahead and level up. I have to send, unfortunately, this I got to send someone a link real quick so they can join. I don't know what happened with them, but yeah, so we were able to talk so far about everything regarding just some basic stuff and understanding fractality, which hopefully, that should make a lot more sense right now. And I think some pieces might be coming together, but again, this is very basic, very introductory. And now what we're going to do and level up to now is basic, or the next basic part of the equation, which is liquidity. And those who are students from previous boot camps and you even know maybe a little bit about liquidity, this is what's really going to start changing your trading. But before we get to the whole algo of how it's working on every single time frame, right? Because we talked about structure on every time frame, we now need to dive deeper into our conscious understanding of smart money concepts. Okay, so now let's get right into it. Advanced structure 201. Now we did everything structure related 101. Now it's time for us to actually start to approach the markets with a level of mastery when it comes to the basics forms. So, are you ready? Let's get a yes in the chat if we're ready. All good to go? Yeah, Antoine, yes, sir. Yes, Richard, let's go. Azad, all right. All right. Good stuff. All right, guys, girls. God, I gotta get, when I say guys, girls, don't be offended. It's just y'all. I will say that. All right. So yes, sir. Okay. Advanced structure 201. So girls, from the last section, we reviewed in-depth continuation and reversal structure. Okay. We talked about trading ranges and introduced the basic understanding of fractality, waves within waves within waves. Everything is fractal in every single market. Meaning the same principles we use on the higher time frames are the exact same that we're going to use on the lower time frames. So if I was hypothetically going to say, this is how we're going to, this is how, for those who know what points of interest are or not, I'm not expecting you to know them. But for instance, maybe you're looking at structure on a higher time frame, right? And maybe that's your directional bias. Well, on a lower time frame, you're going to be utilizing structure to get in. It's the same thing, just used in a fractal way, right? If you have a higher time frame bias on a lower time frame, once it aligns with that higher time frame bias, you'll be able to get in using that. So now it's time to get into the advanced structure 201 and learn how to master fractal structure on every time frame. So this is where we're going to start. We talked about reversals. We've talked about continuations. But now we need to get more specific in the terminology of it. So the first is going to be what we call our pro trend scenarios. So this is going to be a note-taking page. Pro trend. What does pro trend mean? Because we want to get a little bit more technically savvy, right? A pro trend is essentially the higher time frame continuation structure. So rather than just saying, oh, it's the continuation, what we say is it's the pro trend. It's just the pro trend, meaning it's the higher time frame continuation. So let's say on the 4 hour, right? It looks like this. What are we going to say? Well, the pro trend scenario is going to be bullish, right? We are looking for the 4 hour to go higher. So we know that we have our pro trend scenario, and this is our higher time frames specifically, inclusive of the 4 hour, daily, weekly, obviously monthly, and so on. But at the minimum, the 4 hour. All right. So essentially, when we have our pro trend scenario, I know it might be small for some who are looking on their monitors or their computers, laptops. When we have a pro trend scenario, what we're doing is we need to wait for premium, discount, or equilibrium, again, at the minimum equilibrium, to be met before expecting new higher highs or higher lows. So if our pro trend scenario is bullish and we look to buy, we need to wait, right, until price comes back into equilibrium before it goes higher. So now that we understand what pro trend is, what's counter trend? Now, counter trend and reversal are two different things, but counter trend, pullback, those are the same thing. So counter trend is the higher time frame pullback after a BOS on a lower time frame. Let me say that again. Counter trend is going against the main trend. Okay, so that would mean that there's a pullback on the higher time frame, right? Because let's say the main move was sells. Well, the pro trend is sells. Any buys are just going to be counter trend, right? And we expect counter trend moves to not be long, right? Because the whole purpose of a counter trend is to resume the main trend. So if I were to ask you all right here, the pro trend scenario is buys, but if you wanted to sell, right? If you wanted to sell, this would be the counter trend. So if you're taking any sells based off of whatever confirmations you have, we need to understand that this will be the short-term move in order to fulfill the pro trend scenario to continue higher. So this is where getting structure is going to be pivotal. So we wait for these short-term trends until they meet our pro trend structural range. You have your pro trend, then your counter trend. And then lastly is your internal structure. I know there's a lot of words, but you'll see in the next few slides how they all work together. And pretty much it's exactly all that we were doing. All right, Hutan's joining. All right. Hey, Hutan, we are going over some structural stuff, so I'll catch up with you later. Hey, Hutan, we're going over some structural stuff. I'm going to catch up with you later, bro. Just make sure you have some notes and that you're ready to go. Just we'll start with the next slide, and don't worry if you miss stuff. I'm going to catch it up with you. All right. So the last thing is internal structure. So internal is the lower time frame structure within the higher time frame structure. So remember on the last slide, or when we were going over fractality, right? Well, within one structure, what do we have? We have substructure, aka internal structure. Within structure, there's more structure, and that internal structure is coined its name because it's inside of the main trend, right? So this is all internal within structure, right? This is internal within structure. So you have internal pro trend, aka right here. Then you have internal counter trend, aka right here, which you'll see on the next slide. All right, so that's a little introduction to what we're looking at. All right, so now I'm going to give you guys another few seconds. Got some smart money water. Getting ready to speak the facts. All right. So let's go on to the next one. All right. So this is a basic scenario of what we're talking about here. So we need to understand a couple things. Actually, let me go to the next slide. Let me see. So these two are the same thing, but I'm going to start with a basic version and then a more in-depth approach, right? So this right here, what's our pro trend move? What's our pro trend scenario? Well, our pro trend is going to be that higher time from directional bias, and it's going to be buys, right? We know that we are going to be looking for buys, and this is remember, that's the 4 hour. Well, how do we maximize our time, our money, our approach? Is that if we're looking for buys, great. But let's say this is where price currently is right now. In order for us to go higher than this point in the future, we need to return lower into the range before completing the expansion, right? So this is where it's important to note that when you have this low and you have this high, this is right out of the gate. This is your trading range. You are looking for buys anywhere in between here, right? It can mess around and do all of this crap, right? It can do all of this and just trick you. As long as this low does not break, we're still buying, okay? So that's the first point to note. The second thing is anything within side of this range that ends up moving, This is what we call a complex pullback, or our complex bearish pullback. The whole point of our complex pullback is to cause a pullback in order to go higher. Now, specifically on day 3, day 4, you learn about algo stuff, what happens in between everywhere, but this is how you can be approaching it. Anything inside of the range before it actually buys and continues higher, this is all the complex pullback. So we have a complex pullback into discounted price, and then thereafter we look for price to resume our higher time frame bullish structure. And this will be repeating over and over and over again. We have countless examples. In day 1, we do everything from PowerPoint, everything from Google Slides, even all the examples. So we have to go over all the basic ideology before we get to the advanced and the big boy stuff, big girl, big boy, big girl stuff. So, all right. I'll give you guys another 30 seconds or so on this. All right. All right, I think we're all good. So let's go to the next slide. Let's have a little bit more in-depth look at this, what this really is showing us. So this is the advanced structure portion of it. So now we know what a complex pullback is, anything between the range, but now I want you guys to mark and specify what everything actually means, okay? So within here, we have, if our higher time frame structure is the main push, this is what we're looking at. Our main push, AKA higher time frame, is what? It's buys, right? That's our pro trend. Our pro trend scenario is we're looking for buys because that's what's happening on the higher time frame. But we need to know with fractality or due to fractality, there's individual trends happening everywhere. But what we have to do as these detectives trying to solve the mystery and figure out what the end goal is going to be, we need to figure out how it's going to get there. So in order for us to make it look like this, remember, it's going to always look, I'm going to start from the left. All right, so left to right. This is our 1 hour, the higher time frame and our lower time frame. You're always going to have structure inside of structure. If you're doing more than 2, you're doing it wrong. Okay, higher time frame. Main push is the higher time frame. So now just notice the flow of how price is always just going to be utilizing itself in order to transition. Okay, when we see this happening, we need to understand that the internal or that lower time frame structure, maybe this is the 5 minute, right? Maybe this is the 5 minute and the black is the 1 hour, whatever it is. The 5 minute is we're buying, but it's also aligning with the higher time frame. So what we can be doing is looking for buys. So this is called our internal pro trend. If we are aligned with structure, we can be buying on our lower time frames because we know we're going to be targeting, right, our higher time frame structure, ideally. Of course, we could be looking to buy here, but as soon as we get a break of structure on that internal pro trend scenario, now what's happening is our higher time frame is still buying. We're still buying on the higher time frames, but now the internal becomes counter trend, right? Because now we're looking to sell. So what this is telling us is we can be taking our short-term sell positions. Why? Because we know that the whole purpose of internal counter trend is just to come back down to our main pro trend area. So this is where we're going to be looking to buy. Once internal counter trend comes down, these are all those small hedge or those small positions you can be taking short term. Do not look to hold long-term internal. Don't. It won't work. Okay. Now, again, what happens after internal counter trend breaks structure? What happens? It then resumes to internal pro trend. And what do we know about internal pro trend? Well, it'll just continue the higher time frame. So what can we do? We can utilize our lower time frame structure to then get in and target our higher time frame whatnot. And then, of course, what do we think is going to happen in the future? The same thing. We can assume that based off of this, price will make new legs. The same thing will happen. Maybe next point. Maybe we're going to be looking to, I don't know, buy from here. Who knows, right? But what does it have to do before it gets to here? Well, it's going to have to have internal. So internal pro trend. Well, what if it does this, right? Well, it doesn't really matter, but no, it does this. Break a structure. What are we going to look to do? Target the higher time frame. Just understanding the flow and being able to memorize how price is always delivering, very important. For the slow main. All right. All right. I think we're all good and looking at everyone. All right. I think we're all good on this. All right. So now that's the first scenario. So now, so we're going to example of this. Structurally speaking, so our bearish complex pullback within our main structural range, okay? We have a high, we have a low. Where's our trading range? From this low to where? This high, right? From this low to this high. Now, again, this was a previous markup, but within this range, what do we have? We have structure inside of here. So now let's try to figure out this structure. Don't worry about this point or these right here. Don't worry about these two. I mean, change that from last one, but let's figure it out. So let's see, within here, we know we have all of this internal structure, but how do we actually approach it? Well, this is, I mean, some fractal understanding. You guys might not be able to see this right off the bat, so don't worry about it. All right, so right here, this is kind of what we're looking at for some of the internal structure. Now, this is lower time frame stuff. I don't want to confuse you all with this, but essentially this is what we have here. So now looking here within this leg, we have waves within waves, right? So we have this, right? Because this is higher. This is higher, yes. This, right? And then we have this. This is not a pullback. That's literally one candle. And then we have this here, and then this. So now my question becomes, what happens? This is a break of structure, right? On our lower time frame, we have a break of structure. So now I want to ask you, is this break of structure tells us what exactly? It tells us a 5-minute break of structure tells us we're having a pullback on the 15-minute or the next highest. Lower time frame BOS tells us at the least we're having a pullback on the next highest time frame. So we know that we want to be buying long term. That's how, that's what we're going to be looking for. So of course we look for our buys. And then once we know what we're going to be looking to buy, which you guys will come to learn today, is of course sells. So how can we look for sells? We have our break of structure here, blah, blah, blah. And what do we look for? Well, we could be looking for sells. So where's the next low that price does? And make some form of retracement. With, of course, our mastermind protocols students, we know how we can enter all of this. But for instance, we know we have now a lower low, a lower high. Where's the next structural point? No. It's here, right? To make a new low. Now let's think about this. Higher time frame is just buys. On the 5-minute, we have bear structure still. So we have two structure forces that are going against one another. Sells over here, right? We have sells here, and then we have buys on the higher time frame. Which one do I choose? It's going to be the higher time frame because that's a pro trend scenario. So this would enable us to be getting in for a short-term sell, right? For us to then target here. But then how do we actually get in the buy scenario? Well, we're looking at this higher time frame. Of Of course, you'll be learning how to get in here, here, here. But for this example, purely basing it off of structure, this is that lower high that needs to be broken, right? This is the structural lower high that needs to be broken. So what happens is now after this lower high breaks, because it made that last internal lower low. I feel like I'm just talking right now. You guys aren't seeing what I'm saying. Again, higher time frame is buys right here. Higher time frame, we are looking to buy. Here is those cells that we're talking about, right? The purpose of these cells was just to cause a pullback for us to resume the buys. Pullback, sells, pullback, right, sells. Now, again, in order for us to get in buys, let's say we had some form of buy over here. Well, how can we get in this? Based off of structure, we can see, well, all right, well, let's wait for a break of structure because that's telling us when it's going to align with the higher time frame, right? Oh, it breaks structure. I then want to look for price to come down, then to do what? To target the higher time frame, right? As we've talked about, diagrams are the same thing as structure, exact same. You just have to see it. Oh, yes, we had a break of structure. Where do I want to buy? I don't know. Where do I want to buy? Guess what? You can then enter your buys in, and then where are we going to be targeting? Higher time frame at a minimum for our first target. So then you can literally be able to utilize and understand what's going to happen where. Now, of course, I want y'all to get to the point to where you can take all this. I mean, literally any move you'll be able to take. But this is where it comes. You understand what's going to happen where. You understand how to utilize the different time frames to get there. And then it's just fulfilling that pro trend scenario. So follow the higher time frame. You can utilize the lower time frames for some small pullbacks, but don't expect them to continue, or else you're just going to be holding a losing position and continually adjusting your stop loss, as all of us have done at some point. All right, second thing, going on to now the premium price. And then finally we can be done with structure. Now this premium, right? So, or my complex pullback starting. First thing, what trend are we in? We are in a bearish trend. Very clear, very evident. We know that we're selling down. Now, based off of premium discount price, what do we look for? We look for price to at least come back to 50% or the equilibrium of the range. If not, and ideally come to premium. And last, what we just talked about is everything all in between the trading range. All of this is a complex pullback. The whole purpose of it is to, right, cause a pullback in order for us to go lower. Of course, there's more specifics, not spoiling any of those today, but it's to, yeah, just do that for now. So the whole purpose is to cause a pullback to continue higher. And again, it can look like this. It can do some really crazy stuff. It can do all of this, just tricking you. But as long as you know what the higher time frame is, you know how not to get trapped. And guess what? You're still going to be looking for sells no matter what. So that's what our bullish retracement or bullish pullbacks looks like. Higher time frame, bullish pullback. And then guess what? It'll resume that higher time frame to then continue lower.
Our bullish pullback is on the same time frame, or are we saying you drop down to a lower time frame, then you'll see the bullish pullback?
Good question. So you'll see the bullish pullback on the time frame you're looking at, but the structure will be on a lower time frame. So this bullish pullback, right, on your structure on this time frame, it'll look very clear, right? It'll look something like this. It'll be clear. But on a lower time frame, you're gonna mark the individual structural points. That's when you'll mark them. So you'll be able to see it on that time frame. There's an example I think I'll show you. But yeah, go to a lower time frame and identify that complex pullback. All right. So now let's look at just the same. All right. So the higher time frame pro trend scenario, we know that we're looking for sells, right? We have low, we have a lower high that made a lower low. Of course, made a lower low. So now we have a lower high and a lower low. Based off of our understanding of price thus far, we know that ideally we are going to be looking for what? Well, higher time frame is sells. We know that we want to be looking for sells. However, in order for us to sell and go lower, we have to return to equilibrium, premium, or discounted price. So when we're looking at this, where is our premium? Premium is going to be the upper 50% of the range. This is where we need to look for price to come back to. And we want to notice the change in state and delivery of price on the lower time frames. Of course, within one structure, we're going to have another type of structure, all within one another. Okay, so our pro trend scenario is sells. We know that we're looking to sell. This over here, our pro trend is right here, the black, the higher time frame, and then our internal pro trend is right here. It's on the lower time frame looking for sells. So you could be taking all these sells, great, great, great. But at one point, the sells are now going to be converted, and we're going to now enter phase 2 of trend shift, right? We're going to be doing that. And what are we going to look for price to return to? Ideally up to equilibrium. You guys will learn exactly the point later on. But now, so you're looking for buys, right? Now this becomes our internal counter trend buy scenario. The whole purpose is to buy a bullish pullback in order for us to sell lower. So exactly as you asked, Earl, right here, lower time frame, this will be the structure in order to then the time frame for it to align back to that bearish scenario. So when at this moment in time, when we're looking at price, ideally, of course, oh, well, right here, we're looking for buys, which would be great. So what do we think is going to happen? It'll either go higher from here, or if that doesn't happen, it'll fail. And of course, what we know is it'll do the second of the two, right? It'll then have a break of structure. So now after coming to premium price, after giving us a break of structure, what do we look to do? Well, we're not going to be looking to sell up in here anymore, right? It had a break of structure. So now we're going to be looking to sell in here. And then we identify our equilibrium price. Of course, price will repeat this, even make fractal, right? Do the same thing it did here, just on a 1 minute. And then do what? It'll probably make a new low, right? So then guess what? Where's your new range? From here to here. And you'll probably be expecting, ideally the same thing, right? And then to go much lower. And we're utilizing this purple or the lower time frame to target the higher time frame. And do extensive backtesting on this. You'll see it'll always happen. And you'll realize, wow, like this happens all the time, every single day, every move, asset, whatever. So this is how counter trend, there are buying opportunities, because think about it, structurally, we're bullish here, right? Ideally look for equilibrium and be buying. And that's how we can understand. So you can be taking ideally any move in between, as long as you know which ones are counter trend and which ones are pro trend. That's going to tell you if you can potentially swing or hold a trade longer than you should or could and not get out early.
And really and truly, pro trend is just 4 hours and above.
Mm-hmm. Yes, exactly. So this is how, and I know this is day one, pretty, going over some stuff pretty fast, but once you can master this, you're over. You do not get a copy of the slides, but there is an opportunity for you guys to receive all the diagrams as seen in the boot camp, and we watermark them with your name. So again, security reasons, but yes, there is an opportunity for you to get all the diagrams. Yes, sir. All right. I think we're all good here. Yes. Your success is my whole goal. That's the whole, anything I can get and give to you guys. The bootcamp is just the beginning. Everything else is what's to come. That's where the whole journey is. So, all right. I think we're all good on this. If you guys need another minute, please type 1 in the chat. And if not, we'll go ahead and continue. All right, I'm not seeing anyone need any more time, so good stuff. Okay, we're getting the hang of it. All right, so quick example of this. What? Well, we can clearly see we have some form of high over here. We have some form of low. And then, of course, it's just rinse and repeat. Where's the low that's broken? It's broken over here. Where's the lower high that did it? Right here. So now where's our new trading range or our structure from this high to this low? So now what are we expecting? Anything in between here is going to be a complex pullback in order for us to be going lower. And don't mark, if notice how I'm utilizing different colors for different structures. If you're going to mark structure, don't use the same color. You're just going to be hurting yourself. For instance, if you're colorblind, blue, green, don't use blue and green. Use a different color. But this is going to really help you get level understanding, because exactly what I'm doing, you can do this on TradingView. And I would recommend it if you're practicing even using this. Even there's a line tool or a line graph, and it looks just like this. It's very easy. Diagrams show you how to apply scenarios without being confused and looking at all the different candles and, well, what is all this? I don't know. All right. So if this is that pro trend scenario, we understand that there has to be some internal counter trend. And where do we know the internal counter trend will start? Based off when the pro trend or the internal pro trend discontinues. So in this instance, let me go here. Now in lower time frames, again, this is just fractal understanding here, 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 here. This break of structure was the first indication we were going to have some form of pullback, right? So now anything after this point is just going to be a pullback into for us to sell. Okay. So now here. This is the last valid structure, right? So are we going to be marking any of this? No. Why? This is not telling us anything. So this, however, does. We now need to be looking to buy within here, right? Buy within here in order for us to do what? To target a new high, because all the purpose of this is to continue higher. So then, of course, what ends up happening after this? We have now a new high, new low. Price comes to where we're looking to sell. How do we enter? What do we do? I just want to spray and pray. Enter and close. No, it's lógico. No, it doesn't make sense, right? It's impractical. We need confirmation. So how can we actually enter this? Well, if this is the structure, let's look to the right? We get our reaction, and this is at this point, this is counter trend. This is our internal counter trend scenario. So what do we need to do before we enter? We need to wait for it to align with our pro trend scenario. And guess what? BOS. Boom, we're ready to go, locked and loaded. It's now aligned with our higher time frame. What do? Now we look to sell and continue back to our higher time frame structure, right? This is where we're going to look to go ahead and continue the sells. So how can we do this? Well, same thing. We have now a low, a lower high. This in the next section, you'll be learning why this happened. Oh, lower high, lower low, lower high. Oh, it broke structure. I don't know. There's a reason why this, and some of you guys already know it. But really, structurally, we're just going to be looking at this right here. I mean, think about it. We're already looking to sell from the higher time frame. Then this happened, and then this, and then this, and then this. It goes down. So you'll be learning how to enter here, right? Here, knowing how and why to get out here, how to sell right here, how to target here, how to head. Like you'll be learning to ping pong everything. But this is how we approach it. Always utilizing the lower time frames. Once they align with higher time frames, it's done. We know where we're targeting. So that's what our complex pullback scenario looks like. Type A1 in the chat if you need some more time. And if not, ready to go. All right, good stuff. I'm loving what I'm seeing so far. We can keep picking up, because I know this has been a long day. Damn, hours already. Okay. All right. So key structure takeaways, and then we can move on to the fun stuff. Key structure takeaways. With your life, I would definitely mark down this chart. This is going to help you. And essentially what I'm saying here is X time frame break of structure equals X time frame pullback. So like we talked about, a lower time frame break of structure equals a higher time frame pullback. That's it. If you have a 1 minute break of structure, that's a pullback on the next highest time frame, maybe the 5 minute. If you have a 4 hour break of structure, it's going to be probably a daily or a weekly pullback. And this is just really good to start getting the juices flowing and understanding how the market, how the structure is always working together. But again, imperative to know, BC is changing. But you need to know this first. I mean, again, if you utilize this alone, you'll be profitable, you'll be successful with it. But we don't just want to be consistent. We want to become the 1% and doing what no one else is doing. So I'm not going to say anything else about that, but definitely write down this chart. One of the other most important things to take away from this is a BOS does not guarantee retracement. Not at all. A BOS helps you understand or change a character, but how many times has some of you guys who are very advanced with structure or traded SMC, how many times have maybe you looked for a structural break, but then it doesn't work and you just lose? That's one of the main reasons SMC is failing nowadays, because people are applying the concepts illogically and not correctly. And, you know, I say this, and when people ask me about concepts, we need to understand that just because you know something or conceptually know how to do something doesn't mean that you can apply it properly. And an application and conception are two different things. Like, for instance, we all know that 2 + 3 = 5. There's no debating, don't care. Let's keep it simple. 2 + 3 = 5. But now, even though we know 2 + 3 = 5, what if you see this? Yes, 2 + 3 = 5, but what if you do 2 + 5, 2 + 3 = 5? Oh, yes, that's 5. Oh, times 3. Oh, yes, I'm Albert Einstein. That equals 15. Oh, I'm so great. But what was the key factor that we did wrong? We didn't apply it correctly in this instance. We didn't apply and understand that 3 × 3 comes before an addition, PEMDAS, right? We all at least should be familiar with order of operations. So for that reason, if you fail to multiply 3 × 3 first, your answer becomes wrong, right? You have 3 × 3, which is 9. I'm thinking about whatever. 3 × 3 is 9 + 2 = 11. You will get the wrong answer if you don't apply it correctly. And that's where everything comes into trading. Even though you know how to do something, that doesn't mean you actually know how to do something. And SMC is no different. You can see structure, you can see breaks of structure, but if you apply the wrong or the right concepts in the wrong ways and have the wrong perception and vision, it doesn't matter. You're still going to lose. And sometimes it just takes someone to tweak your perception a little bit, so then you see what's right. For instance, a quick solve. How do we know it was wrong? Even though what you know didn't change, you add just a little tweak and say, oh, multiplication becomes before addition, and then you get the right answer. And even that's with me, is even if you guys think you know a lot already, I guarantee you there is going to be a lot of stuff that you've never even heard of before. And even if you think you have, or maybe it makes sense to you, having a little bit of a perception tweak is what's going to be the most drastic result. All right. So most important right here, higher time frame structure is key. Don't get caught up in the small time frames until you're able to view the whole picture and where it's going, right? Of course, we've all heard higher time frame structure is king, meaning when you know, even though when you know how to master lower time frames, don't get caught up on the 1 minute, 30 second, even some of our insane traders, Hunter, 15 second. Don't get caught up in that. I don't even do that. That's too perfect. I don't need that stress in my life. I'm making my money getting out, like crazy. But follow the higher time frame. Don't get caught up. Don't get, greed will always happen. Fear will always happen at some point. but you need to understand how to remain logical in every scenario. Structure always comes first. Doesn't matter what else you're looking at, anything to come after when you learn about everything else. If you're on the wrong side of the structure in the market, doesn't matter what else you have. A true BOS, of course, as we've talked about, and I don't think I illustrated this. Let's say you have something that looks like this, guys. Is this a BOS? Or is this a BOS right here? No, none of them are. Why? Good job, Daniel. Because this is the range. This is the buy range. It can do anything all in between for us to be going higher. And this will oftentimes happen before we go higher. So BOS, you must have some form of structure. Now, let's say this. Same thing over here. Is this a BOS? No, no, no. Good. Because this low did not make a higher high. Now, if it looked like this, yes, then it is. Okay, cool, cool. Also, as it pertains to candle closures, do not, even if a wick takes out structure, it's a break structure and a discussion. People say, oh, you have to look for a candle closure. Oh, that's the dumbest thing I've ever heard of. Why? When you look at this, and I'm gonna be honest, sometimes I'm too transparent, too honest, is that let's say you have some structure, right? You're looking at your structure and maybe it looks like this. And maybe right here is your last low, this is your high, and you see a wick. Just being honest, how many people wouldn't say this is a BOS because of a candle closure? A lot of people look for a candle closure to close below structure. Is there anyone in here like that? I'm not going to bust your ball. I just want to know. I genuinely want to know. Is there anyone who looks for that? Okay. Yeah. Okay. Well, cool. Well, that is wrong. I hate to be right up front, but that is wrong. It must be a wick. Because why? Fractality. What is inside of a wick?
More candles.
More candles. There's candles. Literally, candles are inside of a wick. It's very subjective. Oh, if it doesn't close below. If you go to the 1 minute chart, I guarantee you it closes below. The 15-second chart, I guarantee you it closes below. Therefore, always consider a wick. Screw body, screw momentum. It's a myth. You can understand why and at me. And once you understand, wow, I actually didn't make any money listening to these people because they actually had no idea WTF they're talking about. No. Candle closures, no. Those are something we utilize for less than a 1 pip stop loss for when we're entering. Anything else regarding candle closures? No. If it takes out structure point, if even a wick takes it out 0.1 pipettes, no. And the reason I say this, and as I had some discovery calls you guys illustrating, is that on your USD, do you know how much 1 pip is worth? Give or take. $1 billion of liquidity. People are talking about, oh, I need to see a candle closure. No. $1 billion of orders have been taken down to move price lower. If it goes lower, there is some reason that is happening. It's not just, oh, a candle closure, just for all the volume and everything. No. If it's going lower, it's for a reason. And we need to understand that reason on the most fractal level. So candle closures, doesn't matter if it barely takes it out. No, candle closure are relevant. And I mean, again, take what I say, but at the same time, do it. Look for yourself and you'll see that it'll make so much sense. You're like, oh, wow. Okay, this actually makes a lot of sense. So that's essentially all that I'm saying here. Structure comes first, but understanding market structure and bias is crucial for any winning trading strategy. However, with SMC being a big form of liquidity, smart money concepts, many traders are induced into seeing the wrong structure points. Because as we talked about first, we need to think about first is, well, if the institutions know what all types of traders are doing, do you think we have another hour or two left today? That is a good question. Yeah. So today we are definitely going to be having at least another hour, I would say. I'm going to try and wrap it up in an hour, if not hour and a half. I will not be going over 6.5 or 7 hours. I guarantee you I will not. So If you guys need to go do your thing, whenever we have a makeup session, if you need to join, that's fine. But definitely this is to get into the important stuff. Structure is, this is the longest I've ever spent on structure, to be honest, but it's also the most important. So whoever's ready, of course, I'm talking, I'm wired, I'm all amped up. I love doing this. So yeah, just let me know. But all right, guys, girls.
Well, don't lose your train of thought. You were just about to say something. Oh, you were just explaining something. Okay.
I think he was about to say something about being a lot of traders being induced into seeing the wrong thing.
Thank you. That was a good point for me to say. So a lot of traders are induced into seeing the wrong thing. So if the institutions know what you're doing, and if they know what you're looking at, and we know that they want to manipulate the markets to go against what we think we see, this is where structure almost becomes irrelevant. And this is when last boot camp, I'm going to mention Braylon. He was like, oh my God. He freaked out. He had like a total epiphany on like, I don't know, day 2 or something. And we didn't even talk about it yet. And, but it's like, if we see structure and we know all other types of traders see structure, and let's say we're looking for buys, how do they manipulate this so we're seeing the wrong structure? It completely tricks everyone, but that's for later. That's for later. Little cliffhanger. Anyways.
And you also said, 1 pip is $1 billion move.
Mm-hmm.
Got you. So that's why wicks are more important than the body of the candle. Why do most traders focus more on the body of the candle?
Good question. So when traders think about what makes sense to them, is they're thinking about, all right, candle closures. There's a few things retail traders are thinking about when it comes to candles. They either look for a lot of wicks. Why do you look for a lot of wicks? To see where all the rejection is, right? That's what makes sense for retail. But what makes sense for institution is literally the opposite of retail. Oh, there's a lot of rejection. I want to sell there. Well, guess what? Coming in this liquidity section, you're going to learn specifically why. There's a lot of rejection. This is what makes sense to retail. Oh, rejection. I want to get in here on the rejection. It'll screw you, right? Because by the time you see it, it's too late. That's the first thing. The second thing with candle closures. What do retail traders think about candle closures? Well, one of which is if you have a huge bearish engulfing candle, oh, great. I have a huge engulfing candle. I want to be going lower. Partially true, but ideally that you want to look for a huge candle closure. Oh, it's going to give me a lot of, hope because this is where all the orders closed or wherever it was. That's where the majority of orders were in the marketplace. And that's what they think. Same thing is if you have a huge engulfing candle and prices rapidly running up, I gotta slow down. I'm all amped up right now. When there's a huge candle and price is doing this, what's the first thing every retail trader thinks about doing? Buy. Institutions know you're doing that. So what are they going to do? So they're doing everything that you're doing wrong. So we know how to, we must know how to win in order, we must know what's wrong in order what's right. And as I said, EU was about $1 billion of liquidity every pip. So if every pip is intentional, that means even if it just takes it out by 0.1 pipettes, there was some reason. So therefore, any retail logic has no relevance in an institutional approach. And I will better assess, and I think your question will be even more answered in this next section. All right. Each pip is $1 million move, and $1 billion. $1 billion of liquidity in EU. All right, so now let's get into some of the fun stuff. Liquidity, as this whole bootcamp is really about. But this is some basic introduction to understanding what liquidity is. So some of you guys have maybe never even heard of the term liquidity before. Some of you guys might think you know it, but this is where we're going to change everything drastically, especially tomorrow, which is the first intro day to everything to come. Liquidity is what drives the market. So firstly, liquidity is coined the term that refers to all The available liquid, or it refers to all available assets, liquidity, right? If you have liquid stock, if you have liquid whatever, that means you have that, you can instantly take that thing out and you can sell it and you have the money at your own disposal, right? But specifically, we need to talk about what liquidity is in the foreign exchange market or any financial market for that reason, as we're going to be seeing it. So liquidity, and I will heavily emphasize this. If I say something, write it down, because I do not write everything down on the charts. Liquidity is the continuous exchange between buyers and sellers at the very most basic level. When we talk about liquidity, we need to think about money. We need to think about, where is the money in the marketplace? What is actually driving price? What's going on here? Well, we need to understand that that's happening. Okay, so continuous exchange between buyers and sellers. We always have buyers and sellers in the marketplace, and these fluctuations is what's causing the so-called structure. And if buyers are winning the marketplace and sellers are losing, well, clearly we're going to be going higher, and vice versa. So additionally, is liquidity is what keeps the markets moving and what the markets are naturally gravitated towards. Very important note. So if I had to make this, I'll save that for tomorrow. All right. So liquidity is what moves the markets, and think about other people's stop losses, AKA liquidity equals retail stop losses. Literally put that in your notes, star it, put it as your background. Liquidity equals retail trader stop losses. So naturally, in order for the markets to go anywhere, stop losses need to be collected before that move actually happening. So it comes in the form of stop losses, pending limit, and stop orders. I know definitely some of the older traders are in here, and I would like to know as well. How many times have you guys maybe heard of NFP or news releasing? What's a very common strategy that someone will utilize when news comes out, for instance, if they don't know the direction? If someone wants to say, unmute their mic, what's a very
buy or sell orders?
Yeah, right. Like typically, if you have something that looks like this, we know that and let's say that the market's right here, right? Well, you're either going to have some form of buy stop above here because you want to catch the moon, right? Oh, it's going to go higher. Or you're going to have some form of sell stops because you want to catch the sell off, right? That's what a very basic strategy that every retail trader knows, at least older ones. They know that this happens. So what happens? What do they think? Well, as soon as one enters, they just close one position, right? Well, think about it like this. They know that this is going to happen. How can they manipulate that variable? Well, if we have some buy stops above here, guess what's going to happen? Maybe we have some equal high or resistance per se. Buy stops from above here. Institutions will fund their own money. They're going to cause a move to happen that's going to enter your position. You're going to be dumb. You're going to close the one in the opposite direction. You're going to be like, oh, I'm making so much money. Buy. What do? They're going to take you out. So this is how we need to understand liquidity, is that whenever you see someone's stop losses, wherever you believe stop orders are going to be, pending limits, anywhere the institutions can cause you to lose, that's where liquidity is lying. And a very common saying that, that you guys have heard before that we say is, if you don't see the liquidity, you are the liquidity. So we need to think about it this way. I don't want to confuse any of you guys. This will be a little confusing, but keeping it basic, right? Liquidity is what moves the markets. Structure is great, but liquidity is king, and you guys will see that tomorrow. But yeah, so this is what basic liquidity is, and it's all part of supply and demand, but it's much deeper than that. Being able to really master the markets and become a mastermind is understanding everyone else's position in the market. And you need, trading is so difficult because people want to focus on themselves, their profits, their wins, their losses. But how do great people learn how to become great? You learn from others people's losses. And Daniel, I'm going to ask you, I think we've talked about this. What's the one common quote about history? Those who don't.
Yeah, those who don't learn from history are doomed to repeat it.
Same thing as with the markets. If you don't learn from everyone else's losses, you're just going to fall right into the trap of everyone else who's ever given up, lost a whole bunch of money, or don't know WTF they're doing. So this is where we need to do the hard things, which no one wants to do, is learn how to lose. You'll never hear anyone talk about, oh, I'm going to teach you how to lose. No one wants to do that, but I'm teaching you how to lose so you know how to win. And that's how we're doing it. All right, cool. Let's get on to the next slide. Okay, so furthermore is, what does liquidity actually tell us? Now let's keep it basic for now. The operations of all financial markets, and their segment are based on liquidity, as it tells us these key things. It tells us where price has been, one of which, and you're gonna have to write these down. I'm not gonna go through every individual example, write them down as we talk about it. So it tells us where price has been. It tells us where money is lying, AKA 2 and 3 are the same. It tells us where money is lying. It tells us where price is going to go. And most importantly, it tells us how it's going to get there. So liquidity is what's going to change your understanding, is going to change you into being this next level trader. But today we're only talking about 2 types, which everyone knows, let alone tomorrow, the 10 plus different types. So how price is going to get anywhere is you need to take out liquidity, AKA collect someone's stop losses, and then to target someone else's stop losses. And this is how liquidity is working. This is the never ending and the repeating cycle of liquidity. I would definitely mark this out. Again, anything related to liquidity, the sooner you master liquidity, the sooner you're going to win. I mean, if I'm being honest, master liquidity before anything else, because you'll be able to know direction, what's going to happen where, and have this whole operation in your head before it even happens. And yeah, I get too amped up talking about it, so I'm trying to chill out. But always remember that these operations are present on every time frame, and it's a never-ending cycle. So for these reasons, key before we moved on, we sell above liquidity and we buy below it.
Question. So this, have they always done it like this, or is this now just the era that they're
Always, any market that's ever existed, this has always happened, and it will never change, ever. Because liquidity is if there's no liquidity in a market, the market doesn't exist. Like, liquidity is literally everyone buying and selling. If no one's buying or selling, the market's not going to exist. So the only way for the markets to move anywhere is if you collect someone's stop losses to go there, which we were talking about in the little intro tomorrow. Is me mind blowing, to say the least. But we need to understand, in order for the markets to go anywhere, you need to collect enough liquidity or gas in order to get there. And that's where we understand, oh, wow, this makes a lot of sense. Oh, wow, nothing is actually random. No, any move you can understand and be able to reason. How many times have maybe you guys had a loss you didn't understand, or used whatever retail stuff and you didn't know why, and you tried it again and you still lost, or maybe you can make a reason. What we teach you is, if you lose, you will instantly know why you lost, because it's your own error, and you were willing to take the risk on it. Why. For stop losses, for instance, how many people have used 15, 20, 30, 40, 50, God forbid, 50 pips and above stop losses? Probably a lot of us at some point, right? Well, our stop losses are really maximum 3-4 pips, if 5. I mean, some of our traders only take 1 pip stop losses, and you're like, oh, well, they're going to lose so much. No, no, because on the seconds time frame, it's going to be the exact same thing on the monthly time frame. It has no relevance. So let's go ahead and dive into more about liquidity understanding. But that was a good question, Earl. It'll never change. This is how it's always going to work. And as manipulated as the markets are, they're regulated. All markets are regulated, even decentralized, like crypto. I mean, dude, there's blockchain now. You can see all transactions. You can everything is meaningful. And this, which we'll be learning more about. So now SMC liquidity types 101. If you don't see the liquidity, you are the liquidity. If you don't see where everyone is losing or where people's losses are, you are that person. You are that guy who is going to lose. You're not that guy. You are unfortunately that guy. So now let's understand this. So the first type of liquidity, equal highs and equal lows. I'm going to give everyone a minute to draw these or write this out, and I'm going to draw this with you. All right, so the first type of liquidity is equal highs and equal lows. All right, so I'm drawing two little figures over here. All right, so equal highs, equal lows. When we're looking at this, and I'm going to draw this for each with 1, 2, 1, 2. The first type of liquidity is equal highs and equal lows. 2 reasons. There's always a purpose and intention for any move in the market. Doesn't matter. You need to know how to react. The first thing, let me ask someone who has some retail experience. Maybe Jaban. I'm gonna ask Jaban if you're around. I'm not looking at the screen. But when you see something that looks like this, Jaban, when you're looking at possibly this right here, what is the first thing going through your mind when you're looking at this?
I'm waiting for some type of confirmation.
To do what ideally though?
Sell from a resistance.
Sell right there.
Yeah. Okay, cool. That's all I was getting at. But yeah. So to sell, right? You're looking ideally someone who's looking at this. Oh, we have 1 touch, 2 touch, 3 touch. Everybody is going to be looking to sell from a resistance, right? You know, everyone's buy it, support, sell resistance. This is the first type of trader of what they're going to be looking at. The first type of trader here, and there's 2 types of traders that are looking here. We have our first type. These are what we're going to be calling our resistance traders. Our resistance traders. I'm just going to put res, right? Resistance traders. So the first type of traders, what are they doing? Well, where are they going to enter? They're going to wait for price to come ideally up into their area. And what are they going to expect price to do? This is what they're believing is going to happen, right? That's what they think. But it's a good thing that what they think is going to happen isn't actually what's going to happen in the marketplace. And what do we know about where they're looking to sell? Well, if they're looking to sell here, where their stop loss is going to be, right? How many people have maybe said 5 pips above a resistance, 10, 15 pips above a resistance? Everyone at some point, right? So if your retail entry or if your resistance entry is going to be here, right? This is your entry, let's say on a zone. Well, your stop loss is generally going to be what? Above the zone, correct? Which should make sense. So now let's think about this. They want this to happen, but what is going to happen is their stop losses are going to be collected, aka liquidity. There's think about stop losses. Where is a retail trader's or resistance trader stop loss? It's above highs. So what happens is the market's about liquidity. We are going to be collecting their stop losses. Institutions will collect their stop losses and then cause price to go. This is the first type of trader who's losing here. And resistance trader, they're the ones who are losing. And what do we expect? We expect the market or the institutions to take out their positions and then go lower. So resistance traders are traders who get in too early to a trend or manipulated into seeing the wrong direction. Now, the second thing I want to ask Ollie is if the first type of trader is resistance and they're looking to sell here and they're getting stopped out, what's the other type of trader who is looking at a similar scenario?
Support trader.
Support traders, right? Because support traders over here are going to be looking at this, right? Oh, we have 1 touch. We have 2 touch. What do you think is going to happen? Oh, I'm going to make $1 million. I'm going to risk my whole account on this trade and it's going to go to the moon. Oh, it's going to go. And then what will happen? Guess what? Their entry is going to be right here. Where's their stop loss? Below the level, right? So their stop loss is going to be here. So what's going to happen? A little bit of hope, and then price is just going to take them out drastically. And then what's going to happen? it'll go the opposite direction. So they were right. And that's why it's like, how many people's like, I was so right. If I just held it a little longer, blah. No, like that's what they want you to do. All the shoulda, coulda, wouldas doesn't apply, right? So this is support traders. And this is the second right over here. If I had to talk about the next first type, are support traders. We look to buy below a support, buy below a support. Now, these are the first types of traders in every scenario. But now let's take a little bit deeper look at how we should even more approach this. Let's say that we're in an uptrend right now, right? Let's say that we're in an uptrend right here. We have traders who are looking to sell at a resistance, but what are the other type of traders who are viewing this as some form of opportunity?
Breakout traders.
Breakout traders, right? Think about it. Stop losses. Where are stop losses? Where are money? Where are orders? Breakout traders, they believe if this high is broken, they believe that what? HODL to the moon. No, that's not going to happen either, right? So think about how smart these institutions can be. Now, some of you guys may all know what equal lows is, but I guarantee you don't know the actual specifics behind it, why we actually consider them liquidity. Breakout traders, they are looking to do what? Their buy orders are right here. They are looking for this high to break and them going to catch the moon. But what's actually going to happen? Their order, right? If those breakout traders who have their buy orders here, their orders immediately enter. They're like, oh, yes, yes, yes. I maybe want to enter more positions. I'm getting so happy. But guess what happens? Simultaneously, while these breakout traders' orders are being entered, those traders who are selling, their stop loss is getting tapped. So guess what? As soon as the stop loss has been tapped for those who are looking to sell, what do we think is going to happen? The stop loss of our breakout traders is going to be trapped. So neither type of trader will make money in this scenario. However, who are the only ones that will be able to capitalize off this position?
Ones that can see the liquidity pools and target them.
Mm-hmm. Yeah. So yeah, we are the only types of traders following rule-based ideology that will be profitable from this trade. Now, of course, if you're resistance, and you don't have a stop loss, which everyone has done at some point, sure, you'll win, but you'll most likely lose before the move happens, right? But this is how we need to view it. Two types of traders are losing in this scenario, right? Two types of traders are losing here, and we are able to capitalize and understand the right move by understanding what they're doing wrong, and by understanding where everyone else is losing. There is only one place to win. It's, again, you're like in a maze. If you know the right directions to take on how to get there, you're avoiding all the trap doors, you're avoiding all the traps. Hence the whole matrix approach, right? If you understand how to escape the matrix, you then don't get caught into it like every other type of trader who is not successful. Okay. This is the resistance. So we have two types of traders. We have our breakout traders and we have our resistance traders. Guess what? Same thing as for the buy scenario. We have traders who are looking to buy here. Stop losses down here. We are going to have our sell orders below here. If we're bearish, guess what? Those traders who have no clue about market operations, they're like, oh, I want to catch the fall, catch whatever. Well, guess what? Traders who are looking to buy here, they're getting screwed. They're losing, right? Where's their stop loss? I don't know, some 10, 15 pips below. No one in retail knows how to play stop losses. So they just make something that makes sense to them. They're going to lose here. At the same time, we have sell orders here that are going to be entered. So what happens? Instantly, those support traders are going to be losing. Instantly. Those who are looking to sell, their orders are going to get triggered at the same time. Oh, I'm going to make so much money. I'm going to do so well. Then guess what happens? It's going to completely screw them. They're just going to be completely losing. And by identifying this, by knowing why both of these types of traders are losing, and because we buy below this type of liquidity, it's going to ensure we're the only type of trader, as well with the institutions, that are going to be making money. Why? Because the institutions are funding this whole move with their own money, with their own capital. They know that all retail is going to be accumulating their positions here. So what do they have to do? They're going to manipulate the markets by injecting all the liquidity they have to counteract all the liquidity that we put into the market to take us out. It's never ending. They're literally trying to screw us and using our own emotions and logic against us. And pretty much, essentially, when they know that you're going to lose, They love watching you try and stack your positions. Oh, it's gonna go to the moon. I'm gonna buy it. They know that you're thinking that. So they're gonna give you a little bit of false hope right here when you buy. Oh, yes, buy. Oh my God. F. That's what they're gonna do all the freaking time. Every time, every move, everywhere. You need to understand this is why it works. It'll always work. It has always worked. There's only buyers and sellers in the market. And this is what they always do. And this is how price is manipulated. But just a one little insight as to why and how.
So technically, it really is kind of like a casino where they'll allow some people to win, right? They have to convince you that that's a support level. And then once a good number of people believe in it, then they take you out completely.
Exactly. That's exactly how it works. They want to give you hope, and they'll let you win sometimes, but it's like gambling addiction. You'll win a little and lose a ton. But that couple times you win, I know I can do it. I know I can do it. And you'll risk the whole house. You're going to risk your whole house to be screwed by the house. And that's the whole thing. They'll let you win a little, but you're in the long term, you're going to be giving them your whole life savings, So like, it's all about risk reward. They'll give you a little piece of the pie, but then you're going to get the whole rest thrown back in your face, So that's exactly right. That's why if you've won sometimes, it wasn't coincidental. Everything else happened to align, and that there was that reason for it. So yeah, man, absolutely. All right, good stuff. I think we're all good with this. I know this is a long day, but it'll be worth it. It'll be worth it. All right. So, juice. Okay. So that's the first type we call equal highs and equal lows. And also, it's very important. I want you guys to understand that first point, that first high or that first low, it must be higher or lower than that second point. That's just one last thing to add in there. Unfortunately, it just cleared, but I'm going to. Yeah, but that's what we know. So again, real fast. This low, if we're looking at equal lows, this first point must be lower than this point. If this second point is lower than the first point, then this is something different. So just make sure that 1 is lower than 2. It must be lower than 2. Same thing with the cells. That first point must be higher, right? It must be higher than this. If this is higher, this is something completely different. All right. Next thing is relative equal highs, relative equal lows. So like this is like a whole liquidity pool of it. Okay. I'm not going to spend too much time on this because it's the same exact ideology, just when there's a whole pool. So rather than it being the first point larger than the second point, like for instance, yes, this point is right. This point is higher than not all of it, but there's a whole pool which is here. Everyone is looking. And of course, what does retail think? The more touches, the better, right? But classic, that is not true at all. The institutions do the complete opposite. Oh, there's a lot of rejection. I want to look to buy here, sell here. Nope. The more rejection there is, think about it. The more traders who see this, what do you think they're doing? Oh, I'm getting so much confidence. There is so much effing liquidity above here. Everyone and their mother's stop losses are right above here. So what's institutional logic? Get that back. I'm going to take that money and run away, right? So what are they going to do? Induce and build up even more orders before screwing everyone and taking out all of these types of traders. So that's what that's the pool. It's just a whole area, a whole conglomerate of traders, much more. And if the more liquidity you see, AKA the more stop losses you see, the more support, resistance, whatever, the bigger the move you need to imagine, because this is essentially the money, AKA a ton of gas. This is like, you're giving a bowl of cocaine, right? Like if you're giving a bowl of cocaine and you're about to put a cowboy on that thing, what's going to happen? Cocaine, cowboy, just whipped. It's just going to throw them off, right? It's about to go crazy. If you see a lot of liquidity and you are looking to sell above that liquidity, you're about to make a ton of money. And this is how it's going to repeat itself. The more liquidity that's there, the more of the movement that we know is going to happen, even before it happens. right? If this is where price currently is, we already know what's going to happen before it gets there. So that's how we can expect to start to develop this preliminary 2020 foresight vision rather than hindsight. So this is the liquidity pools for the equal lows or the equal highs. And then of course, the equal lows is just the same exact thing. So equal lows, if you see, oh, the more touches, the better. What do we know? Of course, support traders are going to be looking to buy here. We know that, but how can we use what they're doing against them? Well, if we know this is where price is going to come, we can actually just be looking for sells, doing the opposite, because that's what institutions do the opposite of what retail is doing. And that's all the manipulation. If you see something that you would normally do, just do the opposite. Again, if you do something you normally do and you're losing, the fundamental level is how do I win? Just do the opposite. I mean, that's really all it is. And same thing, traders looking to buy. Oh, I want to buy here. Those breakout traders who are looking to sell. Oh, I want to sell below this low. This is a more vivid example of how both types of traders, their transactions are swapped into one another, and both of them are going to end up losing. Breakout traders sell, screwed. Buy traders who are buying here, screwed. Both these types of traders are losing. Yeah, and both SLs are collected. Institutions then have swept, aka collected enough liquidity in order to continue higher. So in order for us to maybe get up here, we need to collect enough gas to go there, right? So you always need to think about it like this. In order for the market to go anywhere, you need gas to get there. Where's that gas at? Where's that gas at? Where's the stop losses are? Identify the stop losses. That's the fuel for where the market's going to go. Do the opposite in the other direction, but just a little bit of an insight. Again, 5% of the total curriculum. Anyways, the third type, liquidity sweeps. Now, this is that first thing that we were referring to. The gas is at the gas stations. Yes, sir. You got to know where the gas stations are to fill up and go where you need to go. Last type is liquidity sweeps. Okay. So this is, we know that these are equal highs, right? But now the difference is when we have this, even if it's like this, let's think about this. These are not equal highs now, right? They're not equal. So what do you think this is actually telling us here? If someone could unmute their mics and say. If this isn't equal highs, right? And if we're not looking to sell here, what just happened? Well,
POS?
Well, no, not a BOS, but thanks. Liquidity sweep, right? If no, you're good, bro. So remember, let's say we had equal highs here, but what happens when equal highs are taken out? What needs, based off of what we just talked about, what's going to happen next?
Reverse lower then.
Yeah, right. We're going to be reversing lower. So this is the third type of liquidity, which is a liquidity sweep. And essentially, this is where we've already collected the money. And I know I'm kind of transitioning for a second, thinking about structure to thinking about liquidity. Is after liquidity has been taken, what do we need to do? If we just kind of talked about it, well, liquidity is taken, that's the gas, we're going to be ready to go in a new direction. So liquidity sweeps, the purpose of intention of liquidity sweeps is after price has already swept it, and let's say this is where we are now, let's say we're right here, we need to be looking to trade in the other direction. That's what we need to do. I'm not going to spend too much time on it, but that's what we need to see. Whenever you see equal highs, equal lows, for that first example, what are we expecting? We're expecting liquidity to be swept, right? In order to go higher. But let's say that the liquidity has already been swept. Well, let's think about it. Where does it need to go? Well, it's just going to keep going that direction so we can actually utilize lower time frames in order for us to get to where it needs to go. So liquidity sweeps is after the liquidity has been swept and we need to look to trade in the opposite direction. It's really rewiring and training your brain to think opposite of what you've always done.
I love it.
Sweet, sweet, sweet. Yes, Jorge, of course, the whole community, you are Yes, you're going to meet all the other students. So yes, yes. You guys right now, it's just the main bootcamp server. You have all the other channels are in that same server, but you only have access to the bootcamp channel. As soon as the bootcamp's completed that first Monday, you'll be added to everything else, and you'll meet all the other students.
Okay, thank you.
Yes, sir. Oh yeah.
Hello.
Hello. Let's see. Tired of us already, Jorge, right? He needs new people. He's like, I've seen these people already. I need to meet others. All right, guys. So exactly, liquidity is different from equal lows, as we talked about. Liquidity sweeps equal new direction. Liquidity builds equal targets. Definitely write that little point down. Liquidity sweeps equal new direction. Liquidity builds equal target. So for instance, let's think about this. If we have liquidity here and we have liquidity here at the most basic level, let's think about this. What do we need to do? We need to collect enough gas below here in order to go where? To go here, right? Take out money to target money. Just a basic introduction. All right. And for instance, this is where the area where the institutions are getting in at. So what do they need to do? They need to come back to break even on their position to be going higher. I'll talk about that in just a second. Damn, there's a lot. All right, guys. Liquidity sweeps are after equal highs, equal lows have been taken out. Pools are the same thing as equal highs and equal lows. There's just more of a build. All right. This is where the institutions rate in reverse. So we trade away after a sweep has happened and then around, and I can't tell you that we haven't talked about it. Okay. Let me see, guys. I know that this is a long, I've never spent this long on it.
What was the last thing you said? You said liquidity sweeps are something and liquidity build is, you just said something right before you switched.
Yep. Right here. Liquidity sweeps equal new direction, AKA right here, we have equal lows. They've been taken out, right? So sweeps after a build means a new direction. And then a liquidity build is a target, right? Where we need to be looking to either target or sell above. Yeah, Derek, EQU is equal highs. All right, and then yep, same thing here, too. Right, after we take out highs, what do we need to do? We need to take out lows, and this is just the basic operation of what's happening. After we take out highs, we need to take out lows. It's at first it'll be a little difficult, but more practice, it'll come naturally, and you'll unlearn everything else. All right. Let's keep going. I know it's crazy. I cannot believe it's already been that long. Okay. All right. So everybody, we're gonna keep going. Let's get through a couple more things, then I think we're gonna call it a day. I want to aim for at least 30 more minutes max. But yeah, that's I'm gonna try and keep it 30 minutes, and we'll pick off tomorrow. Leave off where we did today, and then do that. So just give me in the meantime. Let me just see. I'm just going through y'all real quick. I want to make sure how much we can get through. All right. So yeah, we don't have too much. All right. So I am going to be skipping some things just so we can go through. It's not going to be anything material wise. It will be, some stuff just explaining how liquidity works. We'll be covering this tomorrow. Do not worry. It's nothing educational. But now what I want to ask you guys, besides this right here, is right here. Let me annotate this. All right. So based off of what we just learned, everybody, I want you guys to illustrate now what we just talked, don't worry about structure here. I don't want you to think about structure. I want all of you guys to take 1 minute and illustrate the different types of liquidity that we just talked about. So go ahead and analyze it. Show me what you guys think. God bless it. Okay. Awesome, awesome, awesome. All right. Perfect, guys. Perfect, perfect, perfect. I love it. I love it. You guys already have a good understanding. Some it may be new, but let's see this a little bit more in depth. I'm going to clear drawings, right? And let's see, right? So whenever we have some form of liquidity build, price will always take it out. And this repeats on all fractal levels, mind you, right? So yes, we have, we have highs over here, right? We have some clear, oops, that's white. We have highs, right? So we have lows, highs, everything all in between. Highs here, boom, we know that. What do we have here, right? We have lows. We have more equal lows here. We have, lows here, lows even in here. All of this fractal level stuff, you'll see even here. What do we have here? Highs taken, right? Highs taken. All of this is kind of like just a whole pool of equal highs. What needs to happen? Collect your stop losses, and then in order to move where? Same thing over here. Where are some of the other types of liquidity? Well, we have some form of support. Takes out, right? Let's think about in the future. Liquidity, right? We have support, 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 support. What's going to happen? It's going to fail even over on this token, right? Resistance, resistance. What's going to happen? Fail over here even, right? You might see some form of support even all the way down here. 1 touch, 2 touch, 3 touch, fail. And this is just looking at here. But once you understand fractal liquidity, you'll be able to understand moves anywhere. And this is what you guys will be learning how to master. And when it comes to different types, any of these moves you'll be able to take. But when it comes to right now, there's liquidity is required for any move. And this is just a basic overview and introduction to it, but showing you guys that this is how all market operations are based off of. Any move anywhere, you have to collect enough money to get there. Once the liquidity sweep is completed, the order is pressed there for. Yeah, Mesh, that's partially correct. All right. Yeah, exactly there too. All right, all right. So now I want to ask you guys, go ahead, mark what you see. I want you to do this again. Let's mark all the different types of liquidity that we have just talked about. And be real with yourself, ask, I know it's like Picasso right now, but y'all will be able to see. Let's get to the point where no one can see nothing. All right, all right, all right. All right, well, you guys are exactly right. Once again, as always, beasts, let's look at this together, okay? So thinking about liquidity, support, resistance, maybe, right? Well, first of all, yes, we do have a sweep here, but let's think about support. Maybe we have 1, 2, 3, 4. I'm going to run my money to the floor, right? Support traders, obviously, lose here. Let's think about resistance traders. Where are resistance traders possibly going to be selling? 1, right? Maybe so. Maybe this is a resistance zone. I can expect price to come in. No, of course, it's going to be manipulated. Well, then maybe you're like, 1 touch, 2 touch. Here's going to be another resistance over here. Crazy, right? That's what people would think. But then guess we're like, 1 touch, 2 touch. I know there has to be a 3rd touch. It has to be over here. Blah, blah, blah. No, now granted, if you put your stop loss like maybe 35 pips above, you could have gotten in. But let's be real. At that point, you're hoping. You're not using logic, So this is why that happened. Anywhere all in between. Oh, I have 1 touch, 2 touch, 3 touch. Oh my God, this is going to be such an amazing zone. I just want to look to buy here. He'll always take it out. 1 touch, 2 touch, 3 touch, screw, 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 screw. Buys here, right? Buys, oh, well, this is a break and retest. I want to look to buy here. This is a really good zone that has, no. And also when you guys mentioned this, hence trend lines fail, but that's for tomorrow, right? Trend line, we know why trend lines fail. And then of course, all those traders, what's happening here on a fractal level? Oh, break and retest. I'm looking for my break and retest. This is going to be an awesome zone. I'm going to go to the moon. No, it's not going to work either. Why? Everyone's orders are lining up here. And those traders who are looking to buy, they're going to be looking to buy down here. So where do we think money is? We already know the whole move before it gets there. Then it's just repeating this on a fractal time frame everywhere, all the time. And it's never going to stop. Now this is looking at the 8-hour chart, mind you. Like some people might have thought, oh, this is the 1 minute, 5 minute. This is an 8-hour chart, and everything in between is going to be the same. So, all right, I think we're all good with that. I love it. I love it. But we're not done yet. I want you guys to do the same thing right now. Take 20 seconds, do it, and then I think we're heading to the last quarter of, ideally the last quarter, but we're going to go through the last of it. All right. I'm gonna tell you. So my question for those who are looking here. Oops, I think it was the next screen. My question for those who are looking right here. Let's think about this. If this is where we are, what do we think is going to happen? If this is where we are, and we see this down here. Now the question is to where though? Well, you'll be learning that. You'll be knowing that based off of this, right? Price can either go all the way down here. Why? What's all this? Support. So that's going to happen, right? Good stuff, right? So that's how we can know what's going to happen before it even happens. Again, resistance. Even you have, again, just people do some weird things because they think it makes sense. And we can see why it makes sense to them, but that's not how the markets work. Oh, sport. Resistance. And it'll just rinse and repeat. So guess what? Oh, it needs to come down. Oh, resistance. So what do you think? It's probably going to take out higher, then go lower. Price. Yes, sir. Yeah, you got it. B. All right, good stuff, everybody. Good. So now, remember what we've talked about so far. Now we're just thinking about liquidity, which you're going to get to the point of understanding everything everywhere all at once all the time. But now let's refer back to structure for now. Structure, the first thing we always do, everybody, is we refer to what? Higher lows, higher high structural points. We have higher low, higher high trading range. Look to buy from this low to this high. Good stuff, Taslim. Thank you. I was going to mark that. Okay. Now what do we look for? Identify the trading range, premium, discount, equilibrium. We know this is discount. We're looking to buy. We look to buy at 50%, if not lower. What do we do now? The next key thing to do is once we have the structure mastered, we need to now understand liquidity. Well, what do we know about liquidity? Is that liquidity must get taken to go anywhere. So for that reason, we buy below liquidity and we observe liquidity below price entering our discount, or when we talk about order blocks, all that stuff, we always look for liquidity to be lying above where we're going to be looking to buy. We have liquidity lying above our discount. Now, of course, we can have liquidity lying in discount as well. It can be lying above discount. As long as we see some form of liquidity get taken, it's going to give us the confidence understanding that, all right, support traders are losing, Breakout traders, right? They're losing. So what do? We utilize that as gas for us. Again, we're being greedy when others are fearful per se. We're capitalizing off of others' fears and their emotions and their logic in order to do what? To make higher highs. Very simple. Okay. Think about it. Taking liquidity to do what? Liquidity swept to target liquidity, then to do the same thing. Take out more liquidity to the left. So these are the 4 basic things that you need to be doing whenever you're applying this to the market. Now, again, you're never going to have, this isn't going to be your area of entry. For now, we just need to tell you guys that this is how you kind of are going to start segmenting, because we start from absolutely knowing nothing to structure, to specific structure, to order blocks, to how to enter, to where to target, to you'll know every facet, but this is just a holistic overview. All right. Cool. Now a specific application, we're looking at this as we just saw to the left. Structure, what are the structure points that we are always going to mark out? Well, we see we have some high, low, high, right? And then of course we need to have a low before we have a new high. So now what my question is let's look at this, right? Let's say this is all we had right now. This is all we had. We want to be asking ourselves, right? Where is the liquidity lying in the order block? Where are we going to be looking to enter? Well, liquidity wise, do we see any form of liquidity over here? Oh, well, we're already in discount. We see some form of equal lows, so we know we want to be buying below them. This is AKA the stop losses. And where do we need to go? We need to target new structure. So what's going to happen is, as we can imagine, what? We're going to rapidly take this out. And of course, what are all retail traders thinking? Sell. You see big candles, big wicks, you're afraid of it. That's what they want you to do. We love big wicks because guess what? We know that it's scaring everyone, then to take out everyone and go up. And that's why all of our entries are always sniper entries. Any entry we have will always be a wick. Any entry, it doesn't matter. Because when we're getting where institutions are, it's liquidating everybody else. So we're always going to have sniper entries. You're never going to be entering on a candle. I mean, it's always entering in wicks. All entries will always be sniper entries because of liquidity. So after we get in our position, guess what? Big wick energy. I like that. That's funny. Now we can, sorry, that threw me off. So now we can do what? Anticipate new structure. The same thing is going to happen over and over. Okay. So now if we even think about it for now, building that foresight. Support, resistance. Guess what? What is this? Isn't this just a larger liquidity sweep? So now where do you think we could be targeting? After we take out all of this over here, where do you think the next area of liquidity is for those who might be advanced? Let's think about support, resistance. So what do we think is going to happen? We already know what the next move is going to be based off of market operations. We already know. And that's what we're going to get to the point of going, understanding specifics. Like, well, I know this would happen, right? So good stuff. Love it. Awesome. Beautiful. Same thing, sells. I don't need to go through all this. Lower highs, lower lows. I think we're all kind of getting familiar with the whole anatomy of it. Again, guys, I took it slower because we do have some new students today, and hopefully it's making sense for the most part. But all right. Yeah. So again, same thing. Look for higher low, higher high structural points. Lower high, lower low structural points. What do we need to see? Liquidity before? We need to see liquidity being taken out into our premium price. And then what do we expect? Of course, target new liquidity or target new structure per se, because structure is king right now. It's king today. He's getting slain tomorrow. All right. And that's the move that we're going to be expecting. I think it all makes sense to everybody. And of course, we'll go through one more example showing that as well, right? We have 1, 2, 3, 4 relative equal highs. So of course, what are we expecting? This is a whole pool. Again, even if you identify it like that, it doesn't matter. You know, just seeing multiple points have multiple touches, Look at liquidity building up. Where's the other liquidity? Well, you have, support. Of course it's going to lose. Support. Of course it's going to lose. We know it's going to lose. So what do we look for? Price comes up, sweeps the liquidity. What does it do after? It breaks structure after that liquidity being swept, right? If we have that BOS right here, higher low, higher high, BOS. And what do? We look to then enter based off of liquidity being taken, which we have liquidity taken right here, which you guys will know this specific point. Exactly, Daniel, right? And then guess what? We have a cute 2 pip stop loss. And then if this is our entry here, and this is our stop loss, this is our first target, that's already a 1 to 10. But now what if I told you how the mastermind approach is, you'll be entering this, I mean, at the minimum 3 times to go lower. Suddenly that becomes over 1 to 30, 1 to 40, right? And that's how you exponentially grow accounts, risking very minimal. So, all right, this should make a lot of sense to everybody. All good. All right. Sweet. Jesus, long. All right, last break before the last quarter. Last break. Enjoy it. Let's have this one be 5 minutes or so, and then we'll get right back to it and finish this up.
Sounds good.
All right.
Did you recently move into that high rise?
Dude, so me and Tristan we were in an Airbnb, and I'm looking right in the area. Actually, Earl, he is I don't know if he's a realtor, if he has places, but I was talking to him, and we're looking for a place right now. My lease fell through, but that's regards to a few places I am looking for. I got my eyes on right now, but no, until in the meantime, chilling in sky rises.
He'll be taken care of, yo. We're gonna take care of him.
You can get me right. It's a little pricey, but it's worth it.
Oh, you live down there too, Earl?
Yeah, I do real estate down
Okay. Yeah, I live 3.5 hours away. I'm in the middle. Yeah, Tampa.
That's where I'm supposed to be today, actually, Tampa.
Okay. Like, yeah, we're gonna link up. I'm scripting a steak. I'm gonna meet up with him and give him that steak. The man deserves it. I was like, we don't get Outback Big Boy T-Bone, the one he can't finish. That's what I'm talking about, you know. But yeah, man. Plus, I need to see the beach. I haven't been there in a while. It's been about 2 years since I last been in Miami.
Oh, you're long overdue, man. You gotta come down here.
Look, man, them young jitterbugs be pissing me off. I can't do it. It's like maybe if I was a little younger, I'd probably be a bit more excited. But I'd be like, I just go there just to see the Rays, and I get my like y'all didn't young bloods and took it over. So I just go there for the Rays a little bit, have a little fun. I'm gone. I can't do it. Can't do it.
Bro, Miami's changing every day, man. Every day.
Oh my God, like it's becoming. It's almost like it's becoming Hollywood. You ever been in Hollywood?
Absolutely.
So you know where Hollywood is, and then right off the back end of Hollywood, you know where Malibu, and then the part of Beverly, like Miami's becoming like that back inside of like Malibu and everything. I'm like, how the hell is this happening? I was like, wait, this is a retirement state.
This is the new Dubai. This is the Dubai.
Yeah, dude, at this rate, you said ain't a steak I can't finish. Oh well, hey, then. You know what, Daniel? I appreciate a man of character and a man of culture. Any man that can finish a good steak is a good man in my mind. Like, you know what? Which reminds me, we need a Wagyu steak when we visit you. Just blow a couple $100 and get a. Well, I ain't never been to Salt Bay's restaurant. Is it even good? Has anybody ever been there?
Yeah, I've never been there. No, Nusrat or whatever.
Yeah, Nusrat. I know it costs an arm, a leg, 2 pennies, and a shoulder.
All right, guys, girls, let's get back to it. Let's get ready for the last quarter. Now, I'm telling you right now, we will not finish today, but I'm going to be working endlessly tonight to try and refine it. So tomorrow is the shortest day, which is good. Kind of makes up, balances out the time for this weekend. But of course, you guys are getting exactly what you guys signed up for, and that's the whole mission and reason behind it. So let's go ahead and get back into it. Our admin, he's gonna make sure that everyone's to their seats. They're all back, they're active. I think we're all good. All right. Make sure everyone's cameras are on too. Please turn your cameras on. We're gonna go ahead and get started here. I'll give you guys about 30 seconds, and we're gonna go ahead and get finished and wrap up with a good day one. All right, as mentioned, let's turn on our cameras and we'll go ahead and see your pretty faces and get started. So, all right, everybody, we're gonna go ahead and finish up today. We're going to cover the last block, which is going to be imbalances, order blocks, IFCs, and potentially the locations of them as well. So some people know what order blocks are, some people don't. Some people know, doesn't matter. We're gonna approach it as if you know nothing. So in this slide, all I'm going to talk about is imbalances. So this is going to be, I'm just gonna go ahead and type for you guys right here. With imbalances, this also, they're referred to as inefficiencies, fair value gaps, I don't know other names, doesn't really matter, but they all mean ideally the same thing. And essentially what these are these are gaps in the market. These are gaps in the market where there's only one type of order going on. And what we understand about market operations is, yes, it's manipulated, but at the same time, it still needs to be distributed fairly. And that's where there's a little click of, oh, this makes a lot of sense, or, oh, like, why is this happening? Like, it's so manipulated, it's not fair, it's rigged. Well, yes, it is rigged, but to a degree, until it makes price balance or efficient again. So what is an imbalance? I'm going to go ahead and draw a chart. Let's say that we have something that looks like this, and it's going to take me a second to draw for you guys. But let's say we have.
Hey, Griffin?
Yes, sir.
We can't see what they're typing or drawing. No, we do.
Thank you for being the only one telling me that. All right, so.
Do I get an FTM for telling you that?
Yeah. All right. So imbalances and efficiencies. Okay. So let's say we have something in the market that looks like this. All right. We have this, maybe this, and then let's say we have this. All right, so when we're looking at this, you just have to give me another second to illustrate this. Here. And even you guys can draw this out as I'm illustrating too, because this is very important. And some people might be confused and not know what some of this is. I mean, I can know that for sure. Some people won't. So let's take this a little easy. All right, so what are imbalances? By definition, imbalances are gaps present in the market, illustrating only one type of active buyer or one active seller. Now, when I say buys or sells, okay, I mean, or one person, it's really just one type of order that's going nonstop in the market. Okay, so let's say that we're looking at something like this. What an imbalance is it's a gap between three candles. All right. So when we're looking at this, right, we can clearly see that we have all these different types of candles, which is great. Okay. We can clearly see this, but now what I'm trying to illustrate is between the wicks of candles, there will be a gap. So when we're looking over here to the left, and I'm just trying to illustrate that maybe we have something here. It doesn't really matter what's over here, but then we're essentially going down. What we need to see is between the candles is a gap. Ideally, what it's going to look like is a gap between three candles. So let's say we have candle, I don't know, let's say we have candle 1, 2, and 3. And I'm going to illustrate it as so. So you have candle 1, 2, and 3, and you can label them as 1, 2, and 3 with me as I do this. So we have 1, 2, Candle 1 is what we call our order block, but I'm going to be ignoring that for now. An imbalance is a gap between two candles and the wicks of those candles. So for instance, when we're looking for a gap, we can clearly see candle 2, between candle 2, 1, 2, and 3, 2 serves as kind of like a mediary between the two. And we see a gap between here and this wick. Essentially, it's a gap between two wicks and a body in between. That's what it is. Even here, right? Do we see another gap here? Well, we see a gap from this low to this low, right? And this is showing us where imbalances are in the market. And imbalances or gaps, fair value gaps, whatever you want to call them, in order for market or pricing to be efficient, we need wicks to touch one another. We need wicks to touch one another. That's showing us that pricing is efficient. There's no gaps. Like for instance, over here, right? Do we see over here, this wick was met. So there's no gap, right? Over here, there's no gap over here. There's no gap, but over here, there was another gap between here and here. If I had to make a better example, I probably didn't do that in the best way. Just 3 candles, just draw 3 candles. And this will be a sell example for an order block or a sell example for imbalance. Gap, gap, gap. And this is a sell imbalance model. Where is the actual imbalance? It's between right here, between our gap at the low of this wick, right? And then the high of this wick. This is where the gap is, okay? And this is what we call our imbalance right here. And what we look for imbalances to do, I don't know, some people use 50%, some people use the open. All that we care about for imbalances is it needs an imbalance always must be closed. So that means in the future, yes, price can keep going lower, but before it actually continues going lower, it needs to fill the imbalance. So price needs to come all the way back to fill the gap. If this is the gap, it needs to fill the gap. It needs to fill the gap before going lower. Now, this is where ICT or other people, they're dumb and they say, oh, 50% mitigation or no. If you always look at a fair value gap, and I'm speaking to those who know what they are, see what happens. People are like, oh, fair value gap. This is what I want to identify. There's a reason you're always looking for a gap to be filled, because this is what we call an order block. It's above the imbalance. All right. So now that we can see this, an imbalance is the gap between two wicks. 1, 2, 3. Imbalance is the gap between 1 and 3. Now, on the opposite side, let's say now that we had a buy scenario. Okay. Let's say we had buys, right? For our buy candles, and I'm just going to use them as white candles, right? Let's say that we are going higher for our buys. We have maybe 1 candle, 2 candle, 3 candle. I'm going to pick on someone to ask or to illustrate it. Let's see here. All right. Let's see who I'm going to pick to be my victim. Being a little slow. Someone I know might not understand. Tristan. Tristan, I want you to illustrate the gap for the bullish, for the buys to the left, if you can understand. Sweet. Okay. Cool. So that is our imbalance, right? We identify imbalances because these imbalances need to be filled. If you do not see an imbalance, do not look there. Absolutely do not. People say, if you don't have an imbalance, you're not going to look there. Imbalances is unequal price distribution, and imbalances need to be completely filled before price continuing higher or before price going lower. Now, what's lying at the close of the imbalance is what we care about. We don't actually care about the imbalance itself, meaning taking trades from it. But what we do take trades from is what we call order blocks, or IFCs, institutionally funded candles. And these are the candles that lie at the closure of imbalances. So all of our candle 1, our candle 1. This is how we look for our points of interest. You know, where we're looking to buy or sell on higher time frames. These are going to be our entries on lower time frames. So make sure you have that in your notes for imbalance. It's the gap for between 3 buy candles, 3 sell candles, ideally. Now, the candle color doesn't matter, but routinely that's what it's going to be. All right. Okay. So I think we're all good with that. Are we all good? Cool. I think we are. All right, so now let's move on. And now we're in the final stretch of today. Thank you guys for staying on. I know it's a grind. So now order blocks. We talked about what imbalance are, but let's talk about order blocks. For me, I refer to them as institutionally funded candles, IFCs, order blocks, supply and demand. If you guys have heard of that, I guarantee you're not marking those zones right either. It's all part of supply and demand. And institutions collect retail orders. It's the area where institutions have artificially or willingly put their own money in to take out every type of trader. So we need to understand that it's the candle that liquidates or takes out your money, takes out your stop loss, and then goes in the opposite direction. This is how the major banks and institutions are, quote unquote, showing their hand. And this is one of our, it's very easy to identify this once you learn what it is. And you can, if this is what you want to do, and you just play basic plays, this is very smart money based. You'll learn why we don't do this tomorrow. But for instance, you need to know. So what is an order block? 4 key features of an order block. Write all of these down. Take 20 seconds and write them down. I promise you. And if I had to illustrate, and I'll talk about this in a second. First of all, the order block, IFC, supply demand, it must take out liquidity. And it's not like it can only do one of these things. It must always do these four, or it is not an order block. It is not. 1, order block must take liquidity. 2, order block must create an impulse, meaning a large move, and or a break of structure that aligns with structure. Three, the IFC must cause even a small imbalance that creates inefficient pricing. I just say leave, the IFC must leave imbalance. Just say that. IFC must cause imbalance. And 4, IFCP must be located in a relevant area, decisional or extreme, which we'll be talking about. I'm honestly, I'm not going to say today. I'm going to say tomorrow. I'm going to wrap up with this today, guys. All right. So what is an order block? All right. An order block, when we're looking at this, is exactly as mentioned. So what we know about liquidity, and as we talked about, one of the liquidity types is whenever liquidity is taken, we need to understand that this move, this whole move right here, right? This whole sell-off that's happening, that's going to be taking out all these positions. This is a liquidity sweep, or AKA an institutionally funded move. This is where the institutions are utilizing their own capital to take out all of these traders, collect their money, and then cause price to reverse. But we need to understand that institutionally funded candles, the reason they're called order blocks or IFCs is because they're literally blocking all of the orders, collecting all of this money before going lower. So when we're looking at this one candle that takes out those traders we're looking to buy here, this becomes the order block. Okay. So when the order block is taken, when the order block takes out liquidity, we have this. We have candle 1, candle 2, candle 3, which should be right after. Candle 1 is always the order block. What must happen is that second candle must engulf the actual order block itself. So if we have an order block right here, that next candle must open below and close above, right? Because what does that do? It leaves an imbalance, right? It leaves an imbalance above. Now, the third candle, what's going to happen is it'll just continue going higher. And notice there's an ever so slight gap that's left behind after it takes out the liquidity from the left. So what does this tell us? Well, the institutions have to break even on their position. So long story short is that even it can keep going higher, but for it to make the real move, it needs to come back to fill that imbalance, right? And what's left at the close of an imbalance? An order block. So it needs to take out liquidity. 1. Second thing, create an impulse to the upside, right? This will be 2 over here. 3, must leave an imbalance. 3, check. 4, it must be located in a relevant area. This is what you guys will be learning tomorrow, right? 4, and then what do we expect? New structure. Should make sense. The color also, the color of the candle does not matter. It's just the last candle before price reverses. And we have, of course, always examples to show. And we're going to end off with that today. So about 10 minutes and we're done for today, everybody. Bearish example, same thing. Some high has to be swept. You want to find that exact candle that took out liquidity, right? That candle that took out these highs. Now what happens? You find the candle, the next candle must leave an imbalance. That candle must take out liquidity. It also must cause some form of impulsive move. What's left is an imbalance, and you always need to have an imbalance to consider an order block. If there's no imbalance, it's not an order block. Don't care, it's not it. This is what you need to look for. So what do we expect? Price to come back to fill the imbalance completely. We don't take trades off of imbalance. We just use them to identify order blocks, identify the imbalance, right? And the price will go lower. So where is our entry? Where is our stop loss? Our entry is always going to be at the wick of the order block. That's always where your entry is going to be. Always, always, always. Where's your stop loss? Your stop loss is going to be literally at the high of the order block, right at the high. If you want to add half a pip for spread, by all means do it, but don't add like 4 or 5 pips. This is no retail BS, you know, it's always exact. If it breaks that order block, it was wrong. It's not going to work. Like very, very easy. Because that's where institutions are accumulating their positions and they need to break even on. That's why we look for order blocks. Okay. So your entry for here, let's say, your entry is going to be right on the order block as the wick high. It's going to be right here. Your stop loss is going to be right there. Don't add more than 1 pip to your stop loss ever. Don't do it. Just don't, right? Take the loss and move on. That's what the whole psychology we'll be talking about. But this is how we need to be looking and approaching the markets.
Griff, can you go over where the entry is one more time in this scenario?
Yes. Yes. So the entry is always going to be on the close of the imbalance. So the candle that entry, right? Let's say we have an imbalance right here. Okay. This is the imbalance right here. The candle that is left that closes the imbalance, meaning if this is our imbalance, we know price has to close the imbalance. The candle is the order block that initially starts the imbalance and is required for it to close. So there's an example I'll show you, but order blocks must have imbalance before. We wait for the imbalance to be closed, which will always be where our entry is, and it's going to be at the order block. Yeah, the next slide will answer that question though. And don't worry, y'all, we'll have a review of this tomorrow as well. All right, so let's go over just a couple more things and we'll get off for today. So order blocks, guys, let's think about this. First, we have some form of low, swept. Where's the order block? The order block is the last candle, right? That takes out some form of liquidity and it has imbalance above. Where's your order block? It's right here. It's the candle that requires the imbalance to be filled. If this is your imbalance, right? This is your order block. Now, Tristan, I'm going to ask you, where's another order block over here? Tristan.
This is the admin. Why don't I take a shot at it?
Okay.
Order block?
Yeah.
Do you want just extremes?
No, just select the order blocks you see in this.
Sure.
Any of them. All right. Yep.
And there's a ton more, but
yeah, but no, notice notice what happens, right? Starting from left to right, some highs. They're swept, and what does price do? It drops. Candle 1, what does candle 2 do? Candle 2 engulfs candle 1. It opens above it, closes below. Don't we see that there's a huge gap right here? So we know in the future, price must do what? It must fill this gap, correct? And what's left at the closure of the gap? An order block. And do you see how we got some form of reaction here? This will always happen. Now, this wasn't the right order block by any means, but any order block will always give you a reaction. So this is institutions breaking even on their position before resuming higher. What's over here? We have another order block, right? What will happen? Institutions will break even on their position to continue higher. Well, what's left over here? Don't we see another order block? What will happen? Price will take out some form of liquidity to mitigate the order block, to tap it, to then go higher, right? Same thing over here. Isn't there an order block over here? There's another order block. This is where price will tap. This is our entry. And then guess what? It's going to be going lower. So just showing you everywhere, order blocks will always be mitigated. So at this point in time, think about it. If some lows equal lows, right? We have our order block here. What do you think is going to happen? Well, if we have another order block here, what do we think is plausible? Probably that. And this is how we need to kind of start thinking about order blocks. Master order blocks become very good. Your stop losses are going to be ridiculous. I mean, your entries are going to be ridiculous. Your overall risk reward is going to be phenomenal. So Order blocks are the candles that lie after imbalances. How do you identify an imbalance? Look at a candle, right? Look at a candle and look to the right, immediate right. You look at a candle, look to the right. Is there a gap after? Yes. Look to the candle. Is there immediate gap after? Yes. Right. Cool. Look at a candle. Is there a gap after? Yes. Right. Even here. Is there even here? Where's an order block here? Do you see? Look at a candle. Is there a gap after? Ever so slightly. What happens? Still an order block, right? Still an order block. It'll always give us a move. Rinse and repeat all the time. Just ask yourself, if you're looking at one candle to the right, is there a gap after? If so, it's an order block. All right, so that was one example. And then last one, before we go ahead and call it a day, is same thing, sweep. We have highs swept. Where's the order block? It's the candle that has imbalance after. Where is the imbalance? Well, after this candle, is there a gap? No. After this candle, is there a gap? Yes. So this becomes the gap. This is an order block, right? We look at this candle. This is our entry point. This is our stop loss, because if this gets broken, it was the wrong order block, point straight. So now, of course, what are we going to look for in the future? We know that price, if it's here, it'll always build some form of liquidity. Is this now I want to ask, is this an order block? Yes, this is an order block. Why? Because we have a gap after. But how do I know? Well, was it going to be this one? Is it going to be this one? I'll be learning, but this one won't work. It'll do something like this, trick everybody to thinking it's going to work. And it'll do something like this. So order blocks must have gaps. If it doesn't have a gap, it's not an order block.
Okay.
Yes, sir.
I have a quick question. Does this week invalidate this order block due to the fact that it is like between lines like already mitigated?
No, because think about it. To the right, and that's a good question. This candle, where is the open of this candle?
Of which candle exactly?
So if this is our order block, that next candle, the open must be inside of the candle. So the anatomy, we have a high, we have a low, we have an open, we have a close. This opened above the order block. So the order block was not mitigated. This is an engulfing candle. And what needs to happen is after an engulfing candle, price must come back in the future to fill this. I know what you're asking, but I think, I mean, I answered it, but like this, because it opened above it. Yes, it's like, oh, it came back and mitigated it, but we need to understand this move, it happened before price left. It happened before price went lower. It's not like it went lower, then came back in. It came up higher and then it dropped all the way down. So this is still left unmitigated from your knowledge. So price must return to here. All right. I think we're all good with that. Now, I'll go over this. I mean, now we could go through just a couple quick examples, just looking, right? If this is an order block, right? Takes out some form of liquidity right here. And where's the imbalance? Ton of imbalance here, right? So all this needs to be filled. And what's lying right above, even this small little imbalance right here, there's an imbalance. What needs to happen? As soon as price comes up to fill our order block, that's when we enter. And where's the liquidity lying? Again, you always have to be simultaneously understanding this stuff. We have all these equal highs, right? All of these relative equal highs serving as liquidity. Liquidity needs to get taken out. So what needs to happen? It'll take out the liquidity and then drop, even over here. If we're looking at all of this, liquidity over here, all this support manipulated, right? To take out, price then takes out this liquidity. Guess what? Isn't there an order block left down here too? Takes out liquidity here to go higher. So where's a new order block? Here. And this, you'll be understanding how to be taking buys into other order blocks, right? And then to do what? To target here. So guess what? Order block. Beautiful. It was tapped. Became another one. This became another one. This is a whole trap and stack, which you guys will be learning. There's so many entries after you understand what's going to happen where. Next is another order block. Takes out liquidity. Great. Imbalance. Where's the imbalance? Right after, little gap after. It's ever so slight. You may not be able to see it. So this is the order block. And where's the liquidity lying before? Clear equal highs. We look to sell above equal highs. All retail stop losses getting rated. And what do? Of course, look to target new lows, new liquidity. Where's the immediate liquidity that we see? Here. But we're looking to sell. So new structure, correct? So we take out a low. If we know what's going here, use this to our advantage to be selling down below here. And then guess what? After price breaks this, we have a new imbalance, right? This becomes an order block and we can sell lower. Vice versa over here. If we're looking to buy in this scenario, let's say we're looking to buy, where's the order block? The order block is right here. Takes out liquidity. We have our order block right here. We know that we are looking structurally looking for buys. Where is the actual liquidity? Well, we have this right here, liquidity here. One of the types we'll be learning about next week. And what do we do? Look to buy below. So this order block, beautiful. It was tapped. Now we have a new order block. Beautiful. And then price will continue higher. I know I'm going over this fast, but I think that's where we are going to end it off for today. Leave you guys fresh and reviewed for tomorrow, because I think there's about 20 more minutes left for today. And then tomorrow is going to be reviewing today, getting into the fun stuff. So it's going to balance out. I know it's almost been 7 hours. Tomorrow, I promise you, will be 5.5, if not less. But yeah, guys, what I want to do is let's go ahead and let me see this real quick, y'all. All right. So yeah. So I think what I'm going to do today, everybody, is we are going to call this a day. We're going to, so now, are you guys ready for the real sauce? Are you ready to dive inside the world of inducements?
Yes.
Ready to enter in the market, the same market exactly the time we do? Well, join us tomorrow to find out, everybody. So thank you. Today was a long day to say the least, but making dreams come true one day and trade at a time. Thank you, everybody, so much for your time today. I appreciate it so much. And tomorrow's going to be limitless, needless to say.
Griffin, quick question. Are we gonna? Is there a need to start an hour earlier tomorrow? Or still 9:30 Eastern?
No, 9:30 will be fine. Today was this is the longest, so no, yeah, tomorrow will be good.
Okay.
All right.
Thanks so much, Griffin.
You're welcome, bro.
Is there anything you want to do like until then, like homework or any reviews or anything?
Yeah, not until then, or not until Monday. You guys will be given homework for the week. I'll give you a review guide. You guys can study, get ready, and then after next weekend, you guys will join the community immediately, and then you guys will have the first call Wednesday, first community call, and then live trading as well. So yeah, don't worry. Just get your mind right. There's no homework to do. But yeah, if you wanted to study, maybe look up some order blocks. I wouldn't say learn from anyone, because my refinements that you guys will be learning are a lot different than anyone else. So, but yeah.
Cool.
Yes, sir.
Talking specifically about this, about this bootcamp, do you have any recommendation for like shortening the learning curve? Yeah.
Yeah, that's a good question. So what I'm going to do is any boot camps going forward, I'm not going to be teaching day one stuff. I'm only going to be focusing on days 2, 3, and 4. So what I'm going to do is either, there's two things, either have it just as an online course that people can go through it, or have, I just lost my train of thought. What was it going to be? Or have like an intro session, the first weekend of every month. Someone who wants to learn, just this, how to get a reduced rate, maybe just, a 1 weekend, 2 day, 3 hours a day, quick thing. And if not that, then what I'm going to have is I'm just going to probably record all day one stuff and then send that to you guys for you guys to review prior to the actual bootcamp start. So you can familiarize yourself, get ready, so we can just focus everything on day 2, 3, 4 stuff.
Okay, great. So even if in the future you only offer a course for the next people that get along with you, are we going to still be able to like watch the bootcamp if we want to do like in the future?
Yeah, for sure. Now, as far as a re-enrollment, the only ever fee there is a re-enrollment fee for the bootcamp. It's $250 USD, but that's it. And that's if you want to join. As it's a long time. But anything in the future that is included inside the community, it's always going to be included. The only additional charge is just going to be a one-time bootcamp enrollment, and that's it. If you're a one-on-one student, which we're not taking anymore right now, you have lifetime access to everything.
No. I mean, like if we're like, I don't know, in December or next year, and I want to see the bootcamp of this May, like 2022, can we do it? Yeah.